Hello all my dear students of full English. I hope you all are doing good. I hope your studies are going on great for your upcoming exams. So just a week back we have uploaded the compilation for 9 RTPs including the latest one, that is May 2025 RTP. And at that time I have promised you that I will also be uploading the compilation for the past papers and also for the past MTPs. So today I am going to compile the 9 exam papers of ICAI till November 2024. And we are going to compile them in a very comprehensive manner in around less than 3 hours or somewhere around 3 hours. So without wasting any further time, let's start with the compilation of the past papers of ICAI. Again, I am saying, believe me, these compilations are more important than anything available on the YouTube on my channel. Nothing can be more important than these compilations. You go through these compilations again and again and you'll be through with direct tax. Nothing can come beyond this in the CA final direct tax exams. And I am taking an extra effort for you all, that is I am recording in Hindi also, and I am also recording in full English for you all, so that the students who don't understand Hindi properly and who are more comfortable with full English can get the advantage of this particular compilation from my side. Okay, we have done all of them in our regular batch, in our exam oriented batch, in our practical question batch. We have done all these things, but the objective over here is to do it very fast so that on the day before examination you are able to revise it very fast. So let us start with our first paper, that is Jan 2021, and the very first question over here is on total income question. And what is given over here? The last line of the question is you have to compute total income and tax payable. Compute total income and tax payable as per the provisions of the Income Tax Act. You are not supposed to follow 115BAA. You are supposed to follow what? Just total income and tax payable as per the normal provision. Let us start. The assessee is a manufacturer. The net profit of the assessee is 75 lakh rupees. Now the very first adjustment is till last year, that is till 23-24, the assessee used to make one mistake. What mistake? They used to include the interest cost in the closing stock. Now which is not correct. As per ICDS it is not correct. As per accounting standards it is not correct. Till last year company used to include the interest cost in the closing stock. But from the current year onwards the company has changed that policy. Now, whatever mistakes they have done, they have rectified. If everything is rectified, nothing has to be done by us because the company itself has rectified in the current year. And if it is rectified, then no effect will come in our question. Okay. Second, provision for gratuity as per actuary is disallowed as per section 48(7). But whenever it is paid, whatever amount is paid, that is 1,20,000 is paid, will be allowed as deduction. Therefore, 5 lakh you will add back and 1,20,000 you will reduce. This will be the effect of this adjustment. We have done this adjustment a lot of time earlier also. Next, you are debiting some one-time franchise fee which is paid to Mr. Robert. You have on 16th of August 2024, TDS etc. has been deducted. Now franchise fee is nothing but what? It's an intangible asset. Therefore you have to add back the intangible asset. You cannot debit the intangible asset. You have to claim depreciation on that 25%. So you will add back the one-time franchise fee 20 lakh rupees and you will reduce 25% depreciation. That is what? Full year depreciation, because the franchise fee is used for more than 180 days in the previous year. Next one, there is some loss, cash lost due to theft when it was withdrawn from the bank. Okay, so cash lost by theft is nothing but a revenue loss, so you can claim that as a deduction under the income tax law. Okay. Next, you are on 1st December 2024, you have paid a royalty of 3 lakh rupees to Mr. Roger, a non-resident, on which you have deducted the TDS also. But you fail to deposit the TDS. You have deducted the TDS, but unfortunately you have not paid the TDS. But Mr. Roger, the non-resident, has included that in his income and has filed the return, etc. Still, do you remember that if I do not deduct TDS, I do not pay TDS, but the other person includes that in the income tax return, pays the tax, files the return, etc., then I am not assessee in default. Then I cannot be called as assessee in default. But in that case also, the expenditure will be disallowed in the current year and it will be allowed as deduction in the subsequent year only. In the current year, it cannot be allowed as deduction, and 100% expenditure will be disallowed because you are making payment to a non-resident. I hope it is clear to all of you. Now, coming to the next paragraph. Now, this is further information. Further information means it has not been given effect in the P&L. Okay. Till point number 5, everything was part of P&L. Either it was debited or credited in the P&L. But from here onwards, it's an independent discussion. First of all, you are selling some plot of land to a domestic company. Now this is the same routine adjustment, 100% holding subsidiary. If transfers assets within themselves, then it is not taxable. It is exempt under section 47. The only condition is the recipient company has to be an Indian company. So here also it is same thing is happening. 100% holding subsidiaries transferring something to each other. The recipient is Indian company. Therefore, this is exempt under section 47. Okay. Now, you will not reduce this from P&L because this is extra information. Okay. Don't reduce this from P&L. If it would have been credited to P&L, we would have reduced from P&L. Now this amount is not credited to P&L, therefore don't reduce it from the P&L. Directly go to capital gains and write a note and say that this is exempt. Next, there is a private limited company by the name called as Manu Textile Limited. Now you have taken a loan from that particular company in which you have 16% voting rights. So a private company is nothing but a closely held company, and I hold 16% voting rights in that company. And if such company gives me a loan, that is deemed dividend in my hand under 222E. But the deemed dividend cannot be more than the accumulated profits. The accumulated profits are 2 lakh. Therefore, the deemed dividend will be restricted to 2 lakh rupees. This 2 lakh rupees will go to income from other source. I hope it is clear to all of you. Next, you have purchased a motor car for the purpose of business on 23rd of August 2019. The WDV of that motor car today is 12,80,000. You have not considered that depreciation in the P&L account. Now, do you remember that? If you purchase a motor vehicle from 23rd August 2019 to 31st March 2020 and put to use between that period, then you will get 15% extra depreciation. So in this case, you will get 30% depreciation instead of what? Instead of 15% depreciation. I hope it is clear to all of you. And last but not least, you have hired some employees, therefore you are eligible for 80JJAA. Now you are eligible for 80JJAA only if the number of employees, the strength of the employee increases. Now just see, at the beginning of the year, there were 480 employees. Then you hired 120 employees more. Then you removed 70 employees. Eventually at the end, there are 530 employees. So is the strength of the company increasing? The strength is increasing. Definitely increasing. Therefore, you are eligible for 80JJAA. Now, to claim 80JJAA, there are a lot of conditions you have to fulfill. First of all, the strength should increase. Second, the employee should participate in recognized provident fund. Are they participating in recognized provident fund? Yes, they are participating in recognized provident fund. Third, their emolument should not be more than 25,000 rupees. Is the emolument up to 25,000 rupees? Yes, it is just 15,000 rupees. Next, they should be recruited for at least 240 days in a previous year. So they are recruited on 1st July. So therefore 240 days will happen. Plus they should be paid the emolument by online modes. Yes, they are paid the emolument by account paycheck. Therefore it is online mode. Now the last thing is on how many employees you are going to get the deduction. So ICI has taken two views. First view ICI has taken is take the deduction on entire 120 employees which are hired. First, this is the first answer given by ICI. So 120 into 15,000 rupees into 9 months into 30%. Okay. Now the second answer given by the ICI is take the deduction only on the incremental employees. What is the incremental employees? You are hiring 120, you are firing 70. Therefore the incremental employees only 50. Take deduction on 50 employees. So that is the second answer given by ICI. Both the answers are correct. Nothing wrong in that. Last but not least, the turnover of the company of last year is 450 crore. Therefore, the tax rate of the company will be coming to how much? It will be 30%. I hope it is clear to all of you. Now let's move on to the next question. Question number 2. It's a beautiful question on non-resident taxation. First of all, there is a foreign company, Vioni Inc., which is incorporated in Japan. Now the company is foreign company. First of all, we need to find out its residential status, whether it is resident or non-resident. According to that, the answers will change completely. So Vioni is a foreign company which is incorporated in Japan. Now they are coming to India. In India for 3 times. Its shareholders met in India for 3 times. Now what is the reason they are meeting to India? Are they meeting for key management and commercial decision? No, they are meeting in India for modification of the rights of the shares, and they are meeting in India for what? Sale of company. Now if you are meeting in India for these purposes, the CBDT circular says that, the CBDT circular of POEM says that if you are coming to India for modification of the rights of the shares, or if you are coming to India for sale of the company, that does not amount to what? Place of effective management. Therefore the place of effective management is not in India, it is outside India. Therefore the assessee is what? The assessee is a non-resident. According to that, you have to answer the entire question. Now the very first point over here is based on Vodafone case law. Dividend is declared by Miyani Inc. Miyani Inc. is also a Japan-based company. Okay. So how much? And Miyani Inc. holds 70% of the total assets in India. Now Miyani is giving dividend to whom? Dividend to us. Who are we? We are Vioni. We are Vioni, and we are receiving dividend from another foreign company. And that another foreign company holds 70% assets in India. So whether that dividend will be taxable in my hand? The answer is no. It is not taxable. Why, sir? Go and see the chapter of Vodafone case law in our book. Just take an example of Vodafone case law. CGP was located in Mauritius and STIL was located in Hong Kong. Now if CGP holds substantial assets in India, That does not mean that if CGP declares dividend to HTIL, then it is taxable in the hands of dividend. Such transactions are not taxable. It is exempt as per the CBDT circular of 2015. Therefore, only if you sell the shares of CGP, then it is taxable. If CGP declares dividend, then that dividend is not taxable in the hands of the foreign company or the non-resident. I hope it is clear to all of you. Go and check the Vodafone case law. Next one, Vioni INC is providing some technical services to Government of India. Vioni INC is providing some technical services to Government of India, and the Government of India is paying him what? Paying him FTS of 4,54,000 rupees. How much FTS is paid? 4,54,000 rupees. But the services which are given by Vioni INC, those are utilized outside India. Does it matter? It doesn't matter. Still, it is accrued in India. If royalty, FTS or interest is payable by government, listen carefully, if royalty, FTS or interest is paid by government, then it is taxable in the hands of the non-resident, irrespective of where it is utilized. Whether it is utilized in India or whether it is utilized outside India, it doesn't matter. Yes, if the royalty, FTS and interest is paid by resident, then it matters. Then it has to be utilized in India. Otherwise, it won't be taxable. I hope it is clear to all of you. Therefore, in this case, it is taxable. One more important catch over here is, it is received by Vioni. This 4,54,000 is received by Vioni. And what rate royalty is taxable? Royalty is taxable at generally 20% plus 4% says, that is 20.8%. So this amount is after deducting the TDS, because this is received. Therefore, this amount is 79.2%. Therefore, 100% is how much? We are making an assumption that we are not making any assumption. Sorry for that. Okay, I make that mistake again and again. Some people will have doubt. So there is no mention about agreement which is approved by central government. No, agreement which has approved by central government is not applicable to government. Government cannot approve its own agreement. That is only applicable for resident, not applicable for government. Therefore, in this case, this will come under 115A, and if it comes under 115A, this amount is received. Therefore, this will be 79.2%. 100% is how much? Third one, interest is received from unit located in IFSC in respect of money borrowed by MSSO. So, if any non-resident is giving loan to a unit of IFSC on or after 1st September 2019, then that interest is exempt in the hands of the non-resident. Therefore, here Vioni INC is giving loan on or after 1st September 2019 to an unit of IFSC, and unit of IFSC is paying interest to whom? To the non-resident Vioni INC. So, in the hands of Vioni INC, it is exempt under the income tax law. And the next one is nothing but your grandfathering clause. Whenever 31st Jan 2018 will come, 100% is as grandfathering clause. The sale consideration is 89 rupees. What will be the cost of acquisition? The cost of acquisition will be the actual cost, that is 64 rupees. Compare with lower of 89 or 70, whichever is lower, and then compare with the actual cost, whichever is higher. Okay, up to 1,25,000 will be exempt, and after that it will be taxable at 12.5%. Why 12.5%? Because you are selling on 26th of August 2024, which is on or after 23rd July 2024. I hope it is clear to all of you. Now, coming to the third question, which is on charitable trust. There is a charitable trust which is following accrual system registered under 12AB. Let's compute the income of the charitable trust. We need to compute the total income and the tax liability of the charitable trust. Let's start. First of all, gross receipt. How much is the gross receipt? 24,41,000. Start taking in the calculator. Then voluntary contribution, including anonymous donation. Don't take anonymous donation. Anonymous donations are separately taxable. So exclude anonymous donation. So the total donation is 520, out of which anonymous donation is 1,85,000. Therefore, take 3,35,000. Voluntary donations are taxable. Then dividend from Indian company taxable. Income from mutual fund taxable. And last one, agriculture income is not taxable. Now, these four things are taxable in the hands of the trust. Wait, take these four things. Don't take 5,20,000, take only 3,35,000. Now let's talk about anonymous donation. How much is anonymous donation? It is 1,85,000. Now out of 1,85,000, how much anonymous donation is exempt? As per 115 BBC, out of 1,85,000, the exemption will be higher of 1 lakh rupees or 5% of total donation, whichever is higher. So 1 lakh or 5% of 5,20,000, whichever is higher, will come to 1 lakh only. Therefore, out of this, 1 lakh will be exempt and 85,000 will be taxable at how much? At 30%. So 85,000 will be flat taxable at 30%. And remaining with this 1 lakh rupees, listen carefully, this is the catch. This 1 lakh rupees now you will add to the normal income statement. So the four items which you have taken in the calculator, in that you will take this 1 lakh rupees also. So this is how you treat the exempt anonymous donation. The taxable anonymous donation will be taxed at 30%. The exempt anonymous donation will be added to the income statement. Add that to the income statement, and then 85,000 will be added at the end, and it will be taxable at 30%. And this 1 lakh will be treated like a voluntary donation. Add that to the normal income statement. Take the total, then take 15% flat exemption, and then take all the application. First of all, you are applying the money, you are setting aside the money for the next 4 years. So you can accumulate the money for 5 years and you can take the exemption. So you can take the exemption of this 2,54,000 rupees. Second, you are making payment to one of the trustee of 1,47,000. The market value is 2,50,000. So you cannot pay more to trustee, but you can pay less to trustee. You are not paying more to trustee. The market value is 2,50,000. You are paying only 1,47,000. Therefore, this 1,47,000 will also be allowed as deduction. Then during the year, you can make the payment to. You have made the payment to some foreign teachers. Then that can also be claimed as an application, and other expenses that can also be claimed as application. After that, your total income is coming to how much? 8,9,54,850 rupees. Out of that, 85,000 will be taxed at flat 30%, and remaining 869,850 will be taxable at slab rates. Slab rates, trusts are always chargeable at slab rate. I can follow old regime, new regime, whichever I want to follow. But this paper is a very old paper of 2021. So in that time, the new regime was not there, only old regime was there. Therefore, this question I am solving as per old regime. In exam, you can do both of them. Okay. So therefore, the remaining 869, you will apply what? You will apply your slab rates as per old regime. In my question, you can follow new regime also if you want. Okay. I hope it is clear to all of you. Now, coming to the next question, which is a very simple question on DTAA. I am not wasting much time in that. The only thing that I would like to say in this, the assessee is a resident, age is 65 years. Therefore, assessee will be eligible for what? First of all, 80 TTB of 50,000 rupees. Second, assessee is earning some royalty on books. Therefore, assessee will also be eligible for 80 QQB. I hope it is clear to all of you. Let's move on to the next question, that is on TDS. We need to explain whether the TDS will be deducted in the following case or not. First of all, there is a company by the name called as Mexcel Limited, which is engaged in business of manufacturing. Now it is taking some bank guarantee from a bank, and for that it is paying some commission to the bank. So if I am taking some bank guarantee from the bank and if I am paying some commission to the bank, then TDS is not applicable on the commission paid to the bank on bank guarantee as per CBDT circular. Therefore, no TDS if paid to bank as a bank guarantee commission. I hope it is clear to all of you. Now the second question has two views over here. There is a non-resident, Mr. Monty, which is providing some web-based lecture to a study card, a trust registered in India. So the non-resident is outside India and study card is a registered trust in India. So the non-resident is providing some web-based lecture to us and we are paying them 98,000 rupees as a fee for that. Now whether TDS will be deducted or not. So in that we have to take two views over here. If we assume that the web-based lecture which is provided by the non-resident, it is in the nature of FTS, fees for technical service, then TDS will be deducted, because for fees of technical services, there is no need to have a permanent establishment or business connection in India. But if we assume that this is not FTS, it's a normal business income earned by that non-resident Mr. Monty, then there has to be a PA in India to make it taxable. So if there is no PA in India, then it cannot be taxed in India. Therefore, TDS will also not be applicable in that particular case. So everything will depend upon whether the non-resident has a PA in India or it does not have a PA in India. So if it is FTS, then there is no need to have PE, deduct TDS. It is taxable. If it is not FTS, it is normal business income, then it cannot be taxed without a permanent establishment in India. Next one. Mr. Nitin is an individual resident whose last year turnover is 97 lakh. 97 lakh is the last year turnover. And it is making some payment for contract. That is for repair of his office building of 65 lakh rupees. So if I am an individual and if my last year turnover is less than is up to 1 crore rupees, it is less than equal to 1 crore rupees, 194C will not be applicable to me. So if 194C is not applicable, can I apply 194M? Yes, I can apply 194M in this case because 194C is not applicable and the payment is also more than 50 lakh rupees. Therefore, 194M will apply over here. That is 2% TDS will be attracted on the amount of 65 lakh rupees. I hope it is clear to all of you. Next one, if an airline company makes a payment of 10 lakh rupees to Airport Authority of India, the TDS is deducted under which section? So as per this, the TDS is deducted under 194C as per the Supreme Court judgment of Japan Airlines Limited. So if an airline company is making some payment to Airport Authority of India, TDS is deducted under 194C at the rate of 2% or 1% as the case may be. Next one is a transfer pricing question. Vihan Limited is an Indian company and Yuan Limited is a foreign company. Now, Vihan has given a loan of how much? Has given a loan of 6 crore rupees to whom? To Yuan, and the book value of assets of the Yuan is 4 crore rupees. So I am giving you a loan of 6 crore and your book value of asset is 4 crore. It means I am financing you 150% of your book value of assets. Okay. Therefore, we both are deemed to be associate enterprise. We both are what? Deemed to be associate enterprise. Because to become associate enterprise, there is a need of only 51% of the book value of the other company should be financed by me. If I finance 51% of the book value of your company, then we both are deemed to be associate enterprise. Then they have put 2 points over here to confuse us. They are saying that the market value has changed. It doesn't matter. We don't compare market value, we compare book value. Then they say that the entire loan along with interest is paid on 31st of August 2023. It doesn't matter. Whether you pay the loan or whether you don't pay the loan, it doesn't matter. It doesn't matter. It doesn't matter. What matters is your loan should be outstanding at any point of time in the entire year If it is 51%, then we both are deemed to be a source enterprise. If at any point, even if on a single day in the entire year, I am financing you 51% of the total book value of the assets, then we both are deemed to be a source enterprise. Now, so that is the first part of the question. Would Vihan and Yuan be treated as a source enterprise? Yes, 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 definitely yes. Why? Because of the 51%. Now, whether the transfer pricing will apply over here? Yes, transfer pricing will apply. Now, Vihan is selling some units of 7,400 per unit, whereas to others, the same units are sold for 9,000 rupees or 9,500. To unrelated party, it is sold for 9,000 and 9,500. So how many samples we have? We have 2 samples. To a source enterprise, we are selling at 7,400. To outsiders, we are selling at 9,000 and 9,500, which is higher than the amount received from a source enterprise. Therefore, transfer pricing will apply over here. Now, can I follow range concept? No, range concept is followed only if there are at least 6 items. If there are less than 6 items, you have to take arithmetic mean of this. Now, what is arithmetic mean of 9,500 and 9,000? It is 9250. Therefore, this will become your arm's length price. Okay. In this also, you have to check this 9250 and compare this with actual price 7,400. If there is at least a gap of 3%, if there is at least a gap of 3%, transfer pricing will apply in this case, and your arm's length price will be 9250 rupees. Now, how much income will be added? So 9250 will be arm's length price. Your actual price is 7,400. Take a difference of both of them into 20,000 medical equipment. That will come to somewhere around 3.7 crore. That will become your primary adjustment. And what has to be done with that primary adjustment? What has to be done in respect of such transfer price by the income tax authorities? You have to bring back that money in India within 90 days. Within 90 days from where? From the due date of filing of return, or if the department is increasing the amount, then within 90 days from the date on which the AO has passed the order. If you don't bring back that money in India within 90 days, then there will be secondary adjustment. There will be interest on you. Then one more option is there that I can pay one time additional tax of 20.9664, and then the secondary adjustment will be closed after that. So all these options which we have done earlier also, you have to mention all these things over here. I hope it is clear to all of you. Now, question number 5 is a question on case law. Let's see, the first case law over here is the High Court has passed an order. Now in the order, the High Court has made some apparent mistake. The question is, can High Court recall its own order to rectify its apparent mistake? The answer is yes. If the High Court passes an order in which there is an apparent mistake, the High Court has an authority to call the order and rectify its own mistake. This is what it is given in the first question. Second question is based on Ace Builders Limited. That is, if there is a short-term capital in the block of asset, can I save that short-term capital gains by investing in 54EC bonds? Because 54EC says that the asset has to be long-term capital asset. Absolutely correct. The nature of asset is important. The nature of gain is not important. If I purchase a building 10 years back, in a block of asset, the 10 years old building will be called as a long-term asset. The gain will be called as short-term, but the asset is not short-term. The asset is long-term. Therefore, I can take the advantage of 54EC over here. I hope it is clear to all of you. Next one. What is the next point over here? You have to compute the income and the tax payable of what? Of a cooperative society. So we have to compute the income and tax payable of a cooperative society. Let's start over here. Let's start computing the income and the tax payable of cooperative society. A cooperative society is engaged in providing credit facility to its member. So if a cooperative society is engaged in providing credit facility to its member, it is eligible for provisions of ATP. ATP is eligible to the cooperative society. Now, ATP deduction is available under Chapter 6A, profit link deduction. First, interest received from other cooperative society. Yes, it is deductible under ATP. Second, interest received from members. Yes, that is also deductible under ATP. Rent received, no, that is not deductible under ATP, but this rent is taxable, but on that you will get 30% standard deduction, the way everybody gets. Income from agency business, that is also taxable. Income from interest received from deposit idle funds of members, yes, that is also available as a deduction under ATP. Expenses on agency, yes, you can claim that as an expense, and the losses of earlier year, you can claim that also as a deduction. Okay. After that, you will compute the total income, gross total income, and from that you will take 50,000 rupees as a general deduction. We all know that consumer cooperative society gets a deduction of 1 lakh rupees and a normal cooperative society gets a deduction of 50,000 against the PGBP income. So this 50,000 is available against what? It is available against the agency business. Okay, against the agency business you can claim 50,000 deduction in Chapter 6A under ATP. After that you will compute the tax of the trust, okay, or tax of the cooperative society. What is the tax of the cooperative society? It is nothing but slab rate. Up to 10,000 10%, about 10,000 20%, about 20,000 30%, then apply surcharge if applicable and cess. I know that the cooperative society is also eligible for 115 BAD, BAE, but I am not considering all those things over here. If in the exam they ask us to compute as per 115 BAD, BAE, which we have done also in RTP session, go and check that, in which there was ATP, there was ATJJAA also. We have computed as per normal provision, as per AMT also, as per 115 BAD also. We have done all those things in one of the question. You can go and check that question. I hope it is clear to all of you. And one last question in this particular paper is, the AO has initiated a penalty proceeding under 270A. Now, is there any way that I can get escape from this penalty under 270A? Okay. Yes, there is a possibility that you can get escape from this penalty of 270A. You can get escape from the prosecution at 276C. The provisions of 270AA has to be fulfilled. In 270AA, what are you supposed to do? First of all, you have to make an application to the assessing officer within 1 month. Then you have to pay the tax and interest as per the notice of demand within 30 days. And then you should not appeal against this order. Against this order of 147, you should not appeal. Then the AO will what? AO will give you immunity from penalty under 270A. But this immunity is only available for under-reporting cases. It is not available for misreporting cases of 200%. You will not get immunity from all these cases of 200% which are given over here. I hope it is clear to all of you. So let's go ahead with the next paper, that is July 2021. The very first question is on total income. That is, they have asked us to compute total income. Only total income, no tax liability. Ignore MAT, ignore 115 BAA. Okay, let us start with the question. The assessee is a manufacturer of iron and steel. The profit is 1000 lakh. The first adjustment is depreciation as per books of accounts that you will add back. Okay. The second adjustment is, you have paid some 50 lakh rupees to a scientific research association, and this scientific research association, if you make any payment to a scientific research association, that is allowed as a deduction under the income tax law. And related to this point, there is one adjustment which is given in the last line, which is given over here in point number F, that the recognition which was granted to the scientific research association, which was withdrawn later on. So will that impact your deduction? Suppose if I make you a donation of 1 lakh rupees as a scientific research donation, and later on if your donation, if your approval is withdrawn, will that affect my donation? And the answer is no, it will still be allowed to you. Don't worry about it. Okay. Now the next one is the most important adjustment of this particular question. The assessee has taken a loan of 350 lakh rupees on 1st of May 2024 for 8%. Therefore, the total interest of the entire year will come to 350 lakhs into 8% into 11 months. That will come to 25.67 lakhs. Now this loan is taken for the purpose of purchasing a plant and machinery. Now listen carefully. You have paid the interest on 1st of November 2025. Therefore, first of all, let me give you step by step the treatment. 350 lakhs into 8% into 11 divided by 12, that will be 25.67 lakhs. First of all, add back that entirely, entire disallow entirely. Okay. Now out of that, when have you purchased the machinery? You have purchased the machinery. You can come below on the next line, on the next paragraph, that is additions over here. You have purchased the machinery of 500 lakhs and you have put to use from 1st of Feb. So from May till 31st of Jan, the machinery was not put to use. So from May to 31st of Jan, which is 9 months, 9 months interest will be capitalized and 2 months interest can be allowed as a revenue expense. Therefore, first of all, capitalize 9 month interest and claim depreciation on that. What about 2 months interest? 2 months interest will not be allowed as deduction. Why? It cannot be allowed as deduction. It cannot be allowed as a revenue expense because you have not paid up to the due date of filing of return. You can check in adjustment number 3 over here. You are paying this after the due date of filing of return. So therefore, this 2 months interest will be disallowed in your hand, and this 9 months interest will be capitalized to the cost of asset. So to sir, for capitalizing, is it not necessary to pay the interest on time? No. For capitalizing the interest, it is not necessary to pay the interest on time. The 43B is only applicable for revenue expense. It is not applicable for capitalization of the expense. I hope it is clear to all of you. Similarly, next adjustment, you are paying some 100 lakh rupees to foreign technician for installation of the machinery without deduction of TDS. So first of all, disallow that. It cannot be allowed as a PGBP expense. You have to capitalize this 100 lakhs to the cost of the machinery. So you will add back this 100 lakhs to the cost of machinery, claim depreciation and additional depreciation on the same. Again, no TDS is required to be deducted for capitalization. TDS is required to be deducted on revenue expense, not on capitalization of the expense. Next one, you are incurring some general expenses for bringing water in the factory, so that is allowed as a normal business expense. Next, donation, you are giving 10 lakhs to a political party, so that will be disallowed under PGBP, and under 80 GGB you can claim because you are following the normal regime. If you would follow 115 BAA BAB, then it will not be allowed. In 115 BAA BAB, 80 GGB is not allowed. Plus, we are making an assumption that it is allowed only if it is paid other than cash. If it is paid in cash, then it will not be allowed as deduction. Next one, you are purchasing some coal etc. of 25 lakh rupees. Unfortunately, invoice is not available, but you have indirect evidences like indirect evidences of general inward report, that is GIR. You also have the payment evidence. Online payment has been made. You have that evidence also. So is this sufficient to claim deduction? Yes, it is sufficient to claim deduction. There is no need to have invoice. GIR or online payment evidence is sufficient enough to claim the deduction. Next adjustment we have done earlier also. There was a party. There was a party, that is Mrs. A company engineer, to whom we have sold some goods of 20 lakh rupees. See on the board. So we have sold some goods of 20 lakh rupees. Then out of that 10 lakh has become bad debt. So how much is recoverable now? Now the debtor is only 10 lakh. Now the assessee is dead. It means the debtor is dead. Now the debtor has died due to his demise. We could only collect 7 lakh rupees. So after how much we were supposed to collect? The outstanding amount was 10 lakh. But how much we have collected? Only 7 lakh. Now unfortunately we have credited that 7 lakh to the statement of P&L account, which is absolutely correct. Why the hell you have to credit that to P&L account once again? Is that 10 lakh not included in this 20 lakh? Definitely it is included in this 20 lakh. Now you want to again credit that to 7 lakh to the P&L account. Why do you want to do that? That is wrong. So first of all, reduce this 7 lakh from the P&L. Otherwise it will lead to double taxation. Now how much you are supposed to recover after the demise? 10 lakh rupees. But how much you have recovered? Only 7 lakh. So 3 lakh rupees have now become bad debt. So reduce that 3 lakh also. So and write off this debt 10 lakh rupees. Okay. I hope it is clear to all of you. Last but not least, there are some opening WDV of the assets on 1/4/2024. We have to claim depreciation on that. On factory building, you will claim 10%. On computer, 40%. On office appliance, 15%. Tractor, be very careful. Tractor, it is 15%, but this tractor is not normal tractor. It is used within the factory. It is like a forklift truck, and therefore if it is purchased in the current year, then you can also claim additional depreciation on the same. I am not talking about additional depreciation on the opening WDV, but if it is purchased in the current year, you can claim additional depreciation also on the same, because it's not a motor vehicle, it's a forklift truck which is used within the factory. Next, plant and machinery, 15%. Then some additions are made. Factory building, put to use from 1st November, therefore claim 50%, that is 5% of 5%, not 10%. Computer, put to use from 1st of May, 40%. Now tractor, put to use on 1st of August. So claim 15% normal depreciation, additional depreciation 20%. Another tractor, put to use on what? On 1st of Feb. Claim 7.5% normal depreciation and additional depreciation of 10%. Okay. I hope it is clear to all of you. And last but not least, plant and machinery of 500 lakhs, on which you will capitalize foreign technician salary for installation of machinery, 100 lakhs and 21 lakh rupees, the interest capitalization, total 621 lakhs. Machinery is put to use from 1st of Feb, therefore only 50% depreciation will be allowed, and additional depreciation will also be only 50%, 7.5% and 10%, as the case may be. Last but not least, you have incurred some expenses on obtaining ISO 9000 certificate, and you have shown that as an asset. So expense incurred for ISO 9001 certificate is considered to be a revenue expense. It is not considered to be a capital expenditure. This is what this question is all about. I hope it is clear to all of you. Let's go on to the next question. Question number 2 has 2 parts. The first part is talking about 3 different issues. There are 3 issues covered in this particular part. There is a partnership firm by the name called as AN Company. The return was filed by the assessee and the case was selected for the scrutiny. And now the AO has raised 3 questions over here. Question number 1. Can you get the deduction of bad debts if you cannot prove the bad debts? So if you cannot prove the bad debts, can you still claim the deduction of bad debt? The answer is yes. It is not necessary to establish the fact that the debt has become bad. It is not necessary to prove that the debt has become bad. The only condition to claim bad debts under section 36 of section 1 clause 7 is you have to write off that in the books of accounts. If you write off that in the books of accounts, you can claim the deduction as bad debts. So this is the first issue which is covered over here. The second issue is you have incurred some repairs and maintenance which are booked on estimated basis. Can you claim the repairs and maintenance on estimated basis? See, the repairs and maintenance of plant, machinery and furniture is given under section 31, and it says that if it is a current repair, then it is allowed. If it is not a current repair, then it is not allowed. So it all depends upon whether you are able to prove that whether it is current repair or not. If you are able to prove to the AO that it is current repair, it is allowed. If you are not able to prove to the AO that it is current repair, then it won't be allowed to you as a deduction. Then the third issue is the most important issue of this particular question, that is, can a partnership firm become a partner in a partnership firm? For example, there is a partnership firm and in which there are a lot of partners. Can a partnership firm become a partner in the partnership firm? On this issue, the Supreme Court of India has held that the partnership firm cannot become a partner in the partnership firm. Why? Because a partnership firm is not considered to be a legal partner. Partnership firm is not considered to be a legal entity in India and across the world. What is partnership firm? Yeah, there is a partnership firm and there are partners. Is there management and ownership different from each other? No. The partners itself are controlling the entire firm. The firm is controlled by the partners only. There is no legal entity, separate entity between partnership firm and partners. Therefore, partnership firm is not considered to be a legal entity, a legal person, and someone who is not considered to be a legal person cannot become a partner in a partnership firm. Yes, a company can become a partner in a partnership firm because company is a legal entity, but a partnership firm cannot become a partner in another firm. Therefore, the AO has treated the partnership firm as what? As AOP, and all the provisions of AOP has applied on the assessee rather than the partnership firm. I hope it is clear to all of you. Let's move to the next question. It's a beautiful question on DTAA. Let me read the question first of all and give you a brief idea about what exactly is happening in this question. There is a person, Mr. Ram, who is a citizen of USA. He is residing in USA since 2008. He is a non-resident since 2008-9 assessment year. Now he works for a US company, XINC. Now he came to India in the last year on 10th of Jan 2024 to visit his aged parents. Now he could return back to USA only by 31st of Jan 2025. So he stayed back in India for almost a year. Okay. Now till the time he was in India, he was doing work from home in India because he is working in a US company. So when he came to India to visit his aged parents, he took a permission from the company to work from home in India. Okay. Now first thing we need to understand, what is the residential status of this person. To understand the residential status of this person, we need to understand for how many days he is residing in India. He is residing in India for 306 days. How? From 1st April 2024 to 31st of Jan 2025. He is staying in India. Therefore, he is staying in India for 306 days. Therefore, he is a resident in India. Is he an ordinary resident or not ordinary? Not ordinary. Obviously not ordinary, because in the last 10 years, he was not staying in India. In the last 7 years, his 730 days stay is not possible, because he came in India after 15-20 years on what? On 10th of Jan 2024. Therefore, 730 days, all those criteria cannot be fulfilled. Therefore, he is resident and not ordinary resident. Now, please tell me, all of you, what is the residential? What is the criteria for taxability for resident and not ordinary resident? A resident and not ordinary resident will be liable for two incomes in India. One, if an income is accrued in India, or if an income is received in India, and one more income, if a business income is accrued outside India but it is controlled from India, then that income is also taxable in the hands of R and NOR. So therefore, the very first income which will be taxable in India will be his salary income for 10 months from April 24 to Jan 25, when he was staying in India, when he was doing work from home in India. At that time, he was rendering the services in India. Therefore, that salary is accrued in India. Now, how much salary is earning every month? In every month, he is earning $6,250. These are all figure in dollars. I have to convert that into rupees. How to convert a foreign income into Indian income? You have to convert a foreign income into Indian income as per Rule 115. Sir, one more thing I would like to ask, sir. Will he not get an exemption under Section 10(6), sir? If a foreign enterprise send a foreign citizen for some work in India, then the remuneration given to that employee is exempt. Yes, it is exempt, but only if the foreign employees come to India up to 90 days. Now, this person, Mr. Ram, is not coming to India for 90 days. He is coming for 10 months. Therefore, his income will not be exempt under Section 10(6). Otherwise, if he would have come for 90 days, his salary would have been exempted in India. But in this case, the salary would not be exempt. I hope it is clear to all of you. Now, coming back to discussion, how to convert this dollar into rupees. You have to apply Rule 115. What is Rule 115? Rule 115 says that the salary income has to be converted as per TTBR of the last day of the preceding month. So therefore, if you see the TTBR, everywhere it is 72 only. Therefore, it is good for us. If it would have been different every month, then we need to make multiple calculation. Now, because it is 72 for the entire year, it is same only for the entire year, we don't have to do multiple calculation. Do one single calculation. $6250 into how many months? Into 10 months. Into what? Into 72. That will be your gross salary. From that, you claim 75,000 standard deduction, because the assessee is following new regime as per 115 BAC subsection 1A. Therefore, 75,000 standard deduction you can claim, and that will be your net salary. Okay. Now, apart from that, he is also earning some interest from a fixed deposit in USA. Will that be taxable in India? That will not be taxable in India, because for NOR, if an income is accrued outside India and if it is received outside India, then it is not taxable. This interest is accrued outside India. It is received outside India. Therefore, this interest will not be taxable. Therefore, the only income which will be taxable is salary income. That is 44,25,000. On that, you will apply the tax rates, new tax rates as per 115 BAC. That is a new regime, and the tax will come to 10,58,200. Now, from this tax, this is an Indian tax. From this tax, he will get some DTAA relief. How much DTAA relief he is going to get? As per Article 2 of DTAA, between India and USA, the taxes covered for credit are federal income tax paid by Internal Revenue Code. Internal Revenue Code is the law of the United States, but excluding Social Security tax. So you are going to get credit only on what? Only on the federal tax. You are not going to get credit on Social Security tax. You are not going to get credit on state tax. Now, how much credit will be available? Credit will be the tax paid in foreign country or tax paid in India, whichever is lower. Okay. Now, there are two assumptions taken by ICI over here. First assumption they have taken over here is that federal tax does not include Social Security tax. It means this 1600 does not include this 420. The second assumption taken by ICI, the federal tax includes this 420. If this includes 420, then we have to reduce 420 from everywhere. Okay. So according to both the assumptions, we need to solve this question. What is the first assumption? Federal tax does not include social security tax. If federal tax does not include social security tax, it means you will get the credit of entire 1600. Now every month you are paying $1600 as tax. How to convert that into rupees? Now you have to apply rule 128. Remember, to convert FTC foreign tax credit, you need to apply 128, and to convert foreign income, you have to apply rule 115. This rule also says the same thing. You have to take the TTBR of the last day of the preceding month. What is the TTBR of the last day of the preceding month? It is 72. Therefore, 1600 into 72 into 10 months. That will be the amount of tax which will be allowed as credit. Compare with Indian tax, whichever is lower. Whichever is lower will be allowed as deduction. And in this case, Indian tax is coming lower. Therefore, this will be allowed as credit, and therefore your tax liability in this case will be 0 rupees. And if your tax liability is 0, and if you are filing a late return in this case, you are filing the return on 21st of August, you should file the return by 31st of July. Even though you are filing a late return, you will not be liable for any interest over here under 234A, because your tax liability is nil. Now the second assumption is if the federal tax includes social security tax. If the federal tax includes social security tax, then from 1600 you have to reduce 420. Then 1600 minus 420, whatever answer will come, multiplied by 10 into 72, that will be your amount of tax. Now this is the foreign tax. What is the Indian tax? Indian tax is 1058. Therefore you will get a credit of how much? 849,600. The balance you have to pay out of your pocket, and if you have to pay out of your pocket, you also have to pay the interest at the rate of 1%, because now there is some payable which is coming, and if you are filing a late return, then you have to pay the interest on that 1% interest for the month of August, because you are dealing by 1 month. I hope it is clear to all of you. Last but not least, if you want the FTC, that is the tax which is paid in the foreign country, you have to fill a form. Some form number 67 etc. is there by the end of the relevant assessment year, stating the statement of income, what is the income earned in the foreign country, and what is the nature of that income, amount of tax deducted and paid in the foreign country. All those details have to be given to the Government of India by 31st of March 2026. I hope it is clear to all of you. Let's move on to the next question. That is question number 3, which is on investment fund. Now there is an investment fund which is AIF, in which there are 20 resident unit holders. All of them are holding 5 units each. So if there are 20 unit holders, all of them are holding 5 units each, it means the total units are 100. 100 is the total number of units which is issued by the fund. Now out of which out of 20 unit holders, 16 unit holders are holding units for more than 12 months, and 4 unit holders are holding units for less than 12 months. It means 80% of the unit holders are holding units for more than 12 months, because out of 20, if 16 unit holders are holding units for more than 12 months, it means 80% of the unit holders are holding units for more than 12 months, and 20% of the unit holders are holding units for less than 12 months. Okay, so this is the breakup which I have done over here. Now pay attention please, all of you. The very first point, business income. Who will pay tax on business income? On business income, the AIF will pay tax, the fund will pay tax, and for investor it is exempt. Long-term capital loss. Who will set off long-term capital loss? First, fund will set off the loss. If the fund does not have a long-term capital gains, then the fund will transfer that loss to the investor, but only to those investors who hold the units for more than 12 months. The losses cannot be given, the capital loss cannot be given to the investors if it is for less than 12 months. So how many unit holders are holding the units for more than 12 months? 80% of the unit holders are holding the units for more than 12 months. So therefore, out of this 30 lakh rupees, 80% will be passed on to the unit holders. That is to those 80% unit holders who are holding the units for more than 12 months. Therefore, out of 30 lakh, 24 lakhs will be passed on to the investor. Third, other source, the fund will not pay tax, the investor will pay tax on the other source. Last line they are asking, will your answer change? What will be your implication if the fund distribute only 80% of its income to the unit holder? It doesn't matter. In AIF, there is a concept of deemed credit. It means if an AIF earns 100 rupees and if an AIF distributes 100 rupees, then also 100 rupees is taxable. And if an AIF fund earns 100 rupees and distribute only 80 rupees, then also entire 100 rupees is taxable in the hands of unit holders. So there is a concept of deemed credit over here. So the answer will not change. Last question over here is in this particular paper is on TDS. So there is an infrastructure debt fund which is making some payment of interest to a foreign company, a non-resident. So if an infrastructure debt fund is making some payment to the foreign company, a non-resident, then the infrastructure debt fund will deduct TDS under section 194 ILB at the rate of 5% plus 4% cess, and the deduction of expenses will not be allowed to the non-resident. It is grossly taxable. Entire 4.5 lakhs will be taxable at 5.2%, including the cess. If the other person is located in an NJA, it is located in notified jurisdiction area, then in that case the infrastructure debt fund has to deduct TDS at 31.2%, 30% tax plus 4% cess as per section 94A. There is a stricter TDS provision for people who are staying in NJA. I hope it is clear to all of you. Next question. On 17th of June 2024, a commission of 40,000 is retained by consignee. If a consignee retains a commission, whether a TDS under 194H which is for commission, is applicable for retention of commission also? The answer is yes. TDS under 194H is also applicable for retention of commission. Therefore, if the consignee is retaining the commission, on that also TDS will be applicable under 194H. The TDS over here will be 5%. Up to 30th September, the TDS rate is 5%. After 30th September, from 1st October, the amendment has come that it will become 2%. But this is before 30th September, so we are taking 5%. Plus the threshold is also crossing. The threshold under 194H is 15,000. You are making a payment of 40,000. Therefore, TDS of 5% is applicable. Next, an employee is there who joined in 2021 and resigned in 2025. So in 4 years, he resigned from the company and he has withdrawn 80,000 from his employee provident fund account and he has given PAN to the company. So if an employee joins a company and if he retires, if he leaves the company within 5 years, then if he withdraws the PF, then that PF is taxable in his hand. If he withdraws after 5 years, then it is not taxable. But if he withdraws within 5 years, then it is taxable. And if it is taxable, the company will deduct TDS under 194A. If it is taxable only, then the company will deduct TDS under 194A. That too, if the amount paid is more than or equal to 50,000 rupees. So in this case, the employee is retiring within 5 years. The amount paid is more than equal to 50,000 rupees. Then therefore the company will deduct TDS at the rate of 10%. Next one, if I am purchasing a flat for 48 lakh rupees, on that I am paying some 22 lakh rupees for car parking and 1 lakh rupees for club membership fees. For determining whether TDS is applicable or not, should I aggregate everything and check whether 50 lakh is crossing or not, or I should only check 48 lakhs? The answer is you should aggregate everything. You should aggregate the consideration. The consideration will include car parking fee also, membership fee also, other charges also in relation to transfer of property. If everything total is crossing 50 lakh or more, you have to deduct TDS at the rate of 1%. So this is what this question is all about. So let's move on to the next paper now, December 2021. First of all, you will ask me what kind of attempt is this, sir? Jan 21, July 21, December 21. So in the year 2021, there was COVID. Because of that, the ICAI used to conduct exams randomly whenever there was no COVID. Because in May 2021, there was a COVID. Therefore, they have not conducted in May. Instead of that, they have conducted in July and they have conducted in December 21. So that is the reason you will find out such kind of attempts over here. Now, let's come to the question number one. Question number one over here is about total income. We need to compute total income and tax payable, and we need to compute total income and tax payable as per what? As per 115 BAB. Okay. So according to that, you need to answer this particular paper. Assessee is a manufacturer engaged in leather manufacturing. Remember, if an assessee is engaged in leather manufacturing, if an assessee is engaged in footwear manufacturing or apparel manufacturing, then in 80 JJAA, you have to employ the employees only for 150 days instead of 240 days. Generally, if you want 80 JJAA deduction, you have to employ for 240 days. But in these three cases, in these three business, only 150 days is sufficient. So let's start with the first adjustment. The net profit is 1 crore 20 lakhs. The opening stock is overvalued by 10%. So if the opening stock is overvalued by 10%, therefore 55 lakhs is 110%. Therefore 10% is how much? Cross multiply and add back that much amount. Okay. Similarly, closing stock is overvalued. It is undervalued by 10%. So if closing stock is 54 lakhs, it is undervalued by 10%. It means closing stock is 90%. Therefore, do backward calculation, find out that 10% amount and again add back. If the opening stock is what? If the opening stock is overvalued, it means you have claimed more deduction. So add back. If the closing stock is undervalued, you are showing less income. Again add back. So in both the case, you have to add back only. I hope it is clear to all of you. Now next adjustment, you are paying 10 lakh rupees to a foreign person, non-resident, to a non-resident person, Mr. John, a citizen of USA. You are not deducting his TDS. What he has done for you, he has procured order for you outside India. So if a non-resident is procuring order outside India for me, that his income is not accrued in India. And if his income is not accrued in India, the question of deducting TDS does not arise. Therefore, if I have not deducted the TDS, I am absolutely fine. I am not doing anything wrong. Therefore, this expenditure should be allowed to me even without deduction of TDS. I hope it is clear to all of you. Next, you are paying your employee Raj 45,000 rupees in cash. Can you pay your employee 45,000 rupees in cash? The answer is no. Generally, you cannot pay more than 10,000 rupees to a person in a day in cash. But if you are paying for retirement benefit, then it is allowed. As per Rule 6DD, for retirement benefit, you can pay to the employees up to 50,000 in cash. Up to 50,000 for VRS, for pension, for gratuity, etc. You can pay up to 50,000 rupees in cash. The limit has been enhanced from 10,000 to 50,000 for retirement benefits. Next one is the grandfathering clause. Whenever 31st Jan 2018 will come, always remember it's a grandfathering clause. I have spoken about grandfathering clause already in so many adjustments, so I'm not speaking much about this. I don't want to do repetition of the same concept again and again. Next one, you are deriving some STCG from a capital asset which is non-depreciable. Let's assume that that it is land. So non-depreciable capital asset, that is, suppose let's say it is land. So STCG you will remove from PGBP, and then you will show under capital gains this 75,000, and this will be subject to how much tax? This will be subject to 22% tax under 115 BAB, because normal STCG, see, 111 STCG will be subject to 15 or 20% tax, but other than 111 STCG will be subject to normal rates, and the normal rate under 115 BAB is how much? It is 22%. Therefore, this will be subject to 22%. If it would have been a part of block of asset, then it would have been taxed at 15%. But this is not a part of block of asset, therefore 15% will not be applicable over here. Okay. Next one is you are earning some profit on sale of land. Same adjustment again and again. 100% holding subsidiary, selling some assets. The recipient is Indian company. Then it is exempt under the income tax law. So reduce from here and show under capital gains as exempt under section 47. I hope it is clear to you. Now next adjustment. Adjustment number 7. You are receiving some dividend of 50,000 rupees from a domestic company. So first of all, you will reduce the dividend from here from PGBP and you will show under IFRS. But when you show under IFRS, you have to gross up. Why, sir? Why gross up? Because this is received. This is not the dividend income. 50,000 is received by you. Therefore, the company, domestic company who is paying you the dividend would have deducted TDS at the rate of 10% under section 194. Therefore, this 50,000 is 90% of the actual amount. Therefore, actual amount is how much? 55,555. So you have to show 55,555 as your income. Okay. I hope it is clear to all of you. Then you are paying 20,000 for inauguration of a new branch. So that is allowed as a revenue expense. There is nothing wrong in that. Then you are paying some penalty to the government for failure to complete the project on time. So there is some delay in your project of 4 months, so you have to pay 5,000 rupees per month as a penalty, and total 20,000 rupees has to be paid. So that is also allowed as penalty, as allowed as deduction, because this is compensatory in nature. Which penalty is not allowed? Penal penalties are not allowed, but this is not penal in nature. This is compensatory in nature. Therefore, this will be allowed as deduction. Okay. Next, VRS is allowed as deduction, but it is not fully allowed. You have debited the full VRS to the P&L account, but only 4/5, only 1/5 will be allowed in the current year. Only 1 lakh will be allowed in the current year. Therefore, 4/5 you have to disallow. 4 lakh you have to add back. I hope it is clear to all of you. Next one is a very beautiful adjustment. There is a non-resident. There is a non-resident who has given you some deposit, and you are using that deposit for what? For manufacturing in India. So if a non-resident is giving you some money in the form of loan or deposit, and you are using that money in India for the manufacturing in India, for the business in India, then the income of the non-resident is deemed to accrue or rise in India as per section 915. And if the income of the non-resident, then the interest of the non-resident is deemed to accrue or rise in India, you have to deduct TDS. And if you have not deducted the TDS, then this interest of 75,000 will be disallowed in your hands. Okay. I hope it is clear to all of you. Now I will discuss point number 2 first, and then I will come to point number 1. You are paying 1,20,000 for National Fund for Rural Development. That is allowed under 115 BAB. Don't worry. 35 CCA deduction is there, which is allowed under 115 BAB also. And last but not least, you are having some additional employees. You are hiring some additional employees over here, on which you are going to get what? 115 BAB deduction. So sorry, on which you are going to get 80 JJAA deduction. First of all, you are hiring 39 employees on 1st of June 2024, and the emolument is 15,000 per month. All of them participate in the recognized provident fund. But out of that 39 employees, 9 employees are being settled by bearer check. So therefore, the employees to whom you are paying by bearer check, those will not be covered under 80 JJAA. To claim deduction under 80 JJAA, you have to make the payment by 4 modes, not bearer check, not cross check, not cash. Therefore, only 30 employees will be eligible out of 39. So 30 employees deduction will be computed how? 30 into 15,000 per month into 10 months from June to March into 30%. Okay. Now, apart from that, 14 more employees have been hired on 1st of July, but their emolument is 45,700. So they will not be eligible because the emolument is more than 25,000. Then 3 more employees have been joined. This is very important point. 3 employees have been joined on 1st of November, whose emolument is 22,000. They will also be eligible. Why, sir? From 1st of November, if you compute till 31st of March, it amounts to somewhere around 151 days. So in case of leather manufacturing business, because the associate is engaged in leather manufacturing business, in case of leather manufacturing business, even 150 days is sufficient. Therefore, this associate, this 3 employees will also be eligible for 80 JJAA. So 3 employees into 5 months, from November to March, it is 5 months into 22,000 into 30%. Now, last but not least, the most important point, the 9 employees to whom you are paying the salary by what? You are paying the salary by bearer check. So for them, you also have to make a disallowance under 48(3) under PGBP, because under PGBP also, if you make a payment to an employee for more than 10,000 rupees in a day in cash or in bearer check, then that is also not allowed. For these 9 employees, you have to do a PGBP disallowance also. I hope it is clear to all of you. After that, you will compute the tax for 112A. For 112A, it is 12.5% tax after 23rd July, subject to 1.25 lakh exemption. And for 75,000 for non-depreciable assets, short-term capital gains, 22%. For dividend also 22%, and for your business income it is 15% under 115 BAB. Then you will apply 10% surcharge, 4% cess, and then you will reduce your dividend income, TDS on dividend, because the question is not asking TDS liability, the question is asking TDS payable, tax payable. Therefore, whenever they will ask you tax payable, you have to reduce TDS, you have to reduce advance tax, you have to reduce TCS from here. I hope it is clear to all of you. So this is what this question is all about. So let's go ahead with the next question. Question number 2. There are multiple parts. There are 3 parts in this question. First part is there is CA Impex Limited, which is an amalgamating company, and Delhi Impex Limited, which is an amalgamated company. Now the profit of amalgamated company is 175 lakhs before setting of the losses, but after taking the depreciation of 15% on 160 lakhs. We need to compute the income of Delhi Impex Limited. So what is the total income of Delhi Impex Limited? First of all, the profit of the Delhi Impex Limited is 175 lakhs. I will write down over here. Now, is the amalgamated company allowed to carry forward the losses of amalgamating company? Yes, certain losses are allowed. Speculative losses are not allowed. Normal business loss is allowed. Unabsorbed depreciation is also allowed. Unabsorbed carry forward of scientific research losses are also allowed. Unabsorbed carry forward of family planning losses are allowed. So, but speculative loss is not allowed. Therefore, first is speculative losses of 5 lakh. Will this be allowed against the income of the amalgamated company? These are the losses of amalgamating company. I want to carry forward to the amalgamated company. This will not be allowed as deduction. Unabsorbed depreciation, yes. Unabsorbed capital expenditure of scientific research, yes, that is also allowed. And business loss is also allowed. So, I am reducing these 3 first of all. Okay. I hope it is clear to all of you. Now, the company has done one mistake while computing the depreciation. While computing the depreciation, the company has taken 15% depreciation on what? On 160 lakhs, which is the purchase price of the plant and machinery by Delhi Impact. Now remember, in case of amalgamation, if I am purchasing some machinery on amalgamation from you, I cannot claim depreciation on purchase price. I will my actual cost will be the WDV in the hands of the amalgamating company. Therefore, 160 lakhs, this is the purchase price. I cannot claim depreciation on 160 lakhs. What is 15% of 160 lakhs? 15% of 160 lakhs is 24 lakhs. So this 24 lakhs will not be allowed. So I am adding back. And what is the WDV in the hands of the amalgamating company? The WDV in the hands of the amalgamating company was 100 lakhs. So I will get deduction on 100 lakh rupees. On 100 lakhs, 15% is going to be 15 lakhs. Therefore, my ultimate answer will come to 39 lakhs. So I will add back the wrong depreciation taken, 24 lakhs, and I will reduce the correct depreciation, that is 15 lakh rupees, which is on the WDV of the block of asset. Okay. I hope it is clear to all of you. Next one is a very simple question on what? On compulsory acquisition. The government has compulsorily acquired my land in October 2024, and they have paid me in Jan 2024 20 lakh rupees. Now, what is the cost of acquisition of the land? It was purchased in 2003. Then I filed a compensation for additional compensation. I got 18 lakh rupees, and then the expenses on transfer is 30 lakh rupees, and the enhanced compensation which I received later on is 1 lakh rupees. Now let's see. The expense on enhanced compensation is 1 lakh rupees. Now let's do the computation. The capital gains has arisen on after 23rd July. Therefore, indexation benefit will not be available. First of all, I am computing the capital gains of the original capital gains and then enhanced capital gains. The original capital gains full value of consideration is 20 lakh rupees. Minus expenses on transfer is 30,000. 1970 will be my net consideration. 12 lakh is my cost of acquisition. The asset is long term. 7 lakh 70 will be my long term capital gains. Sir, will I not get indexation? See, you have both the options. But in the question, they have not asked us to compute tax rates. If they ask us to compute tax rates, I will go for both the options. Sir, which both the options? See, let's assume that he is a resident. Now he has purchased immobile property before 23rd July and he is selling the immobile property after 23rd July. So now he has both the option. He can take this capital gains with 12.5% tax, or he can take indexation with 20% tax. Both the options are available. But in this question, they have not asked us to compute tax. That is the reason we are not doing that. They have only asked us to compute capital gains, and the capital gains is definitely 7,70,000. Now, later on, when I filed case for enhanced compensation, I got 18 lakh rupees. So enhanced compensation will be chargeable in the year in which enhanced compensation is received. Minus, I have incurred 1 lakh rupees to earn that enhanced compensation. So that much amount will be reduced from my enhanced compensation. Therefore, answer will come to 17 lakh rupees. I hope it is clear to all of you. Is it clear? Let's move on to the next question. The next question is a beautiful question on transfer pricing. There is a foreign company, Alpha Inc., and there is an Indian company, Alpha Limited. Now, Alpha Inc. has given a loan to Alpha Limited of how much? Of $1,50,000. So Alpha Inc. has given a loan to Alpha Limited of $1,50,000. Now, if I convert that into rupees, $1,50,000 into what is the dollar rate? Over here in this question, it is 55. It comes to 82.5 lakh. So in rupee, Alpha Inc. has given me how much loan? 82.5 lakh. And what is my book value of asset? My book value of asset is 120 lakh. Therefore, out of 120 lakh book value of asset, 82.5 is financed by Alpha Inc., which amounts to 68.75%. Therefore, both of us are deemed to be associate enterprise. If one enterprise finances 51% of the book value of the asset of another enterprise, then both of them are deemed to be associate enterprise. By that logic, we both are associate enterprise. Now coming back to India, Alpha Limited, Singapore, Alpha Inc. Now we are providing them some software backup support services. So we are exporting them services. Now we need to find out the arm's length price as per the transactional net margin method. Now in transactional net margin method, we need to find out the margin. First, we need to find out the margin with associate enterprise. Then we need to find out the margin with third party, that is uncontrolled price. And then you have to apply that margin on your cost. And then you need to find out what your arm's length price. Now I am providing export. I am doing export. So my objective is sales. Sales is my objective. My objective is not purchase. I am doing export. Okay. So how will I compute the net margin as per with associate enterprise? In that case, you have to follow the rule of net profit upon operating cost. Remember, I have told you in class, when you do export, take denominator as cost. When you do import, take denominator as sales. You have to be very careful, otherwise your entire answers will go wrong. When you do export, I'm again saying you take denominator as cost. When you do import, you take denominator as sales. In this case, I'm doing export, so therefore I'm taking the numerator as profit, denominator as cost. Now, what is the profit in case of associate enterprise? The services are given for 85 rupees and the cost is 80 rupees. Therefore, the profit is 5 rupees, cost is 80 rupees. I'm taking denominator as cost because I'm doing export. Therefore, 6.25% is the arm's length, is the margin with respect to associate enterprise. What is the margin with respect to third party? The margin with respect to third party is as follows. Pay attention, please. The total cost with respect to uncontrolled transaction, it is 500 plus 100. This is my total cost, so I will take in the denominator total cost. And what is the operating profit? It is 100. Therefore, this is 16.67%. Now it's very simple. You have to apply this 16.67% on the cost with respect to your alpha INC, and then you will get the arm's length price, and then compare that arm's length price with what? With your actual price, and then you try to identify how much will be added back to your income statement. I hope it is clear to all of you. Let's move on to the next question. Question number 3A, which is a question on charitable trust exit tax, accredited income. Now, what has happened in this question? A trust was formed in 2006 and it was registered in 2011. Now, remember, it was formed in 2006 and registered in 2011. So, whatever assets and liabilities which are purchased between 2006 to 2011 will not be part of what? Accredited income. Do you remember that? All assets and liabilities which are purchased or incurred before registration shall not be part of accredited income. Now, the trust got resolved on 29th of December 2024. So, now we need to compute the accredited income of the trust. What is accredited income? As per rule 17 CB, it is aggregate of all assets minus aggregate of all liabilities. Now let's see what is the first asset. The first asset over here is land and building of 12 lakh rupees. To purchase this land and building, you have taken a loan from bank of 9 lakh rupees. It means 3/4 of the land is financed through a loan. Okay, 3/4 out of 12 lakh, if 9 lakh is financed through loan, it means 75% of the land is financed through loan. Okay, now, and it is also written in point number 4 in the adjustment, land is acquired out of agriculture income. Therefore, out of agriculture income, 1/4 is acquired, because 3/4 is acquired through what? Through loan. Therefore, 1/4 is acquired through agriculture income. Now, the law says that whatever asset is acquired out of agriculture income, they should also not form part of accredited income. So, whatever portion of land which is acquired out of agriculture income, how much portion? 1/4 portion of the land is acquired out of agriculture income. That should also not be part of what? Accredited income. Now, how to value the land as per rule 17 CB? It is stamp duty value or market value, whichever is higher. Now, in this question, we don't have stamp duty value. We only have market value. Therefore, market value is 50 lakh rupees. But out of this, 1/4 is acquired through agriculture income and 3/4 is acquired through loan. Therefore, only 3/4 of the land should be taken over here. That is 37.5 lakh should be taken. That is the portion from which the portion of the land which is acquired from the loan, and not the portion of the land which is acquired out of agriculture income. I hope it is clear to all of you. Beautiful, beautiful discussion. This is the place where most of the students always ask me out. Next one is for equity shares, you will take the market value. For quoted equity shares, you will take the market value. The market value is 18 lakhs over here. You can check over here. It is 18 lakhs. So take that. Now for cash, you will take the book value. For bank balance, you will take the book value. For liabilities, you will take the book value. You will take this 9 lakh rupees in the liability. This 1 lakh rupees you will not take in the liability, because this is also taken before the registration. So whatever assets and liabilities which are incurred before registration, that shall not form part of what? Accredited income. I hope it is clear to all of you. Now, one last thing is the most important thing. Investment in equity shares, unquoted shares. For unquoted shares, you need to value the unquoted share company. You need to value Z Limited. How to value Z Limited? Take all the assets of Z Limited. 60 lakhs plus 30 lakhs, 90 lakhs is the total assets of the Z Limited. Reduce the liability of Z Limited. 35 lakhs is the liability of Z Limited. Therefore, the net asset of the Z Limited is 55 lakhs. Out of which, this is the total value of Z Limited. Out of which, how much we acquired in that? We acquired 15% of that. So how did you get 15%? See, total 1,50,000 we have invested in Z Limited, and the equity capital of Z Limited is 1 lakh equity shares into 10, that is 10 lakh. So out of 10 lakh, 1,50,000 is acquired by us. Therefore, we hold 15% of that. So whatever is the amount, that will be our stake. But from that also, while computing the accredited income, you will take only 50% of the total assets. Why, sir? Because 50% of the unquoted shares were acquired in 2007-8 when the trust was not registered. Therefore, out of the total value of unquoted shares, only 50% will be taken over here. Last but not least, for dissolution, there is a special benefit that if the trust is dissolved and if the assets are distributed to another trust within 12 months from the date of dissolution, then that much amount should be reduced what? From your accredited income. So the trust is dissolved, and within 12 months, within the specified time, the trust is distributing 8 lakh rupees assets to another trust. Therefore, that much will be reduced from the cost of asset, from the accredited income, and the balance will be chargeable at 34.944%. Now, the next question is a very simple question on DTAA. Very, very, very basic question. We have done so many questions like that earlier also. I'm not wasting my time to discuss such kind of silly questions over here. Okay. Let's move on to the next question. Next question is on TDS and TCS. There is one person by the name called as Mr. Z who is a resident. He is a seller. Now he's selling some unique t-shirts etc. through an e-commerce operator abc.com. Therefore abc.com e-commerce operator has to deduct TDS under section 194O at the rate of 0.1% from 1st October 2024. Before that it was 1%. Now the abc.com, that is the e-commerce operator, will deduct TDS always on the entire amount, gross amount. That is not after commission, deduction of commission, that is before the commission, and the TDS will be deducted on credit or payment, whichever is earlier. So total 60 lakhs of goods are sold through abc.com. First 20 lakh is sold on 31st December. So on that 0.1% TDS will be deducted on the gross amount. Then 15 lakh 0.1%, then 10 lakh rupees is directly paid by the customer to what? To the seller. Customer did not pay to abc.com, the customer directly paid to what? To the seller. So in that case it is said that if the customer directly paid to the seller, then in that case this is deemed to be credited by the e-commerce operator, and therefore the TDS will be deducted on this 10 lakh rupees also, and the balance amount TDS will be deducted on 31st March because the balance amount was released on 31st of March, on which TDS will be deducted on 31st of March. I hope it is clear to all of you. Now, next one is also a very good question on TCS now. Raghav Motors is a dealer in car, Ford cars and Maruti cars. The last year turnover of Raghav Motors is 9.8 crore from sale of cars, and from sale of spare parts and service station it is 60 lakhs. Therefore, the total turnover of the Raghav Limited last year is 10.4 crore, which is more than 10 crore. Now remember, whenever you sell a car as a dealer, the first priority has to be given to section 206C1F. If the car is of more than 10 lakh rupees, you have to collect TCS under 1F. Okay. Now the first car is Maruti car. The value of the car is 37 lakhs. Therefore TCS will be collected under 1F. The second car is also Maruti car. The value is more than 10 lakhs. Therefore under 1F. The third car is 8 lakh. The value is less than 10 lakh. Therefore 1F will not apply. The fourth car is again more than 10 lakh, so 1F will apply. So in the first car, second car and the fourth car, 1F will apply. The dealer will collect TCS at the rate of 1% of the entire amount. But in case of the second car, that is Ford car, that is 8 lakh rupees. In this, if 1F does not apply, then you need to check 1H. 1H has to be checked. For a 1H, you need to fulfill the conditions of 1H. First of all, Raghav Motors last year turnover is more than 10 crore. The answer is yes. Is the car covered in 1F? It is not covered in 1F. Therefore, now you need to check whether it is covered under 1H or not. But for 1H, the ICI has taken two views over here. First view, for 1H, one of the primary condition is that your total sale should exceed 50 lakh rupees. Is it exceeding 50 lakh rupees? The ICI is saying no, because this car sale is only 8 lakh rupees. 1H will not apply. The second opinion taken by the ICI is, while computing the threshold of 50 lakhs, take all the cars, whether they are covered in 1H or whether they are not covered in 1H. All the cars have to be considered. So if I consider all the cars, then definitely my threshold exceeds 50 lakh rupees, and in that case you have to collect TCS on what? On the 8 lakh rupees. I hope it is clear to all of you. Now next question, question number B. It's a beautiful question. Mr. Ashish is a non-resident and he is a person of Indian origin. Therefore, he is an NRI, and we have to apply chapter 12A, which is an optional chapter for here. But the ICI has told that you have to compute your tax payable or refundable as per the special provision. Therefore, we will apply chapter 12A, and we will apply chapter 12A, and according to that, we will compute the tax. Okay. Now the very first thing over here is he is earning some long-term capital gains from certain specified foreign exchange asset on 31st of August 2024. What is the long-term capital asset? What is the long-term capital gains? It is 8,50,000 plus he has incurred some expenses on that 30,000. So this 8,20,000 rupees will be subject to what? Tax under chapter 12A. Now in chapter 12A, there is a specific exemption given under 115F that if you invest the money again in a net consideration in new specified asset within 6 months, you will be exempt from this capital gains. So they have invested some 1,80,000 rupees in the public limited shares check, but they have invested on 31st of December 2025. That is very late. That is after 12 months almost. So therefore this exemption will not be allowed to you. Okay. I hope it is clear to all of you. Therefore this 8,20,000 will be subject to 12.5% tax, because with effect from 23rd July 2024, the long-term capital gains under chapter 12A has also become 12.5% tax. Then interest on deposits held with private company. Now private companies deposits are not covered in chapter 12A. Therefore this 2,93,000 will be subject to what? Slab rates. Now interest on government security. Now government security is covered in chapter 12A, but only if it is purchased in forex. Now the question is very silent, so ICI has taken two views. First view, assume that it is purchased in forex. If it is purchased in forex, then this will be subject to what? This government interest will be subject to 20% tax. If it is not purchased in forex, it is purchased in INR, then the provisions of chapter 12A will not apply. In that case, you have to apply slab rate on this particular amount. Then 111A, short-term capital gains will be subject to 15% tax before 23rd July and after 23rd July. 20% tax. The date of sale is not given, so you can assume whatever you want to. Okay, we have assumed it is after 23rd July, therefore it will be subject to 20% tax. Last but not least, 1,50,000 is invested in the notified savings certificate, that is NSC. So you can claim the deduction of NSC if you are following old regime. If you are following new regime, then you cannot claim the deduction of NSC also. Okay. Last but not least, they have asked us to compute tax payable. So therefore, you have to deduct TDS also to compute tax payable. Okay. So compute tax payable, you need to reduce TDS, TCS, and advance tax credit. I hope it is clear to all of you. Now the next question is based on some case laws. Very simple case laws. First case law: can a CIT revise an intimation under 143 under section 264? Now, see, technically speaking, CIT does not have the power to revise an intimation under 264. CIT can only revise an order of an AO under section 264. But unfortunately, there is a High Court judgment which says that, which is a contradictory judgment which says that CIT also has the power to revise what intimation under 143(1) under section 264. So you can go according to this. Okay. Now there is an assessee firm who has taken some transport services from a transporter, but the truck is not owned by the transporter. The transporter has himself taken the truck from somebody else, and now you are making the payment to that particular transporter who has taken the truck from somebody else. It means he is subcontracting you. So whether the TDS under 194C will also be applicable on subcontracting? The answer is yes. 194C is very clear that 194C is applicable on contract as well as subcontract. It doesn't matter whether the truck is owned by the transporter or it is not owned by the transporter. Even if it is not owned by the transporter, you have to deduct the TDS under 194C. I hope it is clear to all of you. Next one, the AO has passed an order and you have a remedy to file an appeal to CIT appeal. Can you escape that remedy and directly go to High Court to file a writ petition? The answer is no. Writ petition is your fundamental right. I agree to that, but that is only available if there is no remedy in the law. So if there is a remedy in the law, then you should go according to the remedy in the law. AO has passed an order, you have an authority to go to CIT appeal, then you should go to CIT appeal. You cannot directly go to what? High Court to file a writ petition. So this is what the assessee has done wrong, and therefore in this case the assessee is not correct. I hope it is clear to all of you. Now the next question is on equalization levy covered under section 165A, which is applicable to e-commerce operator, but ICI has removed this particular equalization levy from your syllabus. Therefore we are not going to discuss the questions based on this for your exams of May 2025 and onwards. Okay. Now the last question over here is, there is a company by the name called as Highway Drive Limited, which is a wholly owned subsidiary of another Indian company, Highway Roads Limited. Both of them are Indian company and they are eligible for ATIA. Now what they are doing? In ATIA, you have to develop some infrastructure facility, so you get deduction of 100% of your profits. But the assessee is doing some other income and disclosing that as ATIA. You are doing some other activity, but showing that as ATIA, this is nothing but tax evasion. Therefore, in this case, whether the GAR will apply, GAR does not apply in case of tax evasion. The GAR will never apply in case of tax evasion cases. Okay. Next one, the Highway Road Limited, Highway Limited, they are related party. Now one entity is eligible for ATIA, another is not eligible for ATIA. Now they are selling the product between them at a lower and higher price by adjusting the price to benefit themselves. In such cases, domestic transfer pricing is applicable under section 92BA. Because domestic transfer pricing is applicable, therefore, because a specific anti-avoidance rule is applicable, therefore in this case also GAR will not be applicable. Now the last question in this particular paper is the AO empowered to the AO is empowered to provisionally attach your property? Yes, absolutely. He can provisionally attach your property. Can the AO revoke the provision attachment? Can he remove the provision attachment by saying the assessee that if you furnish a bank guarantee, I will remove? Then, if yes, from whom, to what extent, and to the what value? Can he invoke such bank guarantee? So I will explain you each and everything in detail by looking at the solution. First of all, the AO can buy an order in writing. The AO can pass an order in writing and revoke provisional attachment. He can revoke provisional attachment. Why? First he attached your property. Now he is revoking the provisional attachment. He is giving your property back subject to condition. First, you have to furnish a guarantee. You have to furnish a guarantee from scheduled bank of an amount not less than the fair market value of the asset. If you fulfill these three conditions, he will what? He will revoke your provisional attachment in lieu of what? In lieu of a guarantee. Now, can he invoke the bank guarantee? Can he go to bank and take the money from the bank and invoke the bank guarantee? Yes. If there is a notice of demand against you, which is served upon you, and you are not paying the demand within the time specified in the notice, which is generally 30 days. Or if you fail to renew the bank guarantee within 50 days from the expiry of the bank guarantee. Suppose the bank guarantee is expiring on 30th and you have not yet, on 15th also you have not renewed the bank guarantee. So on 16th of the month, the AO can go to the bank and can liquidate the bank guarantee. I hope it is clear to all of you. So this is what this beautiful paper is all about. It was a very lengthy paper. So let's go ahead with the next paper, that is May 2022 paper. The very first question over here is on total income. We are supposed to compute total income and tax payable, but we are opting, sorry, for the 115BAA. So answer according to 115BAA. Okay. So we are not following the normal provision. The assessee is a manufacturer. Accordingly, you need to answer the question. The profit is 850 lakhs. Very first adjustment is depreciation that you will add back because that is as per books of accounts. Next adjustment, employer contribution and employee contribution. We all know that employer contribution has to be paid till the due date of filing of return as per 43B. But for employee contribution, there is a stricter time limit. You have to pay by the 15th of the following month. In this case, you are paying the employer contribution by 20th May. So that will be allowed because the employer contribution can be paid till the due date of filing of return. But employees contribution, if you are paying by 20th May for the month of March, that is wrong. For the month of March, employees contribution has to be paid by 15th of April. Therefore, employees contribution will be disallowed. Okay, I hope it is clear to all of you. Now, the penalty on GST is considered to be penal in nature. Therefore, that is disallowed. But interest on GST is considered to be compensatory in nature. Therefore, that will be allowed under the income tax law. Next one, you are incurring some 10 lakh rupees on a notified skill development covered under 80CCD. Now, the provisions of 80CCD are not available for 115BAA. If you are following 115BAA or BAB, 80CCD is disallowed in that case. Next, there is an old machinery which was destructed and you received rupees 5 lakh rupees as a scrap. Now, what is the treatment of that under income tax law? First of all, you will disallow this 20 lakh rupees because it is a capital loss not allowed as deduction. You have to disallow that, and then this 5 lakh rupees scrap also you have to reduce from your PGBP income, and then you have to go to the WDV of the block of asset, and then you have to adjust that 5 lakh rupees from the WDV of the block of asset. But fortunately, in this question, the WDV of the block of asset is not given, so we don't have to give any effect to that particular 5 lakh rupees. I hope it is clear to all of you. Next one, you are receiving a dividend of 15 lakh rupees from a foreign company, so you will reduce this 15 lakh rupees from here, and you will show that 15 lakh rupees as income under IFOS. As what? As income from other source. Now you are also incurring 50,000 rupees as an expense, so you will add back this expense under PGBP, and under IFOS it will not be allowed, because under IFOS against dividend income there is only one expense that is allowed, and that is interest expense, and it is nowhere mentioned that this 50,000 is interest. Therefore, we are disallowing this 50,000 rupees under what? Under IFOS. So the effect is very simple: reduce 15 lakh from PGBP and show 15 lakh in IFOS, and 50,000 will be disallowed under PGBP, and under IFOS there will not be any deduction of that. Next one is a very routine adjustment we have done so many times. 100% holding subsidiary, if they are transferring assets between them, then the capital gains are exempt. So you have to reduce from here, and then you have to write a note that it is 100% holding subsidiary, it is exempt. Therefore, one more condition is there: the recipient, the receiver has to be an Indian company. If the receiver is an Indian company, then only this exemption is available, otherwise it is not available. Next one, normal depreciation, you have to reduce 92 lakhs because normal depreciation is allowed under income tax law. Additional depreciation won't be allowed because you are following 115BAA. Okay. Now, next adjustment, it is in the last year you have purchased some plant and machinery last year of 20 lakh rupees on 10th of Jan 2024. Now, so in the last year you have used the machinery for less than 180 days. Therefore, in the last year you would have got 50% of the additional depreciation. Can you claim the balance additional depreciation in the current year? The answer is no. Why? Generally you should get, but in this case you will not get because you are not following, you are following 115BAA. Now, because you are following 115BAA, the balance 50% additional depreciation of last year will not be allowed in the current year because you are following 115BAA. Similarly, in the last year you have provided provision for 7 lakh rupees for a subcontract. Now, the tax for that was deducted and paid on 31st of December 2024. So, in the last year, the TDS was not deducted, the TDS was not paid. But in the current year, the TDS is deducted and paid. Therefore, in the last year, 30% of 7 lakh would have been disallowed, and in the current year, you can take 30% deduction under the income tax law. I hope it is clear to all of you. Okay. So, in the last year, 30% of the 7 lakh would have been disallowed, and in the current year, you can claim 30% deduction. Last but not least, you have declared and distributed dividend of 20 lakh rupees on 31st of May 2000, on 15th of May 2025, which is 1 month before the due date of filing of return. Therefore, for this particular adjustment, you are going to get deduction of how much? Of 15 lakh rupees, not 14.5. Sorry, in the answer it is 15 lakh rupees. How, sir? Dividend received is 15 lakhs and dividend distributed is 20 lakhs, and therefore under ATM, whichever is lower, that will be allowed as deduction. Now you will compute your tax. How much tax will be there under 115BAA? It is 22% tax, 10% surcharge, and 4% cess. That's it. This is what this question is all about. Now let's move on to the next question, question number 2, which is on non-resident taxation. There is a foreign company BNB which is incorporated in country X. Now that company has appointed one agent in India, Mr. Lal Singh. Now what is that agent doing? That agent is habitually entering into a contract. The agent is delivering goods in India. So do you remember that if a non-resident or a foreign company has an agent in India who is habitually entering into a contract on behalf of the non-resident or is delivering goods on behalf of non-resident in India, then that amounts to what? Business connection in India. And in that case, the income of the non-resident is deemed to accrue or rise in India, even though there is no permanent establishment in India. Still, that income is deemed to accrue or rise in India. So that is what this particular non-resident is doing in this particular case. Now, the very first income that he has earned from here is, you can check over here, he has earned income from delivery of goods by Mr. Lal Singh. So the non-resident is earning some income from delivery of goods, and who is delivering the goods on behalf of the non-resident? It is Lal Singh. And who is Lal Singh? Lal Singh is the agent of the non-resident. Therefore, this 2 crore rupees will be deemed to accrue or arise in India, and this will be subject to 35% tax in India, 35% tax, which is the normal tax for a foreign company. I hope it is clear to all of you. Now, in the next point, the ICAI has taken 2 views. Fees for technical services 55 lakhs, after deducting expenses of 6 lakh rupees. So here ICI has taken two views. If there is an agreement between both of them and the agreement is approved between both of them, then 115A will apply, and if 115A will apply, then the income will be 61 lakhs. You will not get deduction of 6 lakh rupees, okay? Because in 115A you don't get deduction of expenses of PGBP. So that 61 lakh rupees will be your gross income, and you will be subject to 20% tax plus surcharge if applicable and cess. Then the second view taken by the ICI is, if there is no agreement between both of them which is approved by central government, there is no agreement, there is no approval, then in that case 115A is not applicable, and 115 is not applicable, then 55 lakh rupees, that is net of expense, will be taxable at normal rate. 115A is not applicable, therefore normal tax rate of the foreign company will be applied, that is 35%. Okay, next one, long-term capital gain on unlisted debentures of White Limited and Indian company. So the non-resident is transferring some unlisted debentures. Now we are assuming that the date of transfer is not given. We are assuming that it is transferred on after 23rd July. Therefore, this will be subject to 12.5% tax. Assuming date of transfer is not given in the question, we are assuming it is transferred on after 23rd July 2024. Now, last but not least, last point is given to confuse us. The assessee BNB has paid some tax in his country. So, what shall I do in that? If he has paid some tax in his country, can India give him DTAA credit? India cannot give DTAA credit to a non-resident. India will give DTAA credit only to our residents, not to foreign residents. This 50 lakh which he has paid in his country, he will take the credit of that in his country. India cannot give him any credit. Okay. So this last point is given to confuse us. That's it. There is no other reason to give this last particular point. Okay. Now let's move on to the next question. The next question is on charitable and religious trust. The very first question, in which there are 2 points over here. The first point is, the trust has received some corpus donation of 5 lakh rupees. Now the trust is saying that since we have received the corpus donation, it is exempt. No, it is not exempt unconditionally. The corpus donation is exempt only if you deposit that money in the mode specified in 11.5. If you do not deposit the corpus donation in the mode specified in 11 subsection 5, then it is not exempt. So it is not directly exempt, it is exempt subject to condition. The second thing which the assessee is saying that we have taken a loan of 20 lakh rupees from a nationalized bank, and with the help of that loan we are doing some construction of the building. So we should get the deduction of that construction, not allowed. If you take a loan and incur an expense, if you take a loan and do an application, then that is not allowed as a deduction. It will be allowed when the loan will be repaid. I hope it is clear to all of you. So whenever you will repay this particular loan, and that particular year you are going to get the exemption of this amount. Only taking a loan and incurring an expense does not amount to application under income tax law. You have to repay the loan. Okay. Now the third one, the trust Smile Foundation is a not-for-profit organization, runs a secondary school. Now, they are receiving some voluntary contribution of 14 lakh rupees, of 30 lakh rupees, sorry, out of 14 lakh rupees and government grant of 60 lakh rupees respectively. Okay. So, I am a trust, I am a school, I am receiving voluntary contribution of 14 lakh rupees and government grant of 16 lakh rupees. So, now, can I claim, is the trust required to get an approval to claim exemption? And the question is, the answer is no, there is no need to get an approval. Why? Because there is a provision under section 1023C which says that if a trust is substantially financed by government, then there is no need to take any approval. We need to check over here, is the trust substantially financed by government over here? The answer is yes. What is the meaning of substantially financed by government? It means if the government grant exceeds 50% of the total grant. So if the government grant exceeds 50% of the total grant, the trust will be called as a substantially financed institution, and therefore there is no need to take an approval. Now how much is the government grant? It is 16 lakhs. What is the total grant? It is 30 lakhs. Is it exceeding 50%? The answer is yes. Is it substantially financed by the government? The answer is yes. Therefore there is no need to claim any what? There is no need to get any approval under section 1023C. You can directly claim the exemption. Next one, a trust wants to know whether it can claim exemption under section 11 and 1023C both. The answer is a big no. You cannot claim exemption under section 11 at the same time you cannot claim 1023C also at the same time. You cannot claim both the exemption together as per section 11 subsection 7. You have to choose between both of them. Both of them together are not allowed at the same time. Now let's move on to the next question. The next question is on TDS and TCS. The very first question over here is Mr. Rajat is 79-year-old. Just count the conditions with me. Rajat is 79-year-old. He is a resident individual. Condition number 2. Now he has a saving bank account and a fixed bank account, fixed deposit account in ABC Bank Limited, and he earns the following from the saving bank account. First of all, he earns interest of 75,100 from the saving account. Then he also earns pension from the employer in the same bank account, 55,000 rupees per month. So multiply by 12. And then you can take 50,000 rupees standard deduction because you are going to follow old regime here as it is mentioned over here. And there is an interest of on fixed deposit of 1,20,000 rupees. So now this is a classic case of section 194P where the assessee is a specified senior citizen. Who is the specified senior citizen? Who is a resident individual whose age is 75 years or more, and he earns from a specified bank pension and he earns from the specified bank interest from fixed deposit or saving. In that case, the bank will deduct the TDS as per old regime, new regime, as the case may be, whatever Mr. Rajat will tell the bank. and accordingly the bank will deduct the TDS as per the slab rates of the SSE. So we have to compute the total income and tell the bank to deduct the TDS as per the slab rates. And then Mr. Rajat will not be liable to file the income tax return. So how the Mr. Rajat's income will be computed? 55,000 into 12 will be salary, minus 50,000 standard deduction in the old regime, then 75,000 interest on saving, 1,20,000 interest on fixed deposit. You will get your gross total income. From that you will claim what? You will claim 80 TTB, 50,000 standard deduction of 80 TTB, and then whatever income will come, you will compute tax as per old regime. Okay. And then the bank will deduct the TDS as per the old regime, and then the Mr. Rajat is not liable to file the income tax return. I hope it is clear to all of you. Now the next question is also a beautiful question. Mr. Aryan is a buyer and Mr. Varun is a seller. Now if you see the last year turnover of Aryan, the last year turnover of Aryan is 12 crore rupees. That is, the buyer's last year turnover is 12 crore and the seller's last year turnover is just 8 crore rupees. So if the buyer's last year turnover is more than 10 crore and if the seller's last year turnover is less than 10 crore, then the buyer is liable to deduct TDS under 194Q. Now the buyer is buying goods worth rupees 85 lakhs. Okay. Now in 194Q, you will deduct TDS once you purchase more than 50 lakh rupees. And then you will deduct TDS on payment or credit, whichever is earlier. Now, so you are not going to deduct TDS on entire 85 lakh rupees. Once it exceeds 50 lakhs, you will start to deduct TDS. So how you have purchased the goods of 85 lakh rupees. The PAN has etc. has been furnished, so there is no issue in PAN. On 25th of May, 30 lakhs goods are purchased. On this, you will not deduct TDS because it is within the limit of 50 lakhs. Then on 28th of June, you are purchasing another 25 lakhs. Now it is crossing 50 lakhs. How much is crossed? 5 lakhs have crossed above 50 lakhs. So on 5 lakhs, 0.1% TDS will be deducted now. Okay. Then on 10th of December, now this is the most important point of this question. On 10th of December, you are buying another goods of 20 lakh rupees. So on this, you will deduct 0.1% TDS. Okay. Now out of this 20 lakh goods, you have returned 5 lakh goods because they were not good in quality. And the seller has also refunded the money. So out of 20 lakhs, 5 lakh rupees has been refunded to you. So now you can adjust this 5 lakh rupees against the future purchase from the same seller. Do you remember that? If the seller has refunded you the goods, refunded you the money for return of goods, then you can use that money, you can use that TDS against future purchase from the same seller. So how much he has refunded? 5 lakh rupees. On that, have you already paid the TDS? I have already paid the TDS of 0.1% on that amount. So that much TDS will be adjusted in future purchase. So next time when I will purchase, next time when I am purchasing is 10 crore rupees, 10 lakh rupees. So on this 10 lakh, I will not deduct TDS. I will deduct now only TDS on 5 lakh rupees because I have to adjust the earlier TDS now. So on 10 lakh, instead of 10 lakh, now I will deduct TDS only on 5 lakh rupees. On what? On 20th of Feb 2025. I hope it is clear to all of you. Is it clear? Now the next question is a very simple question on equalization levy. There is an Indian company over here and there is a London based company, Shine Inc. This company does not have a permanent establishment in India. Okay. And we are paying what? We are paying 5 lakh rupees to this company for what? For online advertisement. So we are Indian company. Shine Inc. is a foreign company. Shine Inc. does not have a P in India. Shine Inc. is providing us online advertisement. We are paying them 5 lakh rupees. Therefore, it's a classic case of equalization levy. We are paying them on which date? The services are provided on 15th of March. Therefore, we have to pay by 7th of April. Now, we have deducted on time, but we have paid late. See, instead of deducting and paying on 7th of April, we are paying on 15th of April. So, I am delaying by a few days. So for every month, I have to pay interest of 1% per month or part thereof. So there are 3 questions over here. What is the interest leviable to Sun Limited on delayed payment? So interest leviable will be 1% per month or part thereof of the equalization levy. Now 5 lakh is the total amount paid to what? Paid to Shine Inc. The equalization levy is 6%. Therefore the equalization levy is 30,000 rupees. What is 1% of that? That is 300 rupees. That is the interest which I have to pay to what? To the government of India for delay payment of equalization levy. Now what is the circumstances under which penalty cannot be imposed? So generally, the penalty should also be imposed for late payment of equalization levy. But if you prove to the assessing officer that there is a reasonable cause for delay, there is a genuine reason for delay, then you need not have to what? Then you need not have to pay what? Penalty. Third one, if the AO imposes a penalty and he passes an order, what remedy you have and by what you can file an appeal? So if an AO passes an order of penalty against you, if the AO passes an order of penalty against you, you can file an appeal to the AO. You can file an appeal to the CIT appeal within 30 days from the date of receipt of the assessing officer's order. So whenever you will receive the order of the assessing officer within 30 days, you can make an appeal to the CIT appeal. Okay. The way you do under the income tax law. And the last question is a very, very simple question. This was a very simple paper. Huh? Those people were very fortunate who are giving exams in May 2022. Now, in this question, we need to answer whether it is a tax planning, tax management or tax evasion. So purchasing a Sukanya Samriddhi scheme to reduce your income. It is absolutely a tax planning. The government allows you to purchase Sukanya Samriddhi scheme as per 80C and therefore it is tax planning. Now, obtaining a declaration in Form 60 from the customers who do not provide PAN. So this is a kind of management. Therefore, this is a kind of compliance. It's a kind of procedural compliance. Therefore, it is tax management. Okay. Next one. You are purchasing a refrigerator for home. Okay. But you are showing that as it is in the office. The refrigerator is kept at home, but you are showing it as it is in office. So it's a clear case of tax evasion. Personal refrigerator is shown under business and you are claiming depreciation to reduce your profit. It's a case of tax evasion. And last but not least, you are paying 4 lakh to Mrs. D, who is the wife of the director. Okay. Although being a qualified professional, but is a housewife. Why are you doing so? Why are you paying 5 lakh, 4 lakh rupees to your housewife? Okay. The purpose is to increase the income of D up to 5 lakh so that she can claim what? Rebate up to 5 lakh rupees and the business can claim more expense. So without any genuine reason, you are paying excess money to the wife. Okay. Wife is not contributing to the business also. You are paying excess money to the wife. You are increasing from 4 lakh to 5 lakh. It is absolutely a tax evasion case. Okay. It's a case of tax evasion. It's very simple. Whenever a question of tax planning, management or evasion comes, it's a bonus for all of you. Okay. Last but not least, it's a theory question which you can go through at your end, not very important for exam. So this is what this paper is all about. Now let's move on to the next paper, that is November 2022 paper. In this question, what are we supposed to do in the very first question? Generally, first question is on total income only. So we are supposed to only compute total income, not as per 115BAA, but as per the normal provision. We don't have to compute tax also in this question, only total income. Be very careful. Now, if you see the very first line, there are some important points in the first line. You need to be very careful. We have not seen such lines in our previous questions. The company is resident in India, first of all, and secondly, it is a company in which public are not substantially interested. It means it is a closely held company, and whenever a closely held company word will come in the examination, there can be multiple implications which can come in your examination. One is section 79, which can be applicable. Another is section 68, which can be applicable. Another is section 222 deemed dividend, that can also be made applicable. Okay, so these sections can be made applicable. The very reason the ICI is writing a company in which public is not substantially interested is because to test these sections. Okay, what is section 79? It is about carry forward and set off of loss. What is section 68? It is talking about unexplained cash credit on which 78% tax is imposed. Now let's start with the question and then we will see what is the implication of section 79 and section 68 in this question. The first thing is the profit is 50,75,000. Write down that. Next is one-time license fees you are paying for franchise. This is nothing but an intangible asset. So add back this 12 lakh rupees and then claim 25% depreciation. You can assume in this question the ICI has made one weird assumption. You can assume that the depreciation under section 32 include this amount also. So now, so far what we have been doing, we are always in case of intangible asset, we are adding back the amount and then we are claiming depreciation. So in this question, the ICI has made a weird assumption and they have given an alternate answer also. The weird assumption is they are saying that add back this 12 lakh rupees and then do not reduce this 12 lakh rupees. The depreciation amount given below under section 32 may include this amount also. Therefore, there is no need to reduce. So you can give both the effect. You can reduce also. If you don't want to reduce, you can ignore that and you can write down a note on that. Okay. Next one, convertible debenture you are issuing. So you are incurring some expenses for convertible debenture. So that is allowed because issuing convertible debenture does not amount to fixed capital, does not amount to permanent capital in the business. Therefore, that will be allowed as a revenue expense. So don't worry. Okay. Next one is a very intelligent adjustment. You are paying 2,25,000 to a share broker and 1,20,000 to a commodity broker. Obviously, you are paying what? You are paying brokerage. Obviously, what else you will pay? You are paying commission and brokerage to these people. And now you have not deducted the TDS. Now in this, the ICI has taken two views. First, if the assessee is a trader, in commodity or trader in share, then the deduction of these expenses are allowed. If deduction of these expenses are allowed, now we need to ask ourselves whether the TDS is applicable or not. So if first assumption, the assessee is a trader, therefore deduction is allowed. Now, if deduction is allowed in case of share broker, are we supposed to deduct TDS under 194H? No. For share broker commission, TDS under 194H is exempted. So for share broker, you can directly claim the deduction of 2,25,000. But for commodity broker, yes, TDS is applicable. So on 1,20,000 rupees, 194H is applicable. Therefore, if you have not deducted the TDS, 1,20,000 will be disallowed. Okay. I hope it is clear to all of you. Now. Second one. What is the second view? The second view is what? In this 1,20,000 will not disallowed, only 30% of 1,20,000 will be disallowed. Don't worry, because if you are paying to resident, only 30% is disallowed. The second view is suppose they are not traded in commodity or they are not traded in shares, then the deduction is not allowed under 36,115 and 36,116. See very clearly 36,115 and 36,116 says that the deduction of brokerage, deduction of STD, etc. All these expenses are allowed to trader and broker only if it is what? Only if you are a trader in security. If you are not a trader in security, then the question of deduction is not allowed only. Does not arise only. Next one. If an employer contributes to the national pension scheme of the employees, then how much deduction is allowed to the employer? It is 14% of basic salary plus DA in terms. It is amended by Finance Act 2024. Earlier it was 10% of basic salary plus DA in terms. Now it is 14% of basic salary plus DA in terms. You are paying how much? You are paying 15% of basic salary in DA in terms. Therefore, whatever amount will come, you have to disallow 1% out of it. Okay. You cannot give 15% of the basic and DA. You can only give 14% of basic and DA. I hope it is clear to all of you. Next one. You are a pharma company. And if you are a pharma company, you cannot give freebie to your medical practitioner. That is disallowed. That is bad in law. That will be disallowed under the income tax law. Next is you are incurring some 5,20,000 rupees on feasibility study for examining proposal for technological development of existing business. But the project did not work. It was abandoned without creating an asset. So you are planning to do some expansion in the business and the project did not work, and therefore your project was abandoned without creating a new asset. So it will be allowed as a revenue expense because new asset was not created. Therefore, it can be claimed as a revenue expense. If new asset would have been created, we would have capitalized that expense. Okay. Next, depreciation you will add back. Next, employees provident fund, employer provident fund, same adjustment we have done in the previous paper. Also, I'll say once more. Employer provident fund you have to pay till the due date of filing of return. Employee provident fund you have to pay by 7th of the following month. Okay. Donation to Swachh Bharat Abhiyan will be disallowed under PGBP, but you can claim under Chapter 6A, but with an assumption that you are making the payment for other than cash. If you make the payment in cash, then it is not allowed. Industrial tariff concession from the central government, it is an income. From if any tariff concession from the central government, state government, body, agency, authority, it is an income. Therefore, it is a part of income as per section 224(18). Next one, the interest and the borrowing cost amounting to 6,85,000 and 5,65,000, though not meeting the criteria for recognition as cost, is included in the opening and the closing stock. So you cannot include the interest and the borrowing cost in the opening and the closing stock. So how much you have included in the opening stock? How much? 6,85,000. So that has to be added back. How much you have included in the closing stock? 5,65,000. So that has to be reduced. Whatever is debited in the P&L wrongly, add back. Whatever is credited in the P&L wrongly, reduce. I hope it is clear to all of you. Next one, you have some profit from warehouse. Which warehouse? Storage of sugar. So it's a case of 3580. How much profit is there? 10 lakh rupees. So first of all, reduce this profit from here. It will be separately computed. Against this profit, you have incurred some capital expense. See the last point number 4. 35 lakhs capital expenditure you have done, out of which 20 lakh is land. Therefore, only 15 lakhs will be allowed. Therefore, the profit is 10 lakh and the capital expenditure qualified for deduction under 3580 is 15 lakh. 5 lakh rupees loss. This cannot be set off against your normal business. This you have to carry forward in the section 73A and set off against only 3580 business for infinite number of years. Next one is you have collected some GST of 14 lakh and then you remitted the GST to the central government within the due date. Okay. So first you collected and then you remitted. Then you filed a case in the court. So the court has given you a refund of 5 lakh rupees, out of which you have given back to the customer only 3 lakh rupees. So when the government has given you refund of 5 lakh rupees, so you have to give entire 5 lakh rupees to the customer because ultimately GST is collected from customer only. It is not your money. It is not your wealth. It is not your asset. It is customer's money. Therefore, 5 lakh you have received, only 3 lakh you have deposited back to the customer. Therefore, 2 lakh will be added back. Whenever you will deposit back that, whenever you will give back that 2 lakh rupees to the customer, at that time we will give you the deduction. Next one is the adjustment because of which that first line was given. You remember that in section 79 it is written that section 79 is applicable to closely held company, and one of the conditions for closely held company to carry forward the losses, your 51% of the shareholders should remain same on the year of loss and in the year in which you want to set off. So if the 51% shareholders are not same, you cannot carry forward the loss. So in this case, see, 55% of the shareholders have changed. So Mr. X, who was holding 55% shares, he sold the entire share. Therefore, his loss cannot be carried forward now. His loss will be lapsed under the income tax law. And the last but not least, the depreciation is 14 lakh 50,000 rupees. I hope it is clear to all of you. So this is what this question is all about. Let's move on to the next question. Question number 2, which is on a partnership firm LLP. And in case of a partnership firm, first you have to always compute what? Book profit as per 40B for computing the remuneration allowable to the partners. Then you have to compute the total income, and then there can be an implication of AMT if there is a deduction of 10AA or profit link deduction or 3580 deduction. There can be an implication of AMT as well. So in this question, we have to compute all 3 of them. First book profit, then total income, and then AMT. So this is a LLP. LLP is engaged in what? The LLP is set up in SEZ. Therefore, it will be we need to compute what? 10AA deduction, and then later on we need to compute AMT also. Okay. Now it was set up in 2020. Therefore, this is the 5th year of business, and therefore it will be eligible for 100% deduction for the first 5 years. Now, what is the net profit of the LLP? It is 65 lakhs. First, I am going to compute the book profit. What is book profit? Book profit for the purpose of remuneration under 40B. So, how to compute book profit? Book profit is nothing but it is PGBP income only. All the provisions of section 28 to 44 you have to apply, and then whatever amount will come, that will be your book profit. So, let's start. 65 lakhs is your net profit after debiting and crediting the following items. First, profit on sale of import license. Shall I reduce while computing the book profit? No, no. Profit on sale of import license is part of section 28. It's a special charging section under PGBP. Do not reduce. Then remuneration to working partner. Yes, add back that. Interest to partner 16%. 16% not allowed. Only 12% allowed. Therefore, add back 4%. Okay. Donation to political party. No, that is not allowed under 40B. 40B only PGBP expenses and incomes have to be taken. Other than PGBP and expense, you have to add back. Okay. So add back this and take deduction under chapter 6 later on. Then depreciation. Yes, accounting depreciation you have to add back. Tax depreciation you have to reduce. Okay. Now. Payment of remuneration to working partners and interest on capital are authorized by this. Yes, it has to be authorized. So what about brought forward business loss? Shall I reduce this? No. While computing the PGBP, while computing the book profit, you only have to take the income and expenses and losses only from 28 to 44, and business loss is not allowed to set off under 28 to 44. Therefore, don't take this. This you will take while computing the total income. What about unabsorbed depreciation? Yes, unabsorbed depreciation you can take because unabsorbed depreciation is allowed under section 32 subsection 2. Therefore, it comes under section 28 to 44. Therefore, you have to adjust this. After doing all those things, you will get what? you will get your book profit. Okay. Now the book profit is 87 lakhs. So how to compute the remuneration? Up to 6 lakhs. For first 6 lakh, it is 90% of book profit. So for first 6 lakhs, it is 5 lakh 40. And on balance above 6 lakhs, on balance 81 lakhs, it is 60% of book profit. Therefore, it will come to 48 lakh 60,000. Total 54 lakh will come as a remuneration, which is maximum allowable to the partners. How much remuneration you are giving to working partners? Actual remuneration is 50 lakhs. Whichever is lower, that will be allowed as deduction. Therefore, only 54 lakhs will be allowed as deduction. Therefore, your total income, business income, will come to 33 lakhs. Now, from this, you will reduce what? From this, you will reduce your business loss of 4 lakh rupees, and therefore, your total income will come to 29 lakh rupees. Okay. Now, from this, we will compute what? We will compute our 10AA deduction. This is the 5th year of business, therefore we will get 100% deduction. Now what is the formula to get the deduction? Profit derived from export multiplied by export turnover divided by total turnover. Now while taking the profit, ICI has taken two views. One of the view which has been taken by ICI is you should take the profit before the losses. Another view they have taken is you should take the profit after the losses. Obviously the answers will change according to that, and both the answers are correct. If we are taking suppose the profit before the losses, say 33 lakhs. So from this, first of all, we have to remove this 9 lakh rupees. Which 9 lakh? This 9 lakh. Why, sir? Because it is very clearly written in 10AA that profit from sale of license shall not be part of profit for the purpose of 10AA. So in 10AA, you do not take the profit from sale of license or duty drawback or cash compensatory support. All these things are not taken as a part of profit. So if we are taking the first view, 33 lakhs, so remove 9 lakh, it will come to 24 lakh. If you are taking second view, remove 9 lakh, it will come to 29 minus 9, that will be 20 lakh. This will be your what? Profit. What is your export turnover? See, your export turnover is 45 crore rupees. But see, as per 10AA, it is very clearly written, you can take only that much export turnover which is received in India within 6 months from the end of the financial year in convertible foreign exchange. So out of the total turnover, total export turnover, how much is received in India up to 6 months? 38 crore is received in India up to 6 months. So you will take only 38 crore. Now wait. In that also, any kind of expenses like insurance, freight, telecommunication charges, those should not be part of export turnover. So are you incurring some telecommunication, etc. charges? Yes. Out of 38 crore, 2 crore rupees is telecommunication, insurance, freight, etc. These type of expenses which shall not be part of our export turnover. Therefore, out of 38 crore, reduce 2 crore further. Therefore, your export turnover will be only 36 crore. Okay. Now, what is your total turnover? Your total turnover is also 45 crores. Now, in total turnover, you will not take one thing, that is insurance, freight and other charges. Now, how much insurance, freight and other charges is there in 45 crore? It is 5 crore rupees. So, out of 45 crores of total turnover, 5 crore is expenses of insurance, freight, other charges and telecommunication charges. Therefore, this will be 40 crore. So, I got all the three amounts. Profit I got multiplied by export turnover 36 crore divide by total turnover 40 crore. So, now I am computing my what? My computing 10AA. I am taking the first view. If I take the first view, it is 33 minus 9. Therefore, it will be 24 lakh into 36 crore divided by 40 crore. And therefore, my deduction will be 21 lakh 60,000. I can take another view also. In that case, it will be 20 lakh into 36 crore into 40 crore. So, answers will change slightly. Okay. Now, after doing all those things, I will get what? I will get the deduction of 10AA, and after that I will also claim the deduction of 80 GGC, the donation to political party. Now after that my total income will be 4,40,000. On that I will apply 31.2% tax, and this will be my tax liability. Now the answer will not complete. Now I also have to compute AMT. Okay. Now while computing the AMT, what am I supposed to do? Whatever is my total income, in that I will add 10AA. What is my 10AA? It is 21,60,000. So 4,40,000 plus 21,60,000. That will be my adjusted total income. On that I will apply 18.5% tax, 4% cess. And then I will compare this tax with this tax. Whichever is higher will be my tax liability. And if AMT is higher, I will also get AMT what? Credit. I hope it is clear to all of you. So this is what this beautiful question is all about. So let's go ahead with the next question. The next question number 3 is on taxation of trust. There is a trust by the name called as Fit Me Foundation. They have some questions which we need to answer. First of all, they have received a voluntary contribution of 125 lakhs with a specific direction. It means it's a corpus donation, and they have invested that in a private limited company share. So that is not allowed. You have to invest the mode. Whenever a corpus donation is received, you have to invest that donation in the mode specified in 11.5. Only then it will be exempt. So, and if you invest in a private company shares is not covered in section 11.5. Therefore, this amount will be taxable. You will not be eligible for exemption for this particular case. Okay. Next one, there's a trust who is receiving 125 lakhs. It received 95 lakhs from other contribution and 60 lakhs from providing yoga services. So providing yoga services is very much within the definition of charitable purpose. Therefore, the trust will be eligible for what? Exemption under section 11 and 12. Claim 15% exemption out of the total 125 lakhs, and balance you can apply and claim the deduction. I hope it is clear to all of you. Next, Mr. Nagraj is the founder of the trust of a charitable trust registered under 12 AB. Now it's a hospital. Now the son of Mr. Nagraj, that is the son of founder, was not well, and therefore he was admitted in the hospital. So can a son of a founder be admitted in the hospital? There is nothing wrong in admitting the son of a founder in the hospital, but the point is you should charge that son also equally as you charge to others. Now you are charging how much to the son of a founder? You are charging only 3 lakh rupees to the son of the founder, and how much you are charging to the others as a general fees? To others you are charging 5 lakh rupees. So you are charging less to the son of the founder, and the son of the founder is considered to be a specified person under section 13 subsection 3. Therefore, the amount which you are not charging less, the amount which you are not charging properly, that is 2 lakh rupees, will become deemed income of the trust, and that 2 lakh rupees will not be allowed as what? Deduction also to the trust. I hope it is clear to all of you. Next question is a beautiful question on what? On DTAA. Mr. Ritesh, it's a different kind of DTAA question. Whenever such beautiful questions will come, I will definitely discuss. But if a routine kind of DTAA question comes, I am not going to discuss them. Now this is a beautiful question. This is a resident individual aged 42 years. Now he is earning income from multiple places. First, he is earning from business in India. So you will write down this. Then he is earning income from royalty from country N. How much? 7,80,000. Now India has a DTAA with country N. You can see in additional information. As per the DTAA, India and country N, the royalty will be only taxable in the source state. Now which is source state? India is a resident state for Mr. Ritesh, and country N is the source state for Mr. Ritesh. Therefore, this royalty is only taxable in source state, that is in country N. Therefore, this royalty will not be subject to tax. Therefore, this is not taxed in India. So forget about this. Okay. Now let's talk about the third income. Interest from country Y. Now how much interest is earned from country Y? $9,500. Okay. Now where is this taxable? So as per DTAA between India and country Y, you can check over here. It is taxed in both the states. That is in country Y also and in India also. And the credit will be given in respect of tax payable in the resident state. So this interest will be chargeable in country Y also. This interest will be chargeable in India also. And India ultimately will give them what? DTAA credit, because India is a resident state. Therefore, now we need to convert this interest into rupees because this is in dollar. Now we need to convert this into rupees as per rule 115. If you want to convert the foreign income into Indian income, you have to apply rule 115. Now interest has to be converted into rupees as per rule 115. So I should take which rate? Now here also I have to make one assumption. If I assume that it is interest other than security, then I have to convert as per the TTBR of the last day of the financial year. And if I consider this as interest on security, then I have to take TTBR of the last day of the preceding month. Okay. So for interest other than security, it is the last day of the financial year, and for interest on security, it is last day of the preceding month. So we are assuming interest other than security, and therefore we are taking what? Because it is not clarity. There is no clarity that what kind of interest it is. They are just writing interest. It is whether it is interest on security or interest other than security, that they have not mentioned. So we are assuming it is interest other than security. So if it is other than security, you have to take TTBR on the last day of the financial year. And therefore the TTBR on the last day of the financial year is 80 rupees. So you will convert this as per 80 rupees, 9,500 into 80 rupees. Okay. And whatever tax you have paid in the foreign country, you will get the credit in India. Last, agriculture income in country M, 1,09,000 rupees. So that will also be taxable in India. It is not taxable in the country M. Check. Agriculture income is exempt in country M. But in India, obviously world income is taxable for residents. Therefore, this will be taxable. So now after this, you will compute the tax of the Mr. Ritesh. So 4,85,000 is business income in India. Royalty for country N is not taxable because that is taxable in country N. Then country Y interest will be taxable and agriculture income will be taxable. We are following old regime in this question. Compute tax as per old regime. That will come to 2,27,448. Now whatever is the doubly tax income, we will get relief on that. Now, first one is an Indian income, therefore this is not doubly taxed. Second one is not taxed only in India, so therefore there is no question of doubly tax. Third one, yes, it is doubly taxed here and there. Fourth one is also not doubly taxed because it is only taxed in India. It is not taxed in foreign country. You can see point number 3, agriculture income is exempt in country M. Therefore only the third one is doubly taxed. Now how much tax you have paid in the foreign country and how much tax you have paid in India, whichever is lower, that will be allowed as deduction. Okay, that will be allowed as relief. Now let's see what is the average rate in India. 227 448 divided by 1354. Therefore the average rate in India is 16.798. And what is the doubly tax income? 7,60,000. So on 7,60,000, 16.798 is the tax paid in India. Therefore, this is the tax paid in India. Okay. Now, how much is the tax paid in foreign country? The tax paid in the foreign country is 10%. 10% amounts to $950. Now, how to convert the foreign tax into Indian rupees? As per rule 128. As per now, rule 128. To convert foreign income, rule 115. To convert foreign tax, rule 128. So, how to convert this? You have to take TTBR on the last day of the preceding month. When the tax is paid on 21st of Feb 2025. Therefore, the TTBR of the last day of the preceding month will be 31st Jan 2025. That will be 78 rupees. So, $950 into 78 rupees. That will be the amount of credit you are going to get. $950 into 78 rupees. 74,100. Whichever is lower will be allowed as what? Will be allowed as credit. You can take that much credit and balance you have to pay out of your pocket. I hope it is clear to all of you. Let's move on to the next question. Question number 4, which is on TDS. In the very first question, there is an Indian company which is importing certain computer software from a non-resident company based in USA. Now, when you are purchasing a computer software, you need to understand for what purpose you are purchasing that computer software. Now, if you are purchasing that computer software to resell in India, okay, to the end user or for your personal use, then in that case, it does not amount to royalty as per the Supreme Court judgment of Engineering Analysis Excellence Private Limited. So, if you are purchasing a computer software for resale to end user, then it does not amount to royalty. And if it does not amount to royalty, you are not supposed to deduct TDS on that particular item. Okay, I hope it is clear to all of you. Now, the next one is there is a public sector company who has paid 20 crore rupees to an organization who is providing some services with relation to ATM networks. Okay. So I'm a bank, I'm providing some payment to organization which is providing us some services with respect to what? With respect to ATM services. Now, whether am I supposed to deduct TDS? See, 194H will not apply over here because there is a principal relationship over here. 194H is applicable only if there is a principal and agent relationship. So, if there is a principal and agent relationship, 194H will apply and the amount will be called as commission. But if there is a principal relationship, there is no need to deduct TDS under 194H. Even 194J is not applicable because there is no manual or human interference over here. So, because there is no manual or human interference over here, the question of professional fees does not arise. Therefore, even 194J is not applicable over here. Now, the third question is a very famous question on 194C, which we have discussed in the class also. Suppose I want to make a shirt. I want to stitch a shirt. So, I am going to a tailor to stitch a shirt. Now, the tailor asks me who will give the cloth. So, if I give the cloth or if my associated entity gives the cloth, listen carefully. If I give the cloth or if my associate entity gives the cloth, then I have to deduct the TDS. Okay. Now, the TDS will be deducted on how much amount? The TDS will be deducted on only the stitching charges. If you give me a breakup, this much is for stitching, this much is for cloth. But if you don't give me the breakup and if you give me a consolidated invoice, then I will deduct TDS on the entire amount. Now, coming to this question. In this question, the cloth is provided by my closely related party, that is my associate entity. Therefore, TDS will definitely apply. Now, the question is on how much amount? The other person, that is the person who is stitching the shirt, they are providing me a consolidated invoice. Now, that is where they have made a mistake. Now, because they are providing a consolidated invoice, I have to deduct TDS on the full amount under 194C. I hope it is clear to all of you. And the last question over here on TDS, there is a Canadian citizen who is a non-resident sportsman. Therefore, 194E will apply, 115BBA will apply. So, whatever income they are earning from participating in matches, that will be subject to 20% tax plus 4% cess. Honorarium from writing an article relating to sports for sports magazine, that is also covered under 194E. That will also be subject to 20% tax plus 4% cess. I hope it is clear to all of you. Now, the next question is a beautiful question on what? On transfer pricing. In this question, we need to compute the arm's length price as per cost plus method. So, in cost plus method, what are we supposed to do? We are supposed to find out the cost with respect to associate enterprise, and on that we apply the arm's length margin of the third party, and then we will get our arm's length price. So, here MNO Limited is an Indian company and it is a subsidiary of a company MNO INC. Therefore, because MNO Limited and MNO INC are holding subsidiary, both of them are deemed to be associate enterprise. Therefore, transfer pricing will apply on them. Okay. Now, during the year, MNO has provided some services to MNO INC. Now, MNO also provides similar services to whom? To HTY, which is an unrelated party. Okay. So now we need to find out one by one lot of things. First of all, we will find out what is the margin of the unrelated party. What is the margin of the unrelated party? Now listen carefully. MNO works 9 hours per day for 18 days for MNO INC. Okay, listen carefully. MNO works 9 hours for 18 days to execute the project and 8 hours for 18 days to execute the project for HTY Limited. So let's find out the gross margin of HTY first. Because whatever will be the gross margin of HTY, that we will apply on the cost of MNO. Okay, listen carefully. Whatever is the gross margin of the third party, that we have to apply on the cost for which we are providing services to MNO INC. So what is the gross margin of HTY? Let's try to understand. How much is the cost of HTY? 8 hours per day for 18 days. And the cost is $120 direct cost, $210 indirect cost. So let's try to find out the cost of HTY. The cost of HTY will be direct cost $120 for 8 hours for 18 days. Indirect cost $210, 8 hours for 18 days. Therefore, the total cost is 47,520. But wait. This is only the direct cost. There is one more indirect cost also when we provide some services to HTY. What is that indirect cost when we provide services to HTY? Listen to the question carefully. Listen carefully. Warranty was provided to HTY for a period of 2 years. The cost of warranty is 1.5% of the direct cost. So this is an additional cost when we provide services to HTY, which is 1.5% of the direct cost, which is called as warranty cost. So direct cost is 17,280. 1.5% of 17,280 comes to 259. So this is my total cost. And what is the billing amount to HTY? The billing amount to HTY is 92,000 rupees. Therefore, this is the cost. This is the billing amount, which is given in the question in the very first line. Differential amount will be called as what? It will be called as the margin. Now I will find out my gross margin to the third party, that is HTY. That is 44,240. 220.8 is your margin, and 92,000 rupees is your what? Is your selling price. Therefore, your margin is how much? 92.55%. Now this margin I will apply on what? The cost of MNO INC. Okay, whatever services I am providing to MNO IC, whatever is the cost in that case, that I will apply this particular rate on that particular cost. So MNO I am providing how much services? MNO I am providing services 9 hours per day for 18 days. Okay. Let's see now. 9 hours per day, 9 hours per day for 18 days, 9 hours per day for 18 days, direct and indirect cost. Apart from that, there is some extra cost also of borrowing in respect of MNO. MNO INC, that is the foreign company, has given us a loan of 1,20,000 rupees at the rate of 4% per annum. So that also will be added over here. 1,20,000 at the rate of 4% per annum, divide by 12, because we are computing the monthly data. That is the reason I am dividing this by 12. So this is an additional cost when I am providing services to MNO INC, and this is my cost. And on this I will apply the margin of HTY, and therefore I will get my arm's length price. Then I will compare this with my actual price. I hope it is clear to all of you. Is it clear? Now the next question, the first question over here, the point number 1 is on a very important case law which we have done in class, Pepsi Foods Limited, which is on tribunal, which is on ITAT. Now listen carefully. ITAT generally has to pass an order within 4 years from the end of the financial year in which the appeal is filed. Generally, this is a normal time limit to file an to pass an order by ITAT. Now listen carefully. But if the assessee has taken a stay, then ITAT has to pass an order within 180 days. Within how many days? In case of stay, the order has to be passed within 180 days. Now, can it be extended beyond 180 days? Yes, it can be extended beyond 180 days only if the delay is not attributable to assessee. It means if the delay is because of the ITAT, it has to be extended beyond 180 days also, but then it has to be extended up to 365 days. The stay will be extended up to 365 days, and the appeal order will also be passed up to 365 days. Can it be extended beyond 365 days? The income tax law says very clearly no. The income tax law says that beyond 365 days, it cannot be extended. The stay cannot be extended. The stay has to be vacated after 365 days, even if it is a mistake of the ITAT. Even if it is not a mistake of the assessee, the stay cannot be extended beyond 365 days. Now here comes the Supreme Court in the case of Pepsi Foods Limited, which says that no, that is absolutely wrong. If the delay is because of the ITAT, if the delay is not attributable to the assessee, if the delay is attributable to the ITAT, then they have to extend the stay beyond 365 days also. That is what has been written in this particular case. Okay, I hope it is clear to all of you. Now the next one is a very simple case on board for advance ruling. An order is passed by the board for advance ruling. Now is this order which is passed by board for advance ruling, is it binding on the applicant? And the answer is no, it is not binding on the applicant. The applicant has an option to file an appeal to High Court within 60 days from the date of receipt of order. Now, in case of genuine reason, it can be further extended by another 30 days. Okay, so it is not a binding order. There is an option to appeal to High Court. Next one, there is a public sector company whose case is already pending before ITAT. Can it go for board for advance ruling remedy? And the answer is yes. See, generally you cannot go for board for advance ruling if your matter is already pending in front of ITAT or Income Tax Authority or High Court or Supreme Court. Okay, you cannot go to board for advance ruling remedy. But for public sector undertaking, there is a relaxation that in case of a public sector undertaking, if their case is pending in front of Income Tax Authority or ITAT, even in those cases, they can go for what? They can go for what? They can go for the board for advance ruling benefit. Okay, so that is the reason they are able to go for advance ruling benefit over here. Okay, now one last question over here is, in the following independent cases, we need to identify whether GAR is applicable or not. So there is one company which was making losses, so another company acquired that company to take the benefit of that loss. Is it allowed or not? Absolutely allowed. It is a case of tax planning. There is nothing wrong in that. So if there is one loss making company, another profit making company, and if the profit making company is acquiring the loss making company, that is absolutely allowed as per section 72A of the income tax law, and there is nothing wrong in that. Okay, now the second question, there is a company A Limited which is in India. There is another company C Limited which is also in India. Now instead of giving the loan directly to C Limited and earning interest on that and paying tax on that, what A Limited is doing, A Limited is opening one subsidiary in what? In a tax haven. and giving the money to that subsidiary, and that subsidiary is giving loan to C Limited in India. So they are diverting the funds indirectly to India through a tax haven. Whether GAR will apply or not? Yes, it's a clear case of tax avoidance. Therefore, GAR will apply in this particular case. I hope it is clear to all of you. Third, the assessee is a manufacturer. It wants to set up a unit in SEZ and claim 100% deduction under 10AA. Is GAR applicable? No, it's a case of tax planning. There is nothing wrong in that. You can open a unit in what SEZ and export the goods manufactured over there, and you can claim deduction under 10AA. There is nothing wrong in that. Okay. And the last but not least, it's a very good question on non-resident, which is about agent. Who can be called as an agent in India? So let me read the question first of all. The jurisdictional assessing officer of Mr. Albert. So Mr. Albert is a non-resident, wants to treat the following person as his agent. So now Mr. Albert is owning one residential house in Goa. Now Mr. Albert is selling this house to another person, Mr. D'Souza. Can Mr. D'Souza be treated as an agent? The answer is yes. As per section 163, if a non-resident is selling his property in India to another resident or to another non-resident, listen carefully. If a non-resident is selling his property in India to another resident or to another non-resident, then the buyer can be treated as what? His agent, and he will be responsible for all the tax liability, all the procedure requirement as the case may be. Similarly, point number 2, Mr. Albert employed Mr. Rakesh in 2023, and then Rakesh left the company in 2024. So can Rakesh be called as his agent? See, if any person is your employee, then that person can be called as an agent. But in this case, Mr. Rakesh cannot be called as an agent in 24-25 because Rakesh was employee in 23-24. Rakesh is not employee in 24-25. In 24-25, he left the company. You can check it over here. Therefore, Rakesh cannot be called as what? An agent on behalf of Mr. Albert. I hope it is clear to all of you. So this is what this paper is all about. Now let's move on to the next paper, that is May 2023. This will be our 6th paper, I guess. Yes, 6th paper. So very first question again over here is on total income. The first question over here is on total income. You are supposed to compute total income. That's it. No tax, nothing. You're not supposed to follow 115 BAA or BAB. So you will compute total income as per the normal provision. The assessee is a manufacturer. The net profit is 1 crore 25 lakh rupees. Now the very first adjustment over here is advertisement expenditure of 1.6 lakhs paid in cash. So you cannot pay more than 10,000 in cash. Now one more mistake you have done over here is you are paying excess money to your sister cousin. How much is the market value? The market value is 52,000. You are paying 1,60,000 to your sister concern. Therefore, you are making 2 mistakes. First of all, you are paying excess to your related party. Second, you are paying in cash also more than 10,000 rupees. Therefore, if both the sections 48.2 as well as 48.3 are applied at the same time, you are supposed to follow the order of the law. First, you will follow 48.2 and then you will follow 48.3. So in 48.2, you will disallow the excess amount first. What is the excess amount? 1,60,000 minus 52,000. This is an excess amount that will be disallowed, and the balance, if it is more than 10,000 rupees, that will be disallowed under 48.3. I hope it is clear to all of you. Now, you are doing some repairs to your plant and machinery. Now, this repair amounts to what? Replacement of some worn out part of the machinery. There is no increase in the capacity of the machinery. Therefore, it will be called as a revenue expense, and therefore it will be allowed as a reduction under section 31 because there is no additional increase in the capacity of the asset. Okay. Third one. The third one is something which we have done earlier also. Till last year, the company used to make a mistake of including the interest expense in the opening and the closing stock, and in the current year, the company has rectified that mistake. So if everything is rectified by the company, we don't have to give any effect for this particular adjustment because the company itself has rectified that mistake in the current year in their P&L. Next, one of their employees was on a business trip and he died over there. So employee was on business trip and he died over there, and therefore the company is voluntarily paying him some money. What? In the form of what? Gratuity of 2 lakh rupees. So that will also be allowed as deduction because the employee was on what? Was on a business trip. Okay. So it is your responsibility to take care of him, and in case he dies, therefore you have to pay what? Some gratuity to him. I hope it is clear to all of you. Next adjustment, you are incurring some capital expenditure for promoting family planning. Now remember, family planning expense is only allowed to companies, and that too, if it is a capital expenditure, it is allowed in 5 equal installments. Therefore, you are debiting entire 2 lakh rupees in the current year. Sorry, entire 1.8 lakhs in the current year. Therefore, 4/5 will be disallowed in the current year. Okay, only 1/5 will be allowed. Therefore, 4/5 you have to add back. Okay. Next, you are giving some retrenchment compensation to employees when you are closing one of the unit. Remember, always I have told you in the provision of 37(1) also, if you close one of the unit and then you retrench the employees and pay them retrenchment compensation, that is allowed as reduction. But if you close the entire company, if the entire company is closed, at that time if you give retrenchment compensation, that is not allowed as a deduction. Next one is you have taken some loan from a cooperative bank. What kind of loan? You have taken a trading loan, that is working capital loan. Now, the cooperative bank has waived your loan also, they have waived your interest also. Now, whatever principal they have waived now, whatever principal they have waived, that will be called as remission and cessation of trading liability. That will be considered to be your income and that will be taxable. So, do not reduce that particular thing. But whatever interest they have waived now, whatever interest, that will not be subject to your income. Why? The logic is very simple, because earlier interest was not allowed as an expense on accrual basis. So, now on waiver of the interest should not be taxable also. I hope it is clear to all of you. Next one, employees pension scheme. How much is allowed as a deduction to the employer? We have done earlier also. Up to 14% of the salary, basic salary plus DA in terms. It will be allowed up to 14% of basic salary plus DA in terms. You are paying 12% of basic salary in DA in terms. Therefore, entire amount will be allowed because you are paying less than the limit mentioned by the Government of India. Next one, mark to market loss is allowed as deduction under section 36 subsection 1 clause 18 clause 19, but only if it is from a settled derivative. If it is from an unsettled derivative, that will not be allowed as deduction. Therefore, you have to add back that also. Next one is a very routine adjustment. Provision for gratuity on actuary on the basis of actuarial valuation is disallowed under 48(7). But whatever provision, whatever gratuity you have actually paid of 2.75 lakhs, that will be allowed as a deduction to you. Okay. Next one, you have taken some loan from a private company in which you hold 16% voting power. So if I hold 10% or more voting power in a private company, that is a closely held company, and if that company gives me a loan, that amounts to deemed dividend. How much loan they have given me? They have given a loan of 4 lakh rupees, but deemed dividend cannot be more than accumulated profits. The accumulated profit is 1 lakh rupees. Therefore, the deemed dividend will also be how much? Will also be 1 lakh rupees only. I hope it is clear to all of you. Next one, the company has given iPhones to 5 distributors as what? As a business benefit, as a benefit of participating in business. Now, the iPhone cost 60,000 each and 5 iPhones have been given. So, total of 3 lakh rupees gift has been given in business to somebody, but the company has not deducted TDS on that. So, company should have deducted TDS under 194R. We all know that 194R is applicable. If you give any benefit or participating in business to anybody, to any resident person, then you have to deduct TDS under 194R at the rate of 10% in excess of 20,000 rupees if the threshold is 20,000 over there. Now, here the total is 3 lakh rupees. You have not deducted the TDS. Therefore, 30% of this amount will be what? Disallowed. And last but not least, you are paying some 3,50,000 to an electoral trust by RTGS. So that will be allowed as reduction under 80 GGB. I hope it is clear to all of you. So it was a very simple question, nothing great as such. Okay. Most of the adjustments were repetitive in nature. Now question number 2, it's a good question. The first part is a simple one. The second one is a beautiful one. The first part is a simple one. Mr. A is 34 years old. He is a salaried employee. Now he has furnished the following details. We are supposed to compute the total income of Mr. A. Assuming he has not opted for 115 BSc, it means he is following what? The old regime. He is not following 115 BSc. He is following the old regime. Now his salary is 23 lakh rupees. So from that he will get 50,000 standard deduction. Now business loss 4.5 lakh. Can I set off my business loss against salary income? No, you cannot. You have to carry forward the business loss. Next, short-term capital loss of 3,60,000. Can I set off my short-term capital loss against my salary income? Again, not possible. Capital gain loss can set off only against capital gains income. It cannot be set off against other income. So even this 3,60,000 you have to carry forward and set off. Okay. Till here it is very simple. The next one is also very simple. You are selling some virtual digital currency, that is virtual digital asset VDA 115 BBH. 1,000 BIP coins you are selling. You are selling for 1,300 rupees. You purchase for 1,000 rupees and the transfer expenses is about 2%. So the selling price is 1,300. Transfer expenses are not allowed in case of virtual digital asset. Therefore, this transfer expense is of no use, but the cost of acquisition will be allowed as deduction. So 1,300 is the selling price, 1,000 is the cost of acquisition. So 300 rupees into 1,000 coins will be subject to what? Tax. Now can I set off this for 4,50,000 or 3,60,000 against my virtual digital asset income? No. Virtual digital asset income are directly taxable at 30%. There is no benefit against the virtual digital asset income. I hope it is clear to all of you. So these two losses can neither be set off against salary. These two losses can neither be set off against virtual digital asset income. I hope it is clear to all of you. Now this question is a beautiful question. There are 3 partners in a partnership firm. L, M and N. It's a partnership firm which was formed in 1996. Now L retires from the firm on 27th of July 2024. So now if a partner retires from a firm, then 2 sections are applicable in that case. One is 9B and second is 45(4). Why? Because retirement of a partner amounts to what? It amounts to reconstitution of a firm. And in case of reconstitution of a firm, 2 sections are applicable. First 9B is applicable and then 45(4) is applicable. Now what is 9B? In 9B, how the firm will be, in both the sections, the firm will be liable to tax. Partners are not liable to tax. In 9B, what are you going to distribute in 9B? In 9B, I am going to distribute stock and trade and capital asset. And in 45(4), what will come? In 45(4), money will come and capital asset will come. But in the order of the law, first you have to follow 9B and then only you have to follow 45.4. So first of all, as per 9B, what is the first thing that the firm is giving to the partner? The firm is giving to the partner cash payment of 1 lakh. Is cash covered under 9B? No, cash is covered under 45.4. It is not covered under 9B. Is stock in trade covered under 9B? Yes, stock in trade is covered under 9B. So what is the market value of the stock in trade? 2 lakh. That will become the sale consideration of the stock in trade. And what is the cost of the stock in trade? The purchase price of the stock in trade was 1,20,000 rupees. Therefore, 1,20,000 will be the purchase price. Therefore, 80,000 will be the profit, which is chargeable under PGBP as per 9B. Okay. On that, the firm will pay tax at the rate of 31.2%. Firm will pay tax under PGBP at 30% plus 4% says 31.2%. Now, is one more thing the firm is giving to the partner L, that is land at Kota. Is that also covered under 9B? The answer is yes. What is the market value of that land? It is 17 lakh rupees. Now, when this land is transferred, the land is transferred on 27th of July, which is on or after 23rd July. Therefore, indexation benefit will not be available in this case. Okay. Now, this is the 17 lakh rupees. What will be the cost of acquisition of the land? The land was purchased for 60 lakh rupees, but the FMV of land on 1/4/2001 was 1,10,000. Therefore, you can take the cost of acquisition as 1.1 lakh. Therefore, 15.9 lakhs will be LTCG, taxable in the hands of the firm, and the firm will pay tax at the rate of 12.5% plus 4% says that will amount to 13%. So, the firm under 9B has to pay tax on these two things. On PGBP, 31.2%, and on capital gains, because it is transferred on or after 23rd July, 13% tax. I hope it is clear to all of you till here. Now coming to the next part. The next part is 45.4. Under 45.4, what is the capital gains? Capital gains is A is equal to B plus C minus D. What is B? B means whatever money you have received. B means what? Whatever money you have received. C means whatever market value of the asset you have received. What is the market value of the asset received by the partner? It is what market value of capital asset. In 45.4, stock and trade doesn't come. In 45.4, only money and capital asset comes. Okay. So money is 1 lakh. B, C is market value of the capital asset, that is 17 lakhs, minus what? We need to find out this. Minus the capital account balance. Now the capital account of the balance of the partner L is 20 lakh rupees. Now here you don't have to make a mistake. You cannot directly write 20 lakhs over here. You need to recompute the capital balance over here by finding the change in the book profit, and then that book profit has to be, accounting profit has to be transferred to all the three partners. So listen carefully. When the firm is transferring the assets, as per 9B, the firm is first of all transferring stock in trade. What is the market value of the stock in trade? 2 lakh. The firm is transferring at 2 lakh. What was the cost of the asset? It was 1,20,000. Therefore, 80,000 is the increase in the accounting profit. Okay. 80,000 is the increase in the accounting profit. Is there any increase in the accounting profit because of the land? The answer is no. Because the market value of the land is 17 lakh and today the book value of the land is also 17 lakh. So there is no increase in the book profit because of the land. Okay. So only because of the stock in trade there is an increase in the book profit. Now, after that, the firm is paying two kind of taxes. One, 31.2% on 80,000, that amounts to 24,960. And second, on 15.9 lakhs, firm is paying 13% tax. That amounts to 206,700. So the profit is increasing by 18,000. But because of the taxes, the profit is reducing substantially. So ultimately, there is a loss of 1,51,660 rupees. Now, this will be divided among all the three partners. If I divide this among all the three partners, every partner will get 50,533 loss. So what is the existing capital of the partner L? 20 lakhs. And he has to bear the loss of 50,553. Therefore, this will amount to somewhere around 19 lakhs. And B plus C is 18 lakhs and D is 19 lakhs. So after this, the answer will come to negative. So remember, if as per 45.4, if the answer is coming negative, you have to take 0. So therefore, as per 45.4, the capital gains will come to what? It will come to 0 rupees. It will not be subject to tax. I hope it is clear to all of you. So this is what this beautiful question is all about. I hope it is clear to all of you. Let's move on to the next question. Mrs. AB Inc. is a foreign company which is entering into some agreement with an Indian company for a project which is set up in Gujarat in India. So a foreign company is entering into an agreement with Indian company for a project in Gujarat. Now, they are providing two types of services: offshore services, onshore services. Offshore means they are providing services from their own country, and onshore means they are providing services from India. They do not have any business connection in India, whether they are liable to tax in India. The answer is yes. This amounts to FTS. Okay. So if a foreign company is entering into a contract with an Indian company for setting up a project in India, that is in Gujarat, and they are providing some drawing and design, and they are providing some installation of machinery, all of them are considered to be a fees for technical services. And for fees for royalty, interest and fees for technical services, there is no need to first of all have a business connection in India. There is no need to have permanent establishment in India. There is no need to have any place of business in India. Apart from that, there is no need to come to India and provide service. If they provide services from outside India, then also it is deemed to accrue or rise in India. If they come to India and provide service, then also it is deemed to accrue or rise in India. Now for the offshore services, they are charging how much? They are charging 3 crore rupees. So this will be subject to tax. And for onshore services, they are charging 2 crore rupees, but that is also subject to tax. Okay. Now this 3 crore rupees, they are discharging through a bank account. They are putting in your bank account. So that will be subject to tax. And this 2 crore rupees, they are not giving you in the form of money. Instead of that, they are giving you 6% debenture. So it doesn't matter. I am providing you services. You are giving me debentures instead of money. That is also taxable. But here there is one more catch. On this debentures, there will be charge of interest also. That will also be taxable in the hands of the non-resident. Okay. So how much interest will be charged? 2 crore is the value of debenture into 6% is the rate of interest. You are issuing the debentures on 1st of September. So 7th month interest has to be charged over here. That will also be taxable under 915. So in all, the non-resident ABC INC will be liable for 3 incomes. 3 crore rupees for the offshore service, 2 crore rupees debentures for the onshore services, and interest on debentures also, which is accrued in India. I hope it is clear to all of you. Now let's move on to the next question. Next question is on charitable trust. Let's see over here. There is a charitable trust which has been made for the benefit of the public. Now they are giving some interest-free loans to the company's employees. Now the AO is saying that this is covered under section 13(3) as a specified person, and therefore I will withdraw your exemption. So the entire question is based on only one thing. Is employee of the trust also considered to be a specified person under section 13(3)? And the answer is no. Employees of the specified persons are not covered. Employees of the trust are not covered under the definition of specified person under section 13(3). Therefore, the contention of the assessing officer is not correct. The assessing officer is wrong. Okay. Next one is a very routine question. There is an educational institution with an annual receipt of 2.4 crore and there is an hospital with an annual receipt of 2.5 crore. Are they eligible for exemption without getting an approval? And the answer is yes. Because their total receipt does not exceed 5 crore from education and hospital. If the total receipt is up to 5 crore rupees, there is no need to take any approval. You can enjoy the exemption without taking an approval also. I hope it is clear to all of you. Now in the next question, question number B, the ICI has taken two views over here. Let me read the question first. Mr. Rizvi is an Indian resident. Now what do I mean by Indian resident? There is nothing like Indian resident in this world. Either you need to be resident in India or you should be non-resident in India. There is no concept of resident, Indian resident. So he is 35 years old. He used to work in United States in some company. He used to work in some foreign country and he used to earn some 9,500 AEDs. Now due to his ailing mother, his mother was staying in India and she was not well. So he left the job, he came to India. So after 3 months, he left to the job. He shifted to India in the month of July. So in the April, May and June, he was in the foreign country, and from July onwards, he came to India. Okay. Now he started his consultancy business in India. He also had a property in foreign country, so he let out that property from July onwards. Okay. So in foreign country, he was staying in some property. So when he came back to India on 1st of July, so from 1st July, he has let out the property. Now we need to find out his residential status first of all. Without finding out the residential status, we cannot answer anything. So if he comes to India permanently on 1st July 2024, obviously he is staying in India for more than 182 days. Therefore, 100% he is resident. There is no doubt about whether he is resident or not. But we don't know the status of his past years. Now, if he stays in the past 10 years, 2 years he is resident, and if last 7 years he is staying in India for 730 days, he will be ordinary. I don't have the data. So both the possibilities are correct. So ICI has assumed both the things. In one of the assumptions, the ICI has solved the question by assuming he is a resident and ordinary resident. In another assumption, they have assumed that it is not ordinary resident. If he becomes, first of all, ordinary resident, then what will be the treatment? If he becomes ordinary resident, then everything, world income will be taxable. First of all, 3 months salary will be taxable in India, whatever he has earned outside India. For ordinary resident, world income is taxable. 9-month house property income will also be taxable, which is letting out from July to March. Then business from consultancy in India, that will be taxable. Then fixed deposit in country S will be taxable. Saving bank in India will be taxable. Dividend in India will be taxable. And then the foreign tax rate they have given you. You will also claim 80D, but only 25,000 rupees medical insurance will be allowed because you are not senior citizen. For your parents also, you will get only 25,000 because your parents are non-resident. 50,000 is allowed for resident senior citizen, not for non-residents. So for parents also, you will be getting 25,000 rupees deduction under 80D because you are following old regime. And then we have to compute your sum, and it's a normal question on DTAA. First of all, salary, take 50,000 standard deduction, then house property, take 30% standard deduction, then take all the incomes, take 80 TTA also for saving bank interest, and then 50,000 rupees under 80D. Then compute your income, it's a normal computation. Now, but now think like this. If you are resident and not ordinary resident, then which incomes are taxable? For not ordinary resident, only incomes which are accrued in India, which are received in India, or if the business is done outside India and controlled from India, then it is taxable. So in that case, very few incomes will be taxable. Salary from foreign country will not be taxable. House property from foreign country will not be taxable. Only business income from India will be taxable. Interest from country S will not be taxable. Yes, interest from SBI will be taxable. Dividend will be taxable. Okay, and then he will claim the deduction, and then he will compute the tax. So in the second assumption, when you take NOR, there is no question of double taxation, because double taxation is not happening only. So in the second assumption, there will be no question of relief under 91. Relief under 91 is not possible. Relief under 91 is possible if there is a double taxation. So if you make the first assumption, that is also correct. If you make the second assumption, that is also correct in this particular case. Given a choice, you should make the second assumption, because second assumption is easier to complete in the exam. I hope it is clear to all of you. Now, the next question is again a beautiful question. Mr. P provides some technical consultancy to various clients. Okay. Now, because Mr. P is providing some technical consultancy to various clients, listen carefully. On technical consultancy, TDS is how much? It is generally 2%. Okay, under 194J. But what is the pay doing? Suppose you are providing me some technical services. So I am supposed to deduct here 2% TDS of technical services under 194J. But you are doing what? You are going to the assessing officer. Pay is going to the assessing officer and obtaining a lower deduction certificate of only 1%, and you are giving me that. So you have given me that certificate, and now I should deduct TDS as per 1%. So I should deduct TDS as per 1%. Okay, but you have made one more mistake. You have not filed the return of the last 2 years, and your last year's TDS is 1 lakh rupees. Now remember, now the provisions of 206 AB will attract, not double A. It is wrongly written over here by me. It is 206 AB. So what is my revised rate? Revised rate is 1%. But if the last year TDS is 50,000 or more, and if you have not filed the last year return, then the deductor has to deduct the TDS at twice the rate or 5%, whichever is higher. So twice the rate. What is the revised rate? 1%. What is twice of 1? It is 2%. Or compare with 5%, whichever is higher. So ultimately, I will deduct TDS at how much? I will deduct TDS at 5%. Okay. I hope it is clear to all of you. Similarly, here you are purchasing some house for 60 lakh rupees, and the stamp duty value of the house is 82 lakh rupees. So you will deduct TDS on how much? I will deduct TDS on actual consideration or stamp duty value, whichever is higher. So I will deduct TDS on 82 lakhs, 1%. That is under section 194 IEA. I hope it is clear to all of you. So this was a simple question. Now, the next question is also a very simple question on transfer pricing. There is a company Shahi Private Limited, which is in India, and it is located in SEZ. So it is eligible for deduction under 10AA. It was set up in 2015. Now, the company is engaged in manufacturing of consumable goods. The manufacturing is wholly dependent on the raw material provided by Sumi Inc. So listen carefully. I am Shahi Private Limited, which is in India. Sumi Private Limited is Sumi Inc. is in Japan, and I am wholly dependent on Sumi Inc. So remember, if one entity is dependent on the raw material of another entity to the extent of 90% or more, then both of them are deemed to be associate enterprise. So by that logic, Shahi Private Limited and Sumi Inc. are deemed to be associate enterprises. Now we need to find out what the arm's length price. Now Shahi is importing goods of 30 crore rupees from Sumi. Okay, how much they are importing? 30 crore rupees from Sumi. Now Sumi is charging how much? Sumi is charging 20% markup to us on cost, and to others they are charging only 10%. So Sumi is charging us more. They are taking more money from us. From others they are taking less money. From us they are taking more money. So what shall I do? First of all, I will find out my cost. 30 crore is the price at which I import from Sumi. Now if Sumi is charging me 20% markup on cost, 20% markup on cost is 1/5 on cost, which is 1/6 on sales. Therefore, I will reduce the profit 1/6 from this. So on cost, if it is 1/5, therefore on sales it will be 1/6. So the profit will be 1/6 of 30 crore will be 5 crore. Therefore, my cost will be 25 crores. Now I will apply the normal GP margin on this. What is the normal GP margin? The normal GP margin which Sumi Inc. charges to everybody, that is 10%. So I will add 10% over here of my cost. So 10% of cost will come to 2.5 lakhs. Now I will see if there is any other difference between both of them. Yes, Shahi Private Limited was allowed to use the brand name of Sumi without any payment. The actual cost of the brand value is 90 lakhs. So Sumi is providing us some brand value, some brand name they are allowing us to use. For that also they will charge us how much? 0.9 lakh, that is 90 lakh rupees. 0.9 crore, that is 90 lakh rupees. So that also I will add over here. Okay, 0.9 crore, that is 90 lakhs. So that will amount to 28.4 lakhs. Okay, so this is my actual arm's length price, and the price at which I am purchasing the goods are 30 crores. Therefore, the difference between the two will be considered to be what? 1.6 lakh rupees. I hope it is clear to all of you. I hope it is clear to all of you. So this is the answer to the first part. Now, If the second part, if the TPO has enhanced the income by 2 crore rupees, suppose if the TPO enhanced your income by 2 crore rupees, are you eligible for deduction under 10AA for that 2 crore rupees? The answer is no. Remember, as per 92C subsection 4, if the arm's length price is increased by the assessing officer or TPO, then on that increased arm's length price, you cannot claim deduction under 10AA, nor you can claim what? You can claim deduction under Chapter 6A. Chapter 6A and 10AA will not be allowed on this 2 crore rupees. Last but not least, will Shahi Private Limited be liable for penalty for under-reporting on the basis of the report of transfer pricing? No, penalty will not be applicable. Remember, penalty is only applicable under 270A if the transactions are not reported under Form 3CEB under as per 92E. If the assessee is reporting the transaction in Form 3CEB, then the penalty under 270A will not be applicable on the assessee. I hope it is clear to all of you. Now the next question is based on some case laws over here. The first case law is based on TDS. The assessee has deducted the TDS but has paid the TDS slightly late. Like there has been some delay by 1 or 2 months, but everything has been paid before receiving the notice from the department. So try to understand the sequence of events. The assessee has deducted the TDS, has paid the TDS slightly late, but everything has been done before receiving the department's notice. Now the question is, can department because of this reason prosecute the assessee? And the answer is no. The court has said that if the assessee has deducted on time but has paid slightly late, everything has been done properly before receiving the notice from the department, then the department has no right to impose prosecution on the assessee. Okay, I hope it is clear to all of you. Now the next question is on, does the ITAT has the power to rear the entire order? Suppose ITAT has passed an order and after a few months the ITAT is asking for the order from the assessee, and now the ITAT is changing the entire order completely, taking a different view. The ITAT cannot do that. The ITAT cannot review its own order. That is practically not possible. Yes, if there is some apparent mistake in the order, then the ITAT can definitely rectify that mistake, but the ITAT does not have the power to review its entire order and rear the entire order. Okay, I hope it is clear to all of you. Now the third one. Now this is a very important question over here. Very beautiful case law. So there was an assessee who has initiated some MAP proceeding at international level. What is MAP proceeding, sir? Mutual agreement proceeding at international level. So the assessee was creating some, was having some problem with the foreign authority. So assessee has complained to the MAP proceeding. So the MAP proceeding is pending in case of assessee. Now the question over here is, if MAP proceeding is pending in your case, can the department impose interest under 201 by telling you that you are an assessee in default? The assessee was saying that no, because already a MAP proceeding is pending. Why are you initiating a new proceeding against me to charge me, to tell me as an assessee in default? The court said that there is nothing wrong in that. These two are independent events. Going under MAP proceeding is a separate event, and charging interest under 201 by holding you as an assessee in default, that is a different event. You cannot mix both of them. Okay. Otherwise, everybody will do that only to get evade from the provisions of what? Provisions of 201, that is assessee in default. You will initiate one MAP proceeding. The moment you will initiate one MAP proceeding, will you be escaped from all other provisions of the income tax law? And the answer is a big no. I hope it is clear to all of you. Is it clear? Let's move on to the next question. The next question is based on the concept of significant economic presence covered under section 9. Now remember, under section 9 it is very clearly written that if a non-resident is purchasing some goods of 2 crore rupees or more from India, then it is amounting to what? Significant economic presence. Or if the non-resident has 3 lakh users in India, then also it amounts to significant economic presence. Okay, so based on that, the entire question is over here. Kiwi Inc. is a company based in USA which is engaged in manufacturing and selling of mobile phones. Okay, globally. It sells each mobile phone for $2,000. Now Alpha Inc., another company which is having some website and which is working like what? An e-commerce operator and also providing some advertisement services. Okay, now Kiwi Inc. has sold 80,000 mobile phones through Alpha Inc. First of all, 2% resident in India. Yes, this will amount to significant economic presence because it is sold through a foreign company but to a resident in India. So 15,000 mobile phones into $2,000, you can multiply that, and what is the rate of dollar? In the last line you can see it is 80 rupees. So this will be more than 2 crore rupees, and therefore this amounts to significant economic presence. Now the second one does not amount to significant economic presence because you are not selling to residents in India. Third one will also amount to significant economic presence because again you are selling to residents in India. The fourth one will not amount to significant economic presence because you are again not selling to residents in India. The fifth one will also not amount to significant economic presence because you are selling through a physical store in US. It is just like me going to United States and buying something. That does not mean that the income of that particular physical store will be chargeable to tax in India. No, it has to be sold through resident in India, not in United States. Okay. If you go to United States and buy something from there, that cannot be accrued in India. Okay. That cannot be taxable. Apart from that, they are also providing some advertisement services for publishing advertisement for targeting the Indian customer. So if you are giving some services of advertisement for targeting Indian customers, that will also be taxable in India. So GLC, Gamma LLC enters into a contract with Alpha NC for publishing an advertisement on website from and it paid 90,000 for targeting Indian customers. So if you are targeting Indian customer and earning advertisements out of income out of it, that will also be considered as business connection under 911 and that will also be taxable over here. I hope it is clear to all of you. And one last question over here is we need to answer whether the following transactions will be reported under SFT or not, statement of financial transaction. First of all, Mr. A has purchased 5 bank drafts of rupees 3 lakh each from his current account. Whether this will be reported in SFT? No. In SFT, fixed bank draft is reported only if of 10 lakh or more. It is reported only if it is purchased through cash. If it is purchased through current account, then it will not be reported. Similarly, Mr. Q has made 2 time deposits. One is of 7 lakh, another is a renewal of 5 lakh rupees. So if you make a time deposit of more than 10 lakh rupees, it is reported in SFT. But while computing the limit of 10 lakh rupees, you will not consider the renewal point. And therefore, this renewal of 5 lakh rupees will not be considered over here. Okay. I hope it is clear to all of you. So if I don't consider this renewal, the FD is only of 7 lakh rupees. And because it is less than 10 lakh, that will not be reported in the SFT. I hope it is clear to all of you. Third one, for credit card, which transactions are reported? If the entire credit card transaction of the entire year is more than 10 lakh rupees, it is reported. Or if the cash payment of the credit card bill is more than 1 lakh rupees, then also it is reported. Now, first you are paying cash bill of 19,500 for 4 months. So multiply that will amount to somewhere around 78,000 rupees. Then you are paying 13,300 for 3 months. That will also amount to somewhere around 40,000 rupees. So if I total the first and the third one, the cash payment of the entire year amounts to more than 1 lakh. Therefore, first and the third transaction will be reported in SFT. What about the second transaction? The second transaction you are paying through bank, that will not be reported in SFT because the overall transaction is not exceeding 10 lakh rupees. First and third is the cash transaction. The cash transaction is exceeding 1 lakh. Therefore, that will be reported. The second will not be reported. And last but not least, Mr. Z is purchasing some 2 lakh rupees in goods in cash from Aurora Designer. Aurora Designer is liable for audit. Now remember, if I am Aurora Designer and if I am liable for audit and if I, listen carefully, if I purchase something, see, if I sell something in cash to somebody and if I receive more than 2 lakh rupees, if I receive more than 2 lakh rupees from someone, then it is reported. In this case, it is exactly 2 lakh rupees. Therefore, it is not reported. Listen carefully. If I am doing tax audit and if I am selling you something and if I receive more than 2 lakh rupees in cash from you, then I have to report that in SFT. Now, in this case, it is exactly 2 lakh rupees in cash. Therefore, this transaction will not be reported in SFT. So, this is what this paper is all about. Let's go ahead with the next paper, that is November 2023 paper. The very first question again is on total income only. Now, what is exactly we are supposed to compute over here? We are supposed to compute total income and tax payable. We are not supposed to follow 115 BAA or BAB. Okay, we are supposed to follow as per the normal provision. So let's start. The assessee is a manufacturer assessee. Therefore, you will also be eligible for additional depreciation if you purchase a new plant and machinery. 79,50,000 is the profit. Depreciation as per books of accounts will be added back. Some old machinery has been destructed because of which there is a loss of 25 lakh rupees. So this will be added back. Because it is a capital loss, that is not allowed as a deduction, and the scrap value will be reduced from what? From the PGBP income it will be reduced and it will be adjusted in the WDV of the block of asset. Okay. Next one. Income tax assessment has been completed and there is a demand of 5,70,000 which includes surcharge and cess also. So don't worry, even surcharge and cess are disallowed. Disallow the entire amount including the surcharge and disallow nothing is allowed. Neither income tax is allowed, nor surcharge nor cess is allowed under the income tax law. Next one, you are receiving some power subsidy of 13 lakh rupees during the previous year. That power subsidy is with respect to electricity bill. Now this subsidy is pertaining to 23-24 but you are receiving it 24-25. So remember, power subsidy received from the central government or state government will be taxable in the year in which it is received, so it will be taxable in 24-25. Since it is already part of income, therefore it will be taxable as therefore it will be part of income. It was not included in the income of last year, so it was good that it was not included in the income of last year. Remember, the subsidy, power subsidy, etc. These subsidies are income in the year in which it is received. Okay. Next one, there is some interest on margin money. Now, what is that margin money? Pay attention, please. I want to take some business contract For that purpose, I have gone to the bank. I have to give some bank guarantee to the bank. Now, for the purpose of giving the bank guarantee, I have to make some fixed deposit in the bank. So I made a fixed deposit in the bank. For which I will get bank guarantee, and with the help of that bank guarantee, I will take business contract. Now, on that fixed deposit, if I am earning some interest, that is not income from other source. That is my business income. Therefore, this interest on margin money deposited with the bank for obtaining bank guarantee to carry on business will be chargeable under PGBP, and it will not be an IFRS income. So let it be part of PGBP only. Next one, you are purchasing some raw material for in-house research of 14 lakh rupees, in which 2,75,000 is GST, on which ITC is not admissible. So if ITC is not admissible, you can claim the deduction of GST also. If ITC would have been admissible, then you would have not been able to claim the deduction of GST. So you claim the deduction of entire 14 lakh rupees. Next, you are paying 12 lakh rupees to a Chinese company who is providing some online digital transaction. That company does not have a P in India. Therefore, you should deduct equalization levy. You have not deducted equalization levy. Therefore, this 12 lakhs will be disallowed. Okay. Next one is a very important point. It has come earlier also, but I am giving you justification for the first and the last time over here. Dividend of 2,50,000 received from a foreign company. Now, an expense of 15,000 has been spent on this income, and it is not an interest expense. It is other than interest. See, first of all, I will reduce this 2,50,000 from PGBP, and I will show 2,50,750 in IFOS. Then I will add back this 15,000 rupees and PGBP, and then I will not take the deduction under IFOS, because in IFOS against dividend income there is only one expense which is allowed, and that is interest expense, and this is not an interest expense, therefore it will not be allowed. Now you will ask me one question, sir, why are you not grossing up this dividend? See what ICI has been doing. ICI has not been grossing up the dividend which is received from a foreign company. ICI has been grossing up the dividend only if it is received from a domestic company. So what is the reason? The reason is very simple. I'll let you know. If you receive a dividend from a domestic company, the domestic company will deduct TDS at the rate of 10% under section 194. Therefore, we will gross it up. But if we receive the dividend from a foreign company, we don't know the rates of that particular dividend TDS, because if a foreign company gives you dividend, then in that particular case, TDS under 195 is applicable. Then in that case, I don't know what is the TDS in that particular case, because that TDS will change from country to country, and therefore the TDS is not fixed in that case. Therefore, if you receive dividend, moral of the story is what you know. If you receive dividend from if it is written dividend is received from domestic company, you have to gross up. If it is written dividend is received from foreign company, don't gross up, because we are not sure about how much is the rate of TDS in that case. Okay. Next one. Interest of 20 lakh rupees. You are discharging your interest liability by issuing debenture. Is it allowed? Absolutely not allowed. You cannot convert your outstanding interest into a new loan or debenture or any other security. It is not allowed. That does not amount to actual payment. Therefore, that is disallowed under the income tax law. Depreciation as per income tax law, you can claim 32,50,000 deduction. Then you are purchasing some air compressor, new machinery on 1st of May. You can claim 15% normal depreciation, 20% additional depreciation. For pollution control equipment, you can claim 40% normal depreciation, 20% additional depreciation. Some assets are purchased after 30th October. Lorries for transportation, you can claim 7.5% because it is used for less than 180 days. Additional depreciation not allowed on motor vehicle. Okay, road transport vehicle, additional depreciation is not allowed. One last point, you have imported some machinery which is arrived in the Kolkata on 30th of March, but you have installed in the next year. Therefore, on this you will not get any depreciation. Now, the turnover of last to last year is 450 crore. Therefore, you will be eligible for 30% tax rate, not 25% tax rate. Okay, I hope it is clear to all of you. So this is what this first question is all about. It was a very simple question. Let's move on to the second question, which is on MAT. You need to compute the book profit and MAT over here. There is a domestic company engaged in manufacturing. The profit is 89 lakh rupees. Now we need to see which items will be added back, which items will be reduced, and which items will not be added back, which items will not be reduced. Okay. First, expenses in relation to 10AA do not add back. 10AA expenses and 10AA incomes are not added back or reduced in MAT. Next, depreciation you have to add back, and then you have to reduce the same amount. Why? Because in MAT we add back the depreciation and then we reduce other than revaluation. There is no revaluation in this question. Therefore, you will add back the same amount and you will reduce the same amount. Next, interest not paid is not added back under MAT. Penalty is not added back under MAT. Proposed dividend add back. Provision for income tax add back. Transfer to general reserve add back. Then ATIA expenses are also not added back in MAT. Then amount, next one is a very intelligent adjustment. Amount withdrawn from reserve created during 21-22. So if you withdraw any amount from reserve and credit to P&L, generally we reduce that, but in this case we are not going to reduce. The reason is because the book profit of 21-22 was not increased by such reserve. If book profit of earlier year is not increased, then you cannot reduce this. If book profit of earlier year was increased by this reserve, then we would have reduced from here. Okay, next one, 10AA profit do not reduce. Next one, ATIA profit do not reduce. Deferred tax credit you can reduce. After that, there is a book loss. There is a book loss of how much? 8.75 lakhs, and there is an unobserved depreciation as per books of nil. nil. Therefore, whichever is lower will be allowed. Therefore, 0 will be allowed. Whatever amount we will get, that will be our book profit. On that, apply 15% tax, 4% cess. Surcharge is not applicable because income is less than 1 crore. Therefore, do not apply surcharge. Okay. Next one is provision of section 44 BBA, that is non-resident engaged in operation of aircraft. So now, when this income is accrued in India and how much it is accrued in India and what is the deemed income in this case? See, if the flight is leaving India, then it is definitely taxable in India. Then it doesn't matter where the money is received. But if the flight is leaving from outside India, then it is only taxable if it is received in India. So if the flight is coming from outside India, then it will be taxable if it is received in India. If the flight is going from India, then it is always taxable irrespective of where it is received. How much is the deemed income? Deemed income is 5% in this case. Now, first transaction. Messrs Airlines, XY Airlines collected 90 lakh rupees for carriage of passengers and cargo from Delhi to New York and vice versa, of which 40 lakh was received in New York. 40 lakh was received in New York for carriage of passengers from New York to Delhi. So the flight is flying from New York and the money is also received in New York. So therefore this 40 lakh will not be subject to tax in India. Therefore out of 90, 40 is reduced. Only 50 lakh is taxable out of the first 90 lakh. Second transaction, it collected another 70 lakhs, out of which 30 lakhs were received again in New York from New York to Bombay. Again out of 70, 30 lakhs will not be subject to tax. So only 40 lakhs will be subject to tax. So therefore 90 lakhs, 5% deemed income. How 90 lakhs has arrived? This 50 lakhs and this 40 lakhs, total 90 lakhs, 5% will be deemed income. You have incurred some expenses of 170 lakhs. That is not allowed under 44 BBA. I hope it is clear to all of you. Let's move on to the next question. Next question, point number 2, in which we are supposed to make two assumptions. First, there is an NRI, there is a non-resident Indian who is subscribing some unlisted equity shares. Okay, so we need to assume that if he has purchased in foreign currency or if he has not purchased in foreign currency. If he has purchased in foreign currency, then the provisions of chapter 12A will apply, or the optional chapter will apply, and he will get exemption under 115F. So if he has purchased in foreign currency, see on the board two views. First view, if he has purchased in foreign currency, 115F will apply. If he has not purchased in foreign currency, 115F will not apply. Okay, now let's compute his capital gains. He has sold for 9 lakhs. Expense on transfer is 15 lakhs. He has purchased for 6 lakh rupees. Okay, therefore his capital gains will be 9 lakhs. Pay attention please on the board. See here, where it has gone. Yeah, yes, here 9 lakh is the sale consideration, 15,000 is the expense on transfer, and 85,000 will be the net consideration. Okay, now 6 lakh rupees will be what? 6 lakh rupees will be his cost of acquisition, and 2,85,000 will be his capital gains. Now, if he wants to save this 2 lakh for 85,000 rupees, he has to invest the net consideration in the specified assets within 6 months. How much he has invested? He has invested only 3,50,000 rupees in the question. You can see he has invested within 6 months only 3,50,000 rupees. You can check over here. Within 6 months, he is investing in specified asset 3,50,000 rupees. Therefore, he will get proportionate exemption. How much proportionate exemption he will get? He will get the proportionate exemption as capital gains of 2,85,000 into invested amount in the specified asset within 6 months divided by net consideration. Therefore, this will be allowed as a deduction exemption under 115F. Now, the second view. If he does not purchase the asset in foreign currency, then 115F will not apply. If this 115F will not apply, the answer will be getting over here, and therefore your answer will be 2,85,000 rupees. Indexation will not be allowed here also because you are transferring after 23rd July. See, in chapter 12A, indexation is never allowed. But even if you don't follow the chapter 12A, indexation won't be allowed because from 23rd July 2024, indexation benefit are not allowed to any person except one resident, which I have told you earlier. I hope it is clear to all of you. Now let's move to the next question. Question number 3, which is on charitable trust. Generally, the question number 3 is on charitable trust only. You can understand the pattern of the paper also by looking at this past paper compilation. So there is a charitable trust which is registered under 12AB, which is engaged for preservation of forest. Okay. Now they have asked the following questions. First of all, they are following mercantile system of accounting, and 1 lakh rupees is an electricity expense for 24-25, but unfortunately they paid on 10th of April 2025. Now we all know that for a charitable trust, the deductions are allowed on payment basis. Whenever they will pay the amount, only then it is allowed as deduction. It is not allowed on accrual basis. So therefore, because the electricity expense is paid on 10th April 2025, this will be allowed as deduction in 25-26, not in 24-25. I hope it is clear to all of you. Now the next question is, there is a charitable trust which is earning some agriculture income of 12 lakh rupees. Is it eligible for exemption under section 10(1)? The answer is yes. As per section 11(7), the charitable trust is eligible for exemption under section 10(1) of agriculture income. They can enjoy the exemption of section 10(1). There is no harm in that. Next one, the charitable trust is earning a rental income of 3 lakh rupees. but it received only 2 lakh rupees up to 31st December 2024, and the balance amount is received in the next year. Now listen carefully. 3 lakh rupees is the total rental income, but we received only 2 lakh rupees. Balance is received in the next year. So when they will apply this particular money, they will apply this money in the year of receipt or the year following the receipt. So if they don't apply in the year following the receipt, then it will become deemed income of the year following receipt. I'm talking about which amount? I'm talking about this 1 lakh rupees. So this 1 lakh rupees will be applied in the year of receipt, that is 25-26, that is July 25-26, or year following the receipt. If it is not applied till 2026-27, then it will become deemed income of 26-27. Now the next question is something which has been repeated so many times. I am irritated with this question, that you have taken a loan and with the help of that loan you are incurring some expense. Not allowed. It is only allowed when you repay the loan. Without repaying the loan, it is not allowed as a deduction. I hope it is clear to all of you. Now the next question is a very simple question on DTAA. I'm not wasting my time over here because it's a very straightforward question of DTAA, a very basic question of DTAA. So let's not waste time on that. Okay, let's go ahead with the next question, which is on what? Which is on TDS and TCS. So there is a person, Mr. Ron, who is taking a loan from his employer of 10 lakh rupees. Now why is taking a loan from employer? He is taking a loan from employer for sending money outside India for education of his son in Germany. So he is taking loan from India, from his employer, to send money outside India in Germany for education of his son. Okay. Now, how much money he has sent outside India? He has sent outside India 8,75,000 for university, towards the university in Germany for son's education on 1/10/2024. Now listen carefully. How much TCS will be applicable on this? Whether he will get the benefit of 0.5%? The answer is no. 0.5% TCS is applicable if you take a loan from a financial institution in India and then send for education outside India. Mr. Ron is not taking loan from a financial institution in India. He is taking loan from an employer. Therefore, he will get the benefit up to 7 lakh, no TCS, and above 7 lakh, 1,75,000 he has to pay TCS of 5%, not 0.5%. 0.5% is applicable to whom, which I have told you just now. Now, apart from that, he also remitted 4,75,000 for pursuing higher studies in Germany towards his out-of-pocket expenses. So, whether out-of-pocket expenses are also considered to be part of education, whether the scope of education includes out-of-pocket expenses also, the answer is yes. So, this out-of-pocket expense will also be subject to 5% TCS. So, the first 1,75,000 will be subject to 5% TCS, and then 4,75,000 will also be subject to 5% TCS. Okay, I hope it is clear to all of you. Next one, Mr. Mandeep is a manufacturer, and the turnover of Mr. Mandeep for the last year, that is 23-24, was 12 crore rupees. Okay, now he has purchased the house. He has purchased the house for what? For 5 crore rupees. So now, whether the TDS will be applicable in this case? Yes. If you are purchasing an immovable property of 50 lakh or more, you have to deduct TDS at the rate of 1% of the consideration or stamp duty value, whichever is higher. Okay. Now, apart from that, he also paid a commission of 12% brokerage for purchasing that house. So 12% of 5 crore comes to how much? It comes to 60 lakh rupees. Now, Mr. Mandeep's last year turnover is more than 10 crore, more than 1 crore rupees, and Mr. Mandeep is paying commission for personal purpose. TDS will be applicable under 194H. So under 194H personal purpose is covered? Yes. Under 194H personal purpose is covered. Therefore, you will deduct TDS at the rate of 2% with effect from 1st of October 2024. Before that, it was 5%. In 194C and 194J, personal purpose is not covered. But in 194H, definitely personal purpose is also covered. Therefore, deduct TDS under 194H only. Don't go under 194M. I hope it is clear all of you. If you are not covered in 194C, H or J, then you have to follow the route of 194M. But in this case, you don't have to go to 194M. Next one. The Registrar General of High Court has made a fixed deposit in the bank and the bank is giving them some interest. So on that, TDS is not applicable. So what is this exactly? Generally what happens, suppose if I am a litigant, if I have filed a case in the court and if I am depositing some security deposit with the court, so court takes that money and put that in the bank in the format of FD. Now the bank will give that interest on FD to the court only. So on that interest, the bank is not liable to deduct the TDS. That is what it is written over here. I hope it is clear to all of you. Now the next question is also a beautiful question of case law. The first one is a beautiful one. There was an assessee by the name called as Surajit. He filed his return on 21st of July and declared an income of 11,75,000. Now in his return, he claimed two exemptions. First, he claimed an exemption of PPF of 95,000 rupees, and then he claimed an exemption of long-term capital gains under section 1037. Both of them were disclosed in the exempt schedule of the income tax return. Okay, so he has filed the return, and in the return he has shown two income, one PPF exemption, one long-term capital gain exemption. But unfortunately, he failed to claim current year business loss in the income tax return of 4,50,000 rupees. So he did not claim the current year business loss of 4,50,000 in the income tax return. The income tax return went for processing and while processing the income tax return, the system disallowed the two exemption which he has claimed. The system disallowed the PPF, the system disallowed the long-term capital gains, and intimation was sent to Mr. Sujit and demand notice was raised. Now, later on, he filed a revised return under 139.5, but he failed to e-verify the return. Now, once you file a return, you have to e-verify now within 30 days. He failed to do that. Now, what he is doing, he is going for rectification under 154, and the AO rejected the rectification. Is the AO correct? AO is partially correct, partially incorrect. Now, what is the mistake in the intimation? The mistake in the intimation is to not give exemption of these two items. These two items were claimed by him in the income tax return. Why have you rejected that? That should be allowed. But the AO, the 154 will not allow you to claim 4,50,000 because 4,50,000 was not claimed only in the income tax return. So the question of mistake does not arise only. What was the mistake in the intimation? That the intimation did not allow you the two exemptions which you have claimed, but something which you have not claimed only. How can you tell the department to rectify that? Therefore, the department will not rectify 4,50,000 rupees loss. They will rectify the above two, that is the exemptions. I hope it is clear to all of you. Next one, we all know that once you take a loan from any person, then you cannot repay the loan of 20,000 rupees or more by other than 4 modes. That is account pay check, account pay draft, ECS and such other electronic mode. But what assessee has done? Assessee has made the payment by making a book entry. That is, I have to pay you something, you have to pay me something. Let's knock it off through a book entry. So the AO started saying that no, you are not paying by 4 modes. Therefore, I will charge penalty for you. You are violating the provisions of 269T. Therefore, the matter went to the court. The court said that the penalty under 269T, that is 271E, is imposed by Joint Commissioner, and the Joint Commissioner cannot impose the penalty without giving a reasonable opportunity of being heard to the assessee. And once a reasonable opportunity of being heard is given to the assessee, and if the assessee proves that the transaction is bona fide, then you cannot impose penalty just because the payment is not made by 4 modes, and just because the payment is made by what? Interbook transaction or by book entries, you cannot disallow that. I hope it is clear to all of you. The next question is also a beautiful question. The assessee was engaged in the business of leasing and hire of purchase capital equipment. So I am a leasing company. Okay. So now you are my customer. You came to me for buying, for taking something on lease. Say for example, you have came to me for taking a car on lease. Okay. Now, so I gave you a car on lease. Now to buy that car, I have taken a foreign currency loan. Okay. To buy that car, what I have done? I have taken a foreign currency loan. And whenever I am paying a foreign currency loan, at that time there is some foreign currency loss. So I am claiming that loss as a revenue expense in the PGBP. Now the AO is not allowing that. The AO is saying that you should capitalize that to the cost of asset and claim depreciation as per 43A. Now the court said that no, it should not be capitalized to the cost of asset. Taking loan is a separate transaction and giving asset on a lease is a separate independent transaction. Therefore, take this loss in what? In the P&L account only. No need to take this loss in what? In the asset and take depreciation on that. Do not do that. You cannot do that. You will do that only if both of them are interrelated to each other. Okay. These are not interrelated to each other. I hope it is clear to all of you. Next question is on equalization levy. There is a foreign company ABC Inc. which is in USA, which is engaged in providing what? Online advertisement service. ABC does not have a physical presence in India. ABC does not have a permanent establishment in India. Now that's what we want when we want to charge what? Equalization levy. Now Indian company is there, Raghu Limited. The Indian company is making a payment of 3 lakh rupees on 30th June for providing online advertisement services to ABC Inc. Now, the Raghu Limited remitted the equalization levy on 23rd of March. Now, listen carefully. You are making the payment on 30th June. So, you should pay the equalization levy by 7th of the following month. Now, you are paying on what? On 23rd of March. So, how much delay you have done? You have done a delay of 9 months. What is the equalization levy? On 3 lakh? 6% will come to 18,000 rupees. So 18,000 is the equalization levy, 1% interest for 9 months from 7th of April till 23rd of March. So you have done a delay of 9 months. So 9 month interest you have to pay. Now second transaction over here is you are also taking some online advertisement from Raghu Limited, is also taking some online advertisement from LMF Inc., a UK based company. Now that company has a permanent establishment in India and it is effectively connected to that P. So if the non-resident has a permanent establishment in India and this amount and this online advertisement is effectively connected to that P, then the question of equalization levy does not arise. In that case, we should deduct TDS under section 195 at the rates in force. In that case, see, equalization levy is applicable when the non-resident does not have a PE. If the non-resident has a PE, then we have to deduct TDS under section 195. I hope it is clear to all of you. And one last question is very simple question. Are the following persons liable to file the income tax return? See, Mr. A has incurred 2.4 lakh for his wife for travel to foreign country. Yes. If you incur more than 2 lakh rupees for foreign country travel for yourself or for any other person, you are supposed to file the income tax return. So in this case, Mr. A is liable to file the income tax return. Second, the total turnover of the business of Mr. B is 73 lakhs. Yes, he has to file the income tax return. If the turnover of your business is more than 10 lakh rupees, you are supposed, more than 60 lakh rupees, then you have to file the income tax return. And if the gross receipt of the profession is more than 10 lakh rupees, then also you are supposed to file the income tax return. And the last question over here is a theory question, nothing great as such, you can go through it once. So this is what this paper is all about. So let's go ahead with the next paper, that is May 2024. The very first question over here again is on total income. What exactly we want? Let's read from the last line. We are supposed to compute just total income. Do not follow 115 BAA or BAB. Don't compute tax also. Just find out the total income of the SSE. Now SSE is a private company. It is an Indian company. It is engaged in manufacturing of certain medicines and healthcare solution. The profit is 95 lakhs and the very first item over here is depreciation. So you will add back the depreciation as per the Companies Act. Okay. Now the next one is a very important case law based on Sassoon Chemicals. Now what has happened in this case? Let me give you the background. There was a company and there is an employee and there was some fight between both of them regarding the bonus. And there was some debate which was going how much should be the bonus, etc. And therefore, till the time the debate is not getting solved, till the time the fight is not getting solved, the company has made one trust and the company has deposited that particular amount of bonus in a trust account. And later on, the matter got solved before the due date of filing of return, and the company paid that particular amount to whom? To the employees before the due date of filing of return. So assessing officer did not allow that particular expenditure. So the matter went to the court and the court said that because the payment has been made before the due date of filing of return, it should be allowed. It doesn't matter whether it has been directly paid to the employee or it has been paid through a trust. The point is it has to be paid before the due date of filing of return. That has been done. Therefore, the expenditure should be allowed to the SSE. I hope it is clear to all of you. Next one, you are paying some amount for violating the law of Indian Medical Council Act. If you are violating Indian Medical Council Act and if you are paying some money, it's a penal in nature and therefore that will be disallowed under the income tax law. Next one, you are doing some delay in contract and for that you are paying 45,000 rupees for 5 months. Okay, 9,000 rupees for 5 months. Okay, so if you are doing delay in contract and if you are paying a penalty for that, that penalty is considered to be a compensatory penalty. That is not for breaking a law. It is not penal in nature. It is compensatory. Therefore, that will be allowed under the income tax law. Next one is a very routine adjustment. 100% holding subsidiary selling their assets to each other is absolutely exempt under section 47. Only two conditions have to be fulfilled. Both of them should be 100% holding subsidiary and the recipient has to be Indian company. Therefore, reduce this from the PGBP and show under capital gains as exempt income. Okay. Next one is also very simple, grandfathering clause. Whenever 31st Jan 2018 will come, you have to follow grandfathering clause. I'm not interested in the grandfathering clause over here. First of all, reduce 4.5 lakhs from PGBP and then compute 112A capital gains. Under what capital gains? Okay. Next one, you are giving some bank guarantee to the government in place of disputed tax liability. Whether you will get the deduction. First of all, the deduction of tax is allowed on payment basis. It is not on an accrual basis. Therefore, if you just give a bank guarantee instead of making the payment, that will not be allowed as deduction to you. Okay. Next one, you have taken some loan around 3 years back and on that there is an interest of 7.5 lakh rupees. You have deducted the interest in the month of March and you have deposited the interest by 14th of July. It is absolutely correct. You have to deduct in the same year and you have to deposit by due date of filing of return. If you fulfill these two conditions, the expenditure will be allowed to you. Okay. Next one, you have contributed 65,000 rupees to electoral trust by account paycheck. So that will be disallowed under PGBP and under 80 GGB under chapter 6A, you can claim that deduction. Okay. I hope it is clear to all of you. Now there are some additional informations over here. Now these are some very important and new information, new adjustments given over here. You have imported some machinery parts of 1200 pieces. How many pieces of machinery parts you have imported? 1200 pieces of machinery part you have imported, but unfortunately you have included that in the closing stock. So that is the biggest mistake you have done. You should have capitalized to the cost of machinery and you should have claimed normal depreciation and additional depreciation on that. But rather than doing that, you have included that in the closing stock. Now, because you have included that in the closing stock, obviously you would have included in the purchase also, because without including in the purchase, you cannot include in the closing stock. Therefore, this gets nullified. Don't worry about it. This automatically gets nullified. It is there on the debit side of P&L. It is there on the credit side of P&L. It gets nullified. Now, the only thing that you have to do is, how many pieces are there? 1200 pieces. What is the price of dollar? 25 rupees. When have you imported? On 15th of September. What is the rate on that date? 82.88. Therefore, whatever amount will come, 1200 pieces into $25 into 82.88, whatever amount will come, that you should have capitalized to the cost of machinery and claim normal and additional depreciation. So now claim normal depreciation and claim additional depreciation on that particular asset for the entire, because asset is put to use for more than 180 days. I hope it is clear to all of you. Now, the depreciation charge in the statement of P&L account includes depreciation calculated on the following assets, and only these three assets are there in the what company's income tax purpose. Apart from this, there is no other asset for income tax purpose. So these three assets we have to claim depreciation. First of all, you are purchasing some firefighting equipment. That firefighting equipments were not used. 95,000 rupees is the amount of depreciation on the firefighting equipment. Will you be eligible for claiming depreciation? The answer is yes. Firefighting equipments are used passively, even though it is not actively used, but it is passively used. Now, unnecessarily, why you will open the firefighting equipment unless and until there is a fire? Now, so passive use is there of firefighting equipment. Therefore, 95,000 rupees you can claim as reduction. You have also installed a new machinery on 14th of May. You can claim 15% normal depreciation on that and 20% additional depreciation also on that particular machinery. Further, you have sold some machinery in 2017 for 35 lakh rupees. And you have purchased that same machinery for 65 lakh rupees in 2024. So remember, if you sell an asset and reacquire the same asset, then the actual cost of the asset as per explanation 4 to 43(1) is WDV at the time of original transfer or reacquisition price, whichever is lower. So what is the WDV at the time of original transfer? It was 35 lakhs. And what is the reacquisition price? It is 65 lakhs. Whichever is lower is 35 lakhs. So you will be eligible for depreciation on 35 lakhs, 15%. Additional depreciation won't be allowed because it is a second-hand machinery. Therefore, additional depreciation won't be allowed. After doing all these things, you will compute your total income. That's it. This is as simple as that. So it was a very, very simple question. So let's move on to the next question, question number 2, in which there are multiple questions. There are 3 questions in this particular question. The very first question is on capital gains. Miss Seema is there, age 56 years. She is a resident individual. She has purchased a residential property in 1994 for 45 lakh rupees. The fair market value of the property on 1/4/2001 is 1 crore 20 lakh. The stamp duty value on 1/4/2001 is 1 crore 2 lakhs. Okay. Now she has sold the property for how much? 15 crore 50 lakh. The stamp duty value of the property is 17 crore rupees. Now what will be the full value of consideration in case of Mr. Seema? Miss Seema, 15 crore 50 lakh is the consideration. Stamp duty value is 17 lakh rupees. So is the difference between both of them more than 110%? The answer is no. Now because the difference between both of them is not more than 110%, therefore you are going to take 15 crore 50 lakh as your sale consideration. Okay, this will be your sale consideration. Now what will be your cost of acquisition? See, the actual cost is 45 lakhs. You need to compare with that with the lower of stamp duty value on 1/4/2001 or FMV on 1/4/2001, whichever is lower. Therefore the lower between the two is 1 crore 2 lakhs. Now you will compare that with 45 lakhs, and whichever is higher, that will become your cost of acquisition. Therefore eventually the cost of acquisition will be 1 crore 2 lakh rupees. Okay, so this is how you are going to compute your capital gains. Now after that, she has invested some amount. She has sold this residential property. Obviously this is long term. Now after that, she has purchased one residential plot in Amritsar for 8 crore rupees on 18th of Feb. She also deposited 3 crore rupees in an capital gain account scheme. Okay, so total she has reinvested 11 crore rupees. But under section 54, we all know that she cannot get more than what? More than 10 crore rupees exemption. It is an amendment made by Finance Act 2023 that under section 54, you will get maximum exemption of 10 crore rupees, not more than that. So 8 crore plus 3 crore which she has reinvested to construct a new house, only 10 crore will be allowed as exemption. Now there is one more catch over here which we need to understand. She has two options in this particular question as per Finance Act 2024. First, because she is a resident, she has purchased the property before 23rd July and she is selling the property after 23rd July. She has two options. First option, she can do indexation and take tax rate 20%, and she can ignore indexation and take tax 12.5%. So I have done the solution as per both the things, that if she does option 1, 20% under section 112, then she will get indexation also. Okay, and if she does not take 20%, she goes for 12.5%, then there is no need to do indexation. Okay, directly we have to pay the tax. Okay, so you have both the options, whichever is more beneficial, you can go for that. Okay, the question does not ask about it, but I have done it so that you should have a better idea about what this new provision is all about. Okay, now the next question is based on one case law of Pradeep Kumar Malhotra. Now what has happened in this case law? There was a person, Mr. Manju Memon. He has 20% stake in a private company. So in a private company means in a closely held company, he has 20% stake. Okay, now that shareholder, Mr. Manju Memon, has an immovable property which he has given on rent to the company. So I am a shareholder of a company, 20% shareholder. I am giving my property in rent to the company. Now I am allowing the company to use that property as a mortgage in the bank and take a loan. Okay, so the company is using that property as a collateral security to take a loan from the bank. Okay, now as against that, the company is also authorizing to give me interest-free loan of 20 lakh rupees. Now is this 20 lakh rupees considered to be deemed dividend under section 222E? And the answer is no. Why? Because remember, I have told you in the class, in the case of Pradeep Kumar Malhotra, deemed dividend will under 222E will only include if the loan is given by the company to the shareholder and that loan is a gratuitous loan. Gratuitous loan means that loan is given out of gratitude. That loan has not given just because the shareholder has given a favor to the company. So if the shareholder has given a favor to the company and in return if the company gives the loan to the shareholder, those loans are not subject to deemed dividend under 222E. Now this loan is not a gratuitous loan. This loan is given by the company to the shareholder because the shareholder has given what? The property to the company which the company is using as a collateral security. So this is not a gratitude. This is not out of gratitude. This is give and take relationship. So in case of give and take relationship, I give you something, you give me something. In that case, 222E is not applicable. I hope it is clear to all of you. Okay. Now the next question. Question number 3 is based on non-resident taxation. Miles Inc. is a company incorporated in US. They have their shareholders had meetings in India for 3 times. What is the agenda of the meeting? For the first 2 meetings, they were in India to discuss the modification of the rights of the class of shareholders. And third time, they were in India to discuss about the sale of the company. Does it amount to poem? The answer is no. If the shareholders meet in India for discussing the modifications of the rights of the shares, or if they meet in India to discuss about the sale of the company, that does not amount to place of effective management. You are not interested in effectively managing the business. Rather, you are interested in closing the business by selling the company. Therefore, the poem is not in India, poem is outside India, therefore the company is non-resident. Now, because the company is non-resident, accordingly, you need to answer the question. The very first thing the assessee is earning is dividend is received 5,50,000 net of TDS on GDR. And GDR are purchased in foreign currency. So this will be subject to tax at the rate of 10.4% under 115 AC. Dividend from GDR is taxable at 10.4% under 115 AC, but you have to gross up this dividend because the amount is received, it is net of TDS. So because the tax rate is 10.4%, you have to gross up as per 89.6%. You have to say 5,50,000 is 89.6%. Therefore 100% is how much? Cross multiply and get the answer. Okay. Second one, fees for technical service received from Government of India 5,55,000. Again, this is also received. You need to gross up this. Okay. The Government of India utilized the services for a project carried out in Nepal. So suppose I am Government of India and you are what? You are Miles Inc. You are providing me some services which I am utilizing what? In Nepal. This is also taxable in India. Okay. So but you are utilizing in Nepal. For government, that criteria is not applicable that the services have to be utilized in India. That criteria is only applicable to residents. If I would have been resident instead of government, then the services should have been utilized in India. But for government, the services can be utilized across the world. If the government is paying some FTS, royalty or interest, that is always taxable. It doesn't matter where the services are utilized. So Nepal, they have given us to confuse. Okay. So first of all, this is one important thing. Second, we are assuming that there is an agreement between both of them and therefore this will come under 115A. And that agreement is approved. First of all, is there a need for an agreement between both of them? Yes, there is a need for an agreement between both the party, but there is no need for approval. There is no need for approval. Why? Because if the government itself is receiving the services from non-resident, there is no need for approval. Who will give approval to them? I cannot give approval to myself. Now, approval is only required in case of whom? In case of resident payee. If the payee is the government, then there is no need for any kind of approval. Therefore, assuming that it comes under 115A, we need to gross up this also. So what is the tax rate under 115A? 20% tax, 4% tax, 20.8% will be the tax rate. So you will gross up at 79.2%. Gross up at 79.2% and then you will get the answer. Okay. I hope it is clear to all of you. So this is what this question is all about. Let's move on to question number 3, which is a question on charitable trust. There is a trust by the name called as Devyani Trust, registered under 12AB, and they are using the money of the trust for some illegal persons. First of all, they are giving 4,50,000 for the benefit of the trustee. So if you apply the if you apply any amount for the benefit of the trustee, will be chargeable to tax as per section 115 BBI. In this question, we need to find out the specified income which is liable to tax under 115 BBI at the rate of 30%. That's what we are supposed to tax compute over here. Then they are giving rupees 2,50,000 to the benefit of Mr. Sujan Dave, who has donated 3,75,000 rupees. Now, if any person donates to the trust more than 50,000 rupees in a financial year, that person is called to be a substantial contributor. And if the trust pass on the benefits to that same substantial contributor, that is not allowed under the income tax law, and therefore that will also be subject to what? This 2,50,000 will also be subject to what? Will also be subject to specified income. Third one, in the last year you have utilized, you have accumulated some money of 2,50,000 rupees, and in the for some purpose. Generally you have been allowed, now you can accumulate the money for 5 years and then you can apply for the specified purpose within 5 years. Okay, so you have accumulated some money in the last year and you have claimed exemption. Now in the current year you have made a mistake by giving that as a donation to another person. You cannot do that. This is violation of section 11 subsection 2. So this 2,50,000 will also be subject to what? Will also be subject to income tax under 115 BBI. So all the 3 points which I have circled, those 3 points will be subject to 115 BBI 30% tax. I hope it is clear to all of you. Next one, there was a trust which was incorporated in 2023. Now, in that year, the trust was incorporated with an object of relief of poor, and in that year, the trust failed to file an provisional application. So, the trust failed to file an application for provisional registration. Now, in the current year, the trust wants to file the final registration directly. Can the trust do so? The answer is yes. Provisional application is only applicable in the year in which the trust is formed for the very first time. For example, if the trust is started in the current year, then in the current year, if you want to file an application, you have to file a provisional registration. But if there is an old trust, the activities are old, and now if you want to file what a registration, you can directly go for final registration. So if a trust which was formed in 2023, now in 2025 goes for a registration, they can directly go for a final registration. There is no need for a provisional registration in that case. Now, the next question is a very simple DTAA question. I'm not getting into that. Very, very, very simple. We have done much better question on that. You can go through this question very easily. It's a very, very, very straightforward question. There is nothing great in this. Next question is on TDS. Let me talk about that. What is this question all about? First of all, if a hotel, if a restaurant takes some service charge from you, tips from you, and give it to the what? Waiters. Give it to the employees. Is that subject to TDS? We have done it in the chapter of TDS that is not subject to TDS as per the ITC hotel. There is no employer-employee relationship with respect to that particular thing. Okay. With respect to that tip, if the customer will give the tip, the company will give the tip to the waiter. If the customer will not give the tip, then the company will not give the tip. The company is not obligated to give the tip. Okay. In its employment agreement. Therefore, whatever service charge we pay to the hotels or restaurants, and in exchange, the hotel give it to the what? To the waiters, that is not subject to TDS under 192. I hope it is clear to all of you. Next one, there is an individual, Mr. Lalit, whose last year's turnover is 1.5 crore rupees. Okay. Now, he has paid 5 lakh rupees by check, 5 lakh rupees by check to a contractor for construction of factory building. So, under which section he will deduct TDS? He will deduct TDS under 194C. I am an individual. My last year business turnover is more than 1 crore rupees and I am paying more than 13,000 rupees. For what? For contract, and the contract is also not personal. If it would have been personal, then 194C would have not been applicable. So this is not personal contract. This is a factory building. This is the business contract. Therefore, TDS will be applicable in this case under 194C. Okay. I hope it is clear to all of you. Now, you are making the payment to an individual contractor. Therefore, you will deduct TDS at the rate of 1% under 194C. If it would have been other than individual HUF, then the TDS would have been 2%. Next, he is also making further some more payments. Now, he is also making monthly payment of 16,000 rupees for office rent. And he's also making 5,500 rupees for use of furniture. So this will come under 194I. If you take on rent what? Office, or if you take on rent building, land, plant, machinery, furniture, that comes under 194I. Here also you have to check the last year turnover. Is the last year turnover more than 1 crore? The answer is yes. Therefore 194I is applicable. Now 16,000 into 12 plus 5,500 into 12. You have to check aggregate of both of them, and then you have to check whether 2,40,000 is crossing or not. If after aggregating both of them, if 2,40,000 is crossing, you have to deduct the TDS, which is definitely crossing. The aggregate of both of them is amounting to 2,58,000. 10% of that you have to deduct TDS. Okay. Sir, for furniture also it is 10%? Yes. For plant, machinery and equipment it is 2%. For land, building and furniture it is what? It is 10%. I hope it is clear to all of you. Next one, there is a partnership firm who is selling some product through what? Through an e-commerce operator. So the e-commerce operator will deduct TDS. How much they are selling? They are selling 4,90,000 through online sales. The e-commerce operator will deduct TDS at the rate of 0.1%. 0.1%. Sir, why 0.1%? It was 1%. No. From 1st October 2024, the rate has been reduced to 0.1%. Now, so whatever partnership firm is selling through e-commerce operator, the e-commerce operator will deduct TDS at the rate of 0.1% on the gross sales amount, including the commission portion. He will deduct TDS on the gross amount, not on the net amount, including the commission portion. Plus, in case of some transaction, the customers have directly paid to what? To the partnership firm, directly to the seller. Whether the e-commerce operator is liable to deduct TDS on this direct amount also, the answer is yes. The e-commerce operator is liable to deduct TDS on the direct amount also. It is very clearly written in 194O that if the customer directly pays to the seller, it is deemed to be credited by the e-commerce operator, and the e-commerce operator is liable to deduct TDS on this 60,000 rupees also. I hope it is clear to all of you. Let's go on to the next question, which is on transfer pricing and which is on the concept of NJA. There is a company by the name called as Yalin Limited, which is located in country X and it is located in NJA. Now we all know that if you do any transaction with a person located in NJA, if I do any transaction with a person located in notified jurisdictional area, then it is deemed to be associate enterprise. It is deemed to be international transaction. We have to apply all the provisions of the transfer pricing over here. So now, Armo Limited is selling some goods to Yalin Limited. Therefore, both of them are deemed to be associate enterprise. You are selling for how much? 11.75 crore. Now, Armo is selling the similar goods to others, that is to other third party at 13 crore rupees. So, your arm's length price will start from 13 crore rupees. You will start with uncontrolled price now. You will not start with the price at which you sell to what associate enterprise. You always start with the price which you sell to your unrelated party. So to unrelated party, you are selling at 13 crore, and then you have to make two adjustments over here, two functional adjustment. One is of insurance and freight, and another is of what? One is of insurance and freight over here, and another is of what? After sale service. Very, very simple to adjustment. If you do that, your arm's length price comes to 12.56. Your actual price is 11.75. The differential amount will be added back to your income statement. Okay. I hope it is clear to all of you. So it is a very, very, very simple question. Now the next question is a very, very beautiful question on some very, very important case laws. One by one, we are going to decode all of them. So there is an assessee who has taken some engine on lease from a German company. That German company has no permanent establishment in India. That German company does not have a PAN in India. And the Indian company has deducted TDS at the rate of 10% as per the provisions of DTAA. Now, the assessing officer is saying that because the German company does not have a PAN in India, you should deduct TDS at the rate of 10% or 20% for not giving the PAN, 10% as per DTAA, or 20% for not giving the PAN, whichever is higher. The SRC said that 20% criteria is not applicable on DTAA rates. That is only applicable on the income tax rate. Is the SRC officer correct, or is the SRC correct? Who is correct? And the answer is the SRC is correct. The 20% criteria is not applicable on the DTAA rates. It is only applicable on the income tax rate. Therefore, if in the DTAA something is written like if it is taxable, if a particular income is taxable at 10%, then whether the other person is giving PAN or not, it doesn't matter. You cannot tax more than 10% in that case, even if the other person is not furnishing the PAN, because it is not possible to charge tax more than what is written in the DTAA. Or it is not possible to charge surcharge and cess also on the DTAA rate. Forget about PAN rates of 20%. Therefore, no need to deduct TDS at higher rate in absence of PAN. It was held in the case of Air India Limited. So Air India Limited will deduct TDS only at 10%, even though the non-resident is not giving the PAN. I hope it is clear to all of you. Now the next case law is very beautiful case law. The assessing officer has passed an order of assessment in which the assessee committed the mistake of reducing the depreciation instead of adding the depreciation. So instead of reducing, the assessee has made a mistake, not AO has not made the mistake. Instead of reducing the depreciation of 10 lakh rupees, instead of adding the depreciation of 10 lakh rupees, you have reduced the depreciation of 10 lakh rupees. Okay. Instead of adding, you have reduced 10 lakh. It means you have taken double deduction. You have to add back 10 lakh rupees. Now, rather than adding 10 lakh, you are reducing 10 lakh. It means you are taking double benefit now, 20 lakh rupees deduction. Now, the AO did not correct this mistake in his order. The AO did not find this mistake in the order. Okay. Now, later on, the assessee went to appeal to the CIT appeal on some other issue, not this issue. Some other issue they went to appeal. The matter went to the CIT appeal, and the CIT appeal passed the order. Okay. Now, after that, the AO thereafter passed an order under 154 in which he rectified the double deduction of depreciation committed in the order on 20th of November 2019. Now listen carefully. There are three events over here. What is the first event? The assessee, the AO has passed an order. AO has passed an order under what? Under the regular assessment. In that, the AO has not rectified the mistake which has been done by the assessee. Later on, the assessee went to appeal, and in the appeal was on some other matter. Okay. And the appeal was decided on 28th of June. Later on, the AO realized that, oh, I have made some mistake. I have not identified that mistake. So now he wants to rectify under section 154. Now the time limit for rectification under 154 is 4 years from the end of the financial year in which the order sought to be rectified is passed. Now, from where to count the 4 years? Whether should I count the 4 years from the original assessment order, or whether should I count the 4 years from what? From the CIT appeal order. Now that depends upon two different case laws. There are two different case laws in your study material. One is Tony Electronics or Hind Wire Industry Limited. Second is Elegantron Finance Limited or ICICI Bank Limited. As per Tony Electronics Limited, the 4-year time limit will be counted from the subsequent order. That is from 20th June 2024. Then in that case, 4 years time limit has not expired. Therefore, you can make an application. But as per Elegantron Finance Limited, the 4 years time limit will count from the original order. And if you count from the original order, then the 4 years time limit has expired. And in that case, you cannot rectify. The ICI has given both the answers, and both the answers are correct according to ICI. You can write either of them, whichever you feel comfortable. You can write, you may not write both of them. You can write one of them in detail and another you can write a note. That alternatively we can do this also to give better idea to the institute that I know both the answers. Okay. Now one last question over here in this particular question number 5, that there is a private company, domestic company, who has failed to pay some TDS. It has deducted the TDS on time, but it has failed to pay the TDS on time. Okay. Now the commissioner has sent a notice for what? Penalty under 271C. So now can the penalty under 271C can be imposed for late payment? The answer is no. 271C is only for failure to deduct TDS. It is not applicable for failure to pay the TDS. Therefore, if the assessee has failed to pay the TDS but not failed to deduct the TDS, you cannot impose penalty under 271C. 271C is not possible. Okay. I hope it is clear to all of you. Let's move on to this last question number 6. Now from here onwards, from May 2024, new course was introduced in your syllabus. So if from new course onwards, last question generally they ask on one question on the last question. In last question there will be multiple parts. but one of the question will be on tax audit. So do tax audit chapter very precisely. What are you supposed to do in tax audit? Do all the case studies of tax audit which are given in your study material, which is covered by us in our question bank properly. Plus do all the case studies of tax audit from the last two RTPs, May 24, November 24, and May 25. Plus May 25 MTP, November 24 MTP, May 24 MTP, and the last this attempt exam paper. That's it. This much case studies, all the case studies which are given in the RTP, MTP exam paper, and also in your study material, you have to do all of them precisely. If you do all of them precisely, one of the question will be coming out of them only. Okay. Now, what is happening in this particular question? We need to find out whether the chartered accountant is guilty or not under the Chartered Accountant Act 1949. There was a travel company, the Club U Travels Private Limited, engaged in the business of travel agency, has remitted substantial amount outside India. Okay. Now, the tax department collected the documents from the bank, which includes Form 315 CB also by the chartered accountant, list of passenger, copy of their passport, date of travel, and on inquiry from the passengers and verifying that they really traveled or what. So they come to know that they did not travel. The passenger also denied that there was no such transaction. Okay. The income tax department concluded that the remittance was done for some wrong reasons. False invoices were there. So in short, the remittance done by the company says that this we are remitting for our passengers. But when income tax department questions the passenger denied the transaction, and therefore it is a false remittance. It is not a genuine remittance. It is not remitted for the real reason. It is remitted for some other reason. Okay. Now, the chartered accountant has given 78 certificates in Form 15 CB. So when the chartered accountant was asked that what have you done? Have you not checked the things properly? He said that I have done the KYC documents. I was not a statutory auditor, so I did not examine the books of accounts. Okay. So he is giving all these reasons now. So what is the duty of the chartered accountant over here? The duty of the chartered accountant over here is to give Form 15 CB. If he is giving Form 15 CB, he has some moral responsibility. Responsibility number one, he has to examine the books of accounts. Secondly, he has to check whether the applicable TDS rate has been deducted or not, whether the applicable TDS has been deducted at proper rate or not. He has to verify the agreement between both the parties. He has not done all those things. He has only done one thing. He has verified the KYC. Therefore, the chartered accountant is deemed to be guilty. He is doing a gross negligence. He is not performing his duty properly, and therefore, as per Clause 7 and Clause 8 of Part 1 of Second Schedule, he will be deemed to be guilty under the CA Act 1949. I hope it is clear to all of you. The same case study is there in your study material also. We have discussed this case study earlier. Okay. Now, specify with reason whether the following acts can be considered as tax planning, management or evasion. So, Mr. D has a fixed deposit in SBI in his name amounting to 50 lakh. Now, he gifted this 50 lakh to his son. His son is attaining 18 years. Okay. Now, what is the purpose of gifting this 50 lakh rupees? See, I have a FD of 50 lakh rupees. Now, if I earn interest on that, I'll be liable to tax. So, I'm gifting that FD to my major son, not to my minor son. So, is this tax evasion? The answer is no. There is no tax evasion in this. So, is this tax planning? Yes, it is a tax planning. It is allowed. Sir, why it is allowed? It is allowed. There is no provision to club such things. Yes, if I would have given to my minor son, then the interest would have been clubbed. Okay, I'm not giving it to minor son. If I give some gift as a gift to my major son, then whatever income he will earn, that will be his income. That will be not clubbed in my hands. Okay, so you can do that with your major son, but don't do that with your minor son. If you do that with your minor son, that income will be clubbed in your hands only. Okay, next one is Mr. Ram's annual income is 49.5 lakh rupees. Now he is supposed to receive 6 lakh rupees commission from a company. So he is telling the company that don't give me 6 lakh rupees, give that 6 lakh rupees to my wife account. Why? Because he knows that the moment the income crosses 50 lakh rupees, he will be liable for a surcharge of 10%. So he is telling the company, don't give me 6 lakh rupees you transfer to my wife account. It is a clear case of tax evasion. You cannot transfer your income in your wife account. Okay. If you do that, it is a clear case of tax evasion. You will be liable for tax, interest and penalty. I hope it is clear to all of you. Now, last question over here is on board for advance ruling. Here the ICI has taken two views. I will tell you both the views. First of all, there is a non-resident foreign company which is entering into a contract with several Indian companies for doing something. Okay. And they have made an application for board for advance ruling. Okay. So there is one non-resident company, say they are entering into a contract with 10 Indian companies. So they have made an application to the board for advance ruling for tax liability of this transaction. Now, out of the 10 Indian companies, one of the Indian company has also given an application to the assessing officer for determination of question of law. Now, there is one condition in board for advance ruling, that your board for advance ruling will be rejected if your case is already pending in front of Income Tax Authority, ITAT, High Court or Supreme Court. So if your case is already pending, then your application will be rejected. So now here the question is whose case is pending. So there are two views taken over here. If the applicant's case is pending, one option is, if the applicant's case is pending in front of Income Tax Department, it will be rejected. Is the applicant's case pending? No. The application is given by whom? The application is given by the Indian company. The application is not given by the non-resident to the assessing officer. The application is given by the Indian company. So if the applicant's case is pending, If the applicant's case is pending, then the non-resident cannot go. So in the first view, we are assuming that it is not the applicant's case, it is somebody else's case is pending. Therefore, the applicant can go for what? The applicant can go for BFAR. The second option is if anybody's case is pending in front of AO. If anybody's case, is anybody's case pending in front of AO? The answer is yes. Anybody will include the Indian company also. Anybody will include the applicant also. If anybody's case is pending in front of the AO, then you cannot go for board for advance ruling. So in the second assumption, you cannot go for board for advance ruling. I hope it is clear to all of you. So this is what this beautiful paper is all about. So let's go ahead towards one last paper in front of us, that is the November 2024. It is not 25, sorry. How can I give a paper for November 2025? It is November 2024 paper. So let us start with the discussion of this ninth and the last paper. After this, we will be done with 9 RTP in full English for you all and 9 past paper in full English for you all. Total 18 papers have done. I will be also uploading one more video on around 8 MTPs. I think so that will be much more than sufficient for you all during the exams. 26 papers. Okay, 8 or 10. I am just confused on that whether I should upload 8 or 10 papers. You guys comment below and let me know how many papers I should upload. Okay, so let us start with the 9th paper now in our discussion in full English for you all. Now, the very first question over here, obviously on total income, we are supposed to compute total income and tax liability as per the regular provision, and the turnover of last to last year is 450 crore. Therefore, the tax rate will be 30%. Okay. After we are done with the calculation, we should also do calculation as per the concessional tax rates 115BAA, and then we need to find out which regime is more beneficial. The regular regime is more beneficial or the special regime is more beneficial. Now, right now I am not interested in 115BAA. First, I will solve the question as per the normal provision. Okay, let us start. So, SSC is a company, resident company. It was set up in 2010. It is a manufacturing SSC. The profit is 75 lakh. Depreciation you will add back. Okay. Next, dividend you have received of 5 lakh rupees from Arnold INC. So whatever dividend you have received, you will first of all reduce that and you will show that under IFOS, and the interest expense on that dividend of 1,50,000 that you will add back over here, and under the IFOS you will get deduction of interest expense against dividend up to 20% of the gross dividend. So the dividend will be 5 lakh rupees under IFOS and 20% of the dividend will come to 1 lakh rupees. Therefore your net dividend taxable under IFOS will be 4 lakh. Remember, against dividend there is only one expense which is allowed, that is interest expense, and that to up to 20% of what? Your gross dividend. So first of all, you will reduce dividend, you will add back the interest expense, show under IFOS this particular income. Okay. Next one, you have incurred some 5 lakh rupees. You have contributed some 5 lakh rupees to the state housing board for construction of tenements for your workers. Tenements is nothing but a temporary house for your workers. So you are constructing some temporary house for your workers. For that you have paid 5 lakh rupees to the state government body. Now the ownership is with the state government body. You do not have the ownership, so you are not the owner. Therefore this expenditure will be considered to be as a revenue expense, and that will be allowed as a reduction under PGBP because workers are important for the company. Okay. Next one, there is a creditor who has waived your loan, who have waived your credit, and that amount is already credited to the P&L account. So because so if a creditor remits any liability, then it is your deemed income. Now because in this question they have already credited that to the P&L, no effect has to be given. If they would have not credited to the P&L, we would have added to the PGBP income. Okay, I hope it is clear to all of you. Next one is, there is a debenture of 5 years. Now on that you are paying some upfront discount. Interest is paid during the year of 5 lakh rupees. The SSC has taken deduction of 1/5 in the current year. The SSC has not taken the entire deduction in the current year. Now the entire liability has arisen in the current year. Therefore the law says that there is also a court judgment, high court judgment on this, that if there is an upfront discount interest paid by the company on debenture, and if the entire amount is paid by the company, the liability has arisen, you have to take the entire deduction today itself. The company has taken only 1/5 deduction, that is company has taken only 1 lakh out of 5 lakhs. But you have to take the full deduction. Therefore take the balance 4 lakh deduction in the current year itself, reduce 4 lakhs from your PGBP income. Okay, I hope it is clear to all of you. Next one is, the SSC is engaged in building of developing and building rental houses under 80 IBA. From that the SSC has earned a profit of 20 lakh rupees. So 20 lakh rupees will be eligible for deduction under 80 IBA because you are covered under 80 IBA, and 80 IBA you get deduction of 100% of your profits. Apart from that, the SSC also earned 10 lakh rupees from construction of housing project, but now this has not been constructed by the SSC, it has been done through a work contract. Okay, so this will not be eligible for 80 IBA. One more condition is important for 80 IBA, the project has to be approved till 31st March 2022, which is very much approved till 31st March 2022. The project is approved during financial year 21-22. Therefore, if it is approved after 31st March 2022, the deduction under 80 IBA is not eligible. Now because the project is approved till 31st 31st March 2022, you are eligible for 80 IBA. Therefore, what is the total profit from this housing project? 30 lakhs. Out of that, you are only eligible for 20 lakhs under 80 IBA. The work contract is not eligible for 80 IBA. Okay. So 30 lakhs you will show under PGBP, and then 20 lakhs you will show under Chapter 6 as deduction under 80 IBA. Next one, you have purchased the land in 2010 for 5 lakhs, which was compulsorily acquired in 2018, and the original compensation was 10 lakh was awarded, and in the current year the government has given you an additional compensation. So in the current year, the original compensation would have been taxable in the year in which original compensation would have been received. The enhanced compensation will be taxed today. So enhanced compensation is 8 lakh. What is the cost of acquisition of enhanced compensation? Generally it is nil. Therefore this 8 lakh rupees will be subject to 20% tax. Or why 20% tax? Because the transfer has been made before 23rd July 2024. Therefore it will be subject to what? 20% tax. Okay. Next, income tax depreciation you can reduce over here. Next, you have purchased the machinery for 20 lakh rupees in 2020 and insured against it for fire, etc. Then the company, then there was a fire which was broken in September 2023 and the machinery was damaged and the insurance company paid you 22 lakh rupees. Okay. So now you are supposed to compute the block is ceased to exist now. This was the only asset in the block. Therefore, the block is ceasing to exist. Therefore, now you are going to find out what? Now you are going to find out the WDV of the block of asset, and then you will compare with the insurance money, and the differential amount will be considered to be short-term or long-term capital gain. So you have purchased the machinery in 2020. So from 2020 to 2020 to 23, you have to claim depreciation, and therefore in the first year you will claim normal depreciation and additional depreciation also, and in the second year you will only claim normal depreciation. So your WDV comes to 9.39 lakhs, and therefore your sale consideration is 22 lakhs. The differential amount will be subject to short-term capital gains, which will be subject to 30% tax. Okay. And last but not least, the company declares a dividend of 6 lakh rupees to its shareholders during the year on 31st of August 2024. That is 1 month before the due date of filing of return. The company is declaring the dividend. Therefore, under ATM, you will get deduction of dividend received compared with dividend paid, whichever is lower. How much is the dividend income in the IFOS? 4 lakh rupees. 4 lakh rupees is the dividend income in the IFOS, correct? We have done this calculation over here. And how much is dividend distributed? 6 lakh. Therefore, you will get deduction of 4 lakh rupees under ATM. And then you will compute tax as per the regular regime. And then you will compute tax as per the 115BAA. Sir, why 115BAA? Why not 115BAB? Because the company was set up in 2010. Therefore, 115BAB is not possible. For 115BAB, the company should be set up on or after 1st October 2019. Therefore, 115BAA is applicable over here. Now, because 115BAA is applicable, now we need to recompute the income. The only thing that will change over here is you have to add back 80 IBA income. 80 IBA income will be added, 80 IBA deduction will be added back, and then you will get the income as per 115BAA. That's it. 80M is not added back in 115BAA. 80M is allowed under 115BAA. Then compute your tax on long-term capital gains 22%, and on other incomes it will be subject to 22% tax, 10% surcharge, 4% cess. Then compare whichever is more beneficial. You go according to that. Okay. I hope it is clear to all of you. Let's move on to the next question. The next question is a beautiful question, 10-mark question on slum sale. There is a company, Salsi Limited, which is having multiple units, textile unit, chemical unit. It is planning to sell its chemical unit as a going concern for how much? 242 lakhs. Therefore, we need to find out what the full value of consideration of the chemical unit, and then we need to find out the net worth of the chemical unit, which will become the cost of acquisition. Now, while computing the full value of consideration, you have to apply Rule 11 UAE, and in that you are supposed to compute two full value of consideration. First is FMV1 and second is FMV2. First is FMV1, FMV2, whichever is higher, that will be your full value of consideration. And then we will compute the cost of acquisition, which will be the net worth. So FMV1, what is FMV1? FMV1 is the FMV of the asset transferred. So whatever asset you are transferring of the chemical unit, you need to find out the FMV of that as per Rule 11 UAE. So let's compute the FMV1 first. First of all, we are transferring land. For land, you will take the stamp duty value as per Rule 11 UAE. So for land, you will take 62 lakh. For building also, you will take stamp duty value, but in the question, stamp duty value is not given. So for building, you will take book value because stamp duty value is not given. Okay. For machinery, you will take book value as per FMV1. Right now, I am computing only FMV1, FMV1, FMV1. Okay. Now, for license and franchise, which is an intangible asset, you will take book value only. For equity shares, you will take market value. The market value is 42 per share, and there are 1 lakh shares in equity shares. You can check over here. So 1 lakh into 42 will come to 42 lakh rupees. Okay. Now what is left after that? Inventories, you will take book value only. For inventories, you will take book value, and for creditors also, you will take book value only. Okay. Now all the assets have been done as far as FMV1 is considered. FMV1 is over. Now FMV2. What is FMV2? FMV2 is nothing but whatever you are receiving. What are you receiving as a consideration? We are receiving 242 lakhs as a consideration. That's it. So this will become FMV2. Therefore FMV1 or FMV2, whichever is higher, that will become your full value of consideration. Now we will determine what? Cost of acquisition. How to determine cost of acquisition? Cost of acquisition of chemical unit will become your net worth. Okay, and how to determine the net worth? Net worth is nothing but aggregate of all the assets of chemical unit minus aggregate of all the liabilities of the chemical unit. That will be considered to be what? The net worth of the chemical unit. So for that, again, for land, what will you do? For land, you will take the book value now. While computing the net worth, you will not take stamp duty value, you will take the book value. Okay, for building and machinery, you will take the income tax WDV. For depreciable asset, you have to take income tax WDV, which is same as the balance sheet value. So you will take from the balance sheet the income tax WDV. For license and franchise, again, for depreciable asset, you will take income tax WDV. So for this, you need to compute the income tax WDV. You have purchased the license and franchise in 2022. So 2022, you purchased for how much? You purchased for 23 lakh rupees. So you have to reduce depreciation of 1 year. After that, you will get the WDV as per income tax law that you have to take. For inventory, you have to take the same value, that is the book value. For equity shares also, you have to take the book value only, whatever is given in the balance sheet. And for creditors also, you have to take the book value, whatever is given in the balance sheet. You will get the net worth, and after that, you compute the capital gains, whether it is long term or short term. That depends upon the period of holding. It was purchased in 2020, and it was sold when? It was sold in 2023. Just a second. The chemical unit was established in 2020. Therefore, this will be considered to be what? Just a second. This will be considered to be long-term capital gains since the unit is held for what? More than 36 months. Okay. Now remember always that in Finance Act 2024, the period of holding has reduced to 24 months from 36 months. But for slum sale, the government has not changed the limit. For slum sale, the limit is still 36 months only. I hope you all remember that. Okay. The next question is on section 44C. If a foreign company has a branch in India, if a non-resident has a branch in India, and if they allocate some expenses in India, then how much reduction will be allowed to the Indian branch? We are supposed to compute how much reduction will be allowed to Indian branch, and then we are supposed to compute the total income of the Indian branch also. For that, we need to compute the adjusted total income of that Indian branch. How to compute the adjusted total income? We have to take the total income plus add few things. Okay, we have to add few things. What all things will be added back to compute adjusted total income? That I will let you know. And then you have to take 5% of the adjusted total income or actual amount allocated to the Indian branch. Whichever is lower, that will be allowed as deduction. So first we will compute the adjusted total income. There was a loss of 28 lakh rupees to the Indian branch. So you will start with negative 28 lakhs. Then is depreciation added back while computing adjusted total income? No. Depreciation is not added back. Is unabsorbed depreciation added back? Yes. Is short-term capital loss added back? Yes. You have to follow the provisions given under 44C, please. I'm not doing anything new. I'm doing whatever is given under 44C. Then you have paid some voluntary retirement scheme of 12 lakhs, but only 1/5 is allowed. Therefore, 4/5 you have to add back. Okay. How much you have to add back? 4/5. Speculative business loss, all losses have to be added back. Deduction to chapter 6 have to be added back. And then head office expenses also have to be added back. After doing all those things, your adjusted total income is coming positive. So don't need to check all these things. If your adjusted total income would have come negative, then we would have taken average of these 3 years, and then we would have taken 5% of that. When we take average of the last 3 years, only if the adjusted total income of the current year is negative. Now, because the adjusted total income of the current year is positive, you don't have to do average and all in this particular case. Okay. I hope it is clear to all of you. Now. After that, you will get the adjusted total income. Take 5% of that. Whatever is that, compare with what? Actual head office expense with 165 lakh, whichever is lower, that will be allowed as deduction. Now compute the total income. While computing the total income, start with 28 lakhs loss. While computing the total income, will you get the deduction of depreciation? Yes. So do not add back. Will you get the deduction of unabsorbed depreciation? Yes. So do not add back. Will you get the deduction of short-term capital loss? No. Why? Because short-term capital loss cannot set off against PGBP income. Will you get the deduction of 12 lakh rupees? No. Only 1/5 will be allowed. Therefore, add back 4/5. Will you get the deduction of speculative business loss? No, because speculative business loss cannot set off against normal business. Will you get the deduction of chapter 6? Say yes. So do not add back this. Will you get the deduction of head office expense? Not this one. Add back this one and reduce the actual amount which is allowed. That is 5% of the adjusted total income. That will be reduced. Okay. After that, whatever amount will come, that will be considered to be what? That will be considered to your income. I hope it is clear to all of you. Is it clear? Now let's move on to the next question. Question number 3. There are multiple questions in this. The first question over here is on electoral trust. There is an electoral trust which was set up in April 2023. This is the first year of the setup. First year of the electoral trust, and the total voluntary contribution received by the trust is 600 lakhs, and it spent 5 lakh rupees on the management of its affairs. Okay. Now we all know that for electoral trust, if they want to make, they want to take exemption, then they have to distribute 95% of the total donation in the current year. Okay, so out of the amount of 600, if 90% is donated to different political parties, entire 600 crores will be, entire 600 lakhs will be exempt. Okay, now what is the question over here? The question is, what is the amount of surplus that can be distributed by the electoral trust to a registered political party? See, how much the electoral trust has received? It has received 500 lakhs. It has received 600 lakhs. Okay, now it has incurred how much in the form of what? In the form of management of affairs, 5 lakh rupees. How much it is allowed to incur in the form of management of affairs? Remember, there is a provision on that. You can incur 5% of your total donation or 5 lakh rupees in first year, and in subsequent year it is 3 lakhs. For first year it is 5 lakhs, for subsequent year it is 3 lakhs. This is the first year, so we are taking 5 lakhs. So whichever is lower. So how much you can spend on the management of affairs, that is also, there is also a cap on that. So 5% of the total contribution or 5 lakh rupees, whichever is lower in first year, and second year 5% of total contribution or 3 lakh rupees, whichever is lower from second year onwards. This is the first year, so we are taking 5 lakh rupees. Therefore, you can distribute what? You can distribute 600 minus 5 lakhs, that is 595 lakhs. So you can, the distributable surplus is 595 lakhs. Now, if I distribute 595 lakhs, will I be eligible for exemption? Definitely, because you have to distribute only 95% of your 600. So 95% of 600 comes to 570 lakhs. Now, and your distributable surplus is 595 lakhs. So if you distribute 595 lakhs, you will be eligible for the exemption. Now, one last thing is given over here. Will your answer change? Is if out of 100 lakhs, if out of 600 lakhs, 100 lakhs are received from individuals who are not citizen of India. Remember, as per Rule 17 CA, an electoral trust is not allowed to accept donations from not a citizen of India. They are allowed to accept donations only from Indian citizen. If they accept donation from other than Indian citizen, that will be not eligible for exemption. So if they accept donation from other than Indian citizen, then the exemption under section 13B will not be allowed to the electoral trust. I hope it is clear to all of you. Now the next question has come 100 times. I am irritated with this question. There is an organization which is running a school and a hospital, and the aggregate received from both of them is more than 5 crore rupees. Will they be eligible to exemption without approval? The answer is no. If the aggregate received from school and from hospital is up to 5 crore rupees, there is no need for approval. If it is more than 5 crore rupees, you need to take an approval from the Commissioner of Income Tax. I hope it is clear to all of you. Third question over here is, can a trust claim exemption under 1023(6) and under 1046 simultaneously at the same time? The answer is no. A trust has to forego one of them, cannot claim exemption under 1023C also and 1046 also simultaneously at the same time. That is not allowed. Okay. The next question is a very simple question on DTAA, so I'm not wasting time on that. It's a very routine question. You can go through it and you can complete in 2 seconds. Okay. There's nothing great in that. I'm moving ahead with the next question. Question number 4, which is on TDS. Listen carefully. Now, this is a good question on TDS. There are some very good questions put by the institute on TDS over here. The very first question is, there is an individual who has purchased an urban land in 2014. Now, the government has compulsorily acquired that land in 2022. And the government paid a compensation of 2,40,000 rupees to Mr. Bhuvan on 10th of April 2023. And then later on, the government paid an enhanced compensation of 50,000 rupees to Mr. Bhuvan on 10th of December 2023. Is TDS liable to be deducted by the government? The answer is yes. Because the aggregate compensation is more than 2,50,000 rupees. See, for government compensation on compulsory acquisition, TDS is applicable under section 194LA, and under 194LA, TDS is deductible on what amount? In excess of 2 lakh. If the threshold crosses 2,50,000 rupees, then only it is applicable. So in this case, the aggregate amount is exceeding 2,50,000 rupees. Therefore, TDS will be applicable at the rate of 10% on 2.9 lakh rupees. And in this section in 194LA, TDS is deducted on payment basis, not on credit basis. Okay. Now, the next question is also a beautiful question. On 1st October 2023, Mr. Aman was transferring some money outside India, 9 lakh rupees, for overseas tour package and program. Now, we all know that if you transfer some money for overseas tour package and program, for first 7 lakh, it is 5%, and above 7 lakh, that is on balance above 7 lakh, that is on 2 lakh rupees, there will be a TCS of 20% as per section 206C subsection 1G. So first 7 lakh, it is 5%, and above 7 lakh, it is 20%. Okay. But now, here there is a problem. The problem is the buyer has not filed the return for the last 2 years, and the buyer's TCS for the last year is 51,000 rupees. So therefore, if the buyer has not filed the return for the last 2 years, and the buyer's TCS is 51,000 rupees in the last year, then the provisions of 206CCB will apply, not CCA. CCA is for TDS, CCB will apply. And in that case, you have to deduct the TDS, you have to collect the TCS at twice the rate or 5%, whichever is higher, but that cannot be more than 20%. Maximum it is 20%. So in this case, on this 5 lakh rupees, twice the rate, is 10% or 5%, whichever is higher. So on this 5%, the rate will become automatically 10%. And on this 20%, the rate cannot become 40% because maximum 20% will be applied. The tax rate cannot be more than 20% in this case. I hope it is clear to all of you. So 5% will become 10%, but 20% will remain 20% only. I hope it is clear to all of you. Now the third one is also a beautiful question on what? Online gaming TDS. So remember, for gaming, online gaming TDS, when the TDS is applicable at two times. When you withdraw from the account of online game, at that time it is applicable 30% TDS, and the second time when it is applicable on the closing balance. So we need to understand the entire scenario, how much money was there in the opening balance, how much he has deposited, how much he has withdrawn, how much is the closing balance, all those things we need to understand. So this is a Dream 11 account. Mr. Z is a user of Dream 11. He has a credit balance, 10,000 rupees is the opening balance. Then he deposited 1 lakh rupees in the account, okay, and then he earned 30 lakh rupees from the online game. Now during the previous year there was also some bonus given. On the bonus, the income tax is not applicable. Bonus is not subject to income tax, okay, so forget about bonus. Just remember what, how much was deposited. 10,000 was there in the account already, 1 lakh was deposited, 30 lakh was earned, and then on 1st of Feb 2024, 25 lakh was withdrawn. So this is the first time when TDS will be applicable. Now will the TDS be applicable on what? On 25 lakh rupees directly? No. For that the government has given the method of determining the net winning. What is the method of determining of net winning? Whatever amount is withdrawn, that is 25 lakh rupees, minus bracket of whatever is the opening balance plus whatever is amount deposited. How much is the opening balance? 10,000. How much is the amount deposited? 1 lakh. That will be reduced from what? 25 lakh rupees. Therefore, the net winning will come to 23.9 lakh rupees, 30% tax. On this 30% tax has to be paid on 1st of Feb 2024. On this date, it has to be paid. Okay. Now, there is a balance of 6,60,000 on 31st March 2024. So, am I supposed to directly deduct TDS on 6,60,000? No. At the end of the year, you have to do calculation. How? Whatever amount is withdrawn during the year plus whatever is the closing balance. You will add both of them and then you will compare with whatever you have deposited in the current year plus whatever was there in the opening balance plus whatever tax you have paid earlier. Otherwise, there will be duplication of tax. So, whatever tax you have paid earlier, you have paid tax on 23.9 lakhs earlier. So, you will reduce that much. So, after that, whatever amount comes, that will be subject to what? 30% tax. I hope it is clear to all of you. Next question is a very, very simple question on transfer pricing, nothing great as such. There is a company by the name called as Surya Limited, which is an Indian company, and there is a foreign company by the name called as Sun Inc. Now, the Surya is guaranteeing 20% of the total borrowings of Sun Inc. So, Surya is guaranteeing more than or equal to 10% of the total borrowings of Sun Inc. Therefore, Surya and Sun are deemed to be associate enterprise. Now, Surya is importing some goods of 60 crores rupees from Sun Inc. How much? 60 crore rupees. So we are purchasing some goods of 60 crore rupees or 60 lakh rupees, whatever it is. Okay. Don't get into crores and lakhs. The amount is important, not the denomination. So 60 lakhs or 60 crore, whatever it is. So Surya is importing how much? 60 lakh rupees goods from whom? From its associate enterprise. Surya and Sun are associate enterprise, that we have already determined. So Surya is importing goods of 60 lakh rupees from its associate enterprise. Now, the associate enterprise is charging how much markup? It is charging 25% markup to us, whereas to others they charge only 20% markup. To us they are charging more markup. It means we are paying more to Surya Inc. and to others they are charging less. The others are paying less to Surya Inc. So first of all, we need to reduce this markup. 25% on cost, 25% on sales will become 20% on cost. Okay. Therefore, this will become what? This will become what? This will become 12 lakhs rupees. So I have reduced 12 lakhs rupees over here. So 20%, 25% where they are charging markup to us. So I have to find out what is the markup on sales. 25% on cost is 20% on sales. So therefore on sales it is how much? On sales it is 1/5. Okay. Again I am saying if it is 25% on cost, it means it is 1/4 on cost. So therefore I want on sales because I have the sales figure. Na? So how much will be on sales? It will be 1/5 on sales. So I will reduce 1/5 of the cost. So that will become 48 lakhs. Then I have to adjust two things over here. What? Surya Inc. is providing me two more services. He is giving me 1 month extra credit. So whatever 1 month extra credit is giving me, that I have to add back over here. Plus Surya Inc. is also charging me for some brand value. So I have to add the brand value also. And after that, I have to do what? I have to add my normal markup. My normal markup is 20%. And then I have to compare with my arm's length price. Okay. I hope it is clear to all of you. So the rule is very simple. First, you will take the purchase price. From that, you will reduce the markup which Surya is charging. Then you will add your normal markup, that is 20%. Then you will add brand value, extra cost which I have to pay to Surya. Then you will add the extra 1 month credit which Surya is providing you. That also you have to add back. And then you will get your arm's length price. Okay. Now, last but not least, there are some additional questions over here. What is the due date for Surya for furnishing audit report? So the due date is 31st October 2024, 25, whatever it is. It is 31st October, 1 month prior to the due date of filing of return. You have to submit Form 3CB under Section 92E. What is the amount of penalty leviable if Surya fails to furnish the report under 92E. So if you don't furnish the report under 92E, there is a penalty of 1 lakh rupees under section 271 BA. I hope it is clear to all of you. Is it clear? Please tell me. Let's go ahead with the next question. Beautiful question. There was Mr. Balram Kumar who was questioned by the police department because he was having 1 kg of gold ornament. Okay. That was seized by the police and it was given to the income tax department. The income tax department valued the gold. It was valuing around 63.3 lakhs. The assessee did not raise any objection. So what is happening in the first paragraph? There was a gold of 63.3 lakh rupees which was found to be in with Mr. Balram Kumar. The income tax department has raised question on that and the income tax department wants to tax that. The assessee is not raising any objection on that. Now later on during the assessment proceeding, the AO was not satisfied with the explanation given by the assessee and therefore the AO charged income tax on this 63.3 lakh rupees. How much income tax? As per section 115 BBE, because it is unexplained jewelry, bullion, etc. will be subject to 78% tax. 78% tax comes to 49.37 lakhs including cess and surcharge, whatever it is. Plus 12.35 lakhs he was also charging against you an interest. Okay, an interest of 12.35 lakhs was charging. Listen to the amount very carefully. The tax is how much? 49.37 lakhs and the interest is 12.35 lakhs. Then the assessee filed an appeal to the Commissioner of Income Tax Appeal against this order. That assessee was saying, no, this is wrong tax. Matter went to the CIT appeal and the CIT appeal deleted the matter and the assessee was won. The assessee won the case. Now the department wants to appeal to ITAT. So now there is a monetary limit if department wants to appeal to an ITAT. Remember, what is the monetary limit as per section 268? The monetary limit is your tax effect should exceed 50 lakh rupees. Now which has been very recently amended to 60 lakh rupees. Earlier it was 50 lakh rupees, but it has been very recently increased to 60 lakh rupees. This answer we will give as per 50 lakh only, but in the exam if the question comes you have to give as per 60 lakh rupees. Okay, be very careful about it. Now the question is, what do I mean by tax effect? Will tax effect include both tax and interest? If it includes both tax and interest, then the limit is crossing, then the department can appeal. But if the tax effect does not include interest, then you cannot appeal, then the department cannot appeal. Therefore, for that we need to have a fine reading of the income tax law under section 268. Law under 268 says that tax excludes interest. It only includes tax including surcharge and cess. So you should not take interest in the calculation of the monetary limit given by the law. So the monetary limit which you are going to take 50 lakhs or 60 lakhs now should not include what? Interest. So without interest the limit is below 50 lakhs. Therefore the department cannot appeal to what? ITAT. I hope it is clear to all of you. Next one, due to the nature, complexity and the volume of the accounts during the assessment proceeding, the AO has issued direction for inventory valuation. Now the AO has given an inventory valuation. The AO has the power to give inventory valuation or AO has the power to give what? Special audit direction under section 142A. We all know that. The relevant approval has been taken and the company was given an opportunity of being heard. Now, the real problem starts from here. The AO wants to appoint a chartered accountant. Will a chartered accountant do a inventory valuation? The answer is no. Inventory valuation will be done by a cost accountant and not chartered accountant. Okay, this is the first mistake done by the assessing officer. Second, the AO fixed the fees for valuation at 1 lakh rupees. That is also wrong. The fees will be fixed by the Commissioner of Income Tax. Okay, it will not be fixed by the assessing officer. And the AO asked the CA to raise the bill for valuation report directly to the company. That is also wrong. The bill will not be paid. The remuneration and all the incidental charges will be paid by the central government. So 3 mistakes done by the assessing officer. First, inventory valuation will be done by the cost accountant, not chartered accountant. Second, the fees will be decided by the Commissioner of Income Tax as per the rules made by the income tax law. Okay. Third, the fees will be borne by the central government and not by the assessee. Okay, I hope it is clear to all of you. Now, last question over here, which is very simple question. 100 times it has come. There is a cellular company, there is a telephone company which is giving some SIM card or recharge coupon to its agents. So the agents are selling. So 1000 rupees recharge coupon they will sell to the agent at a discounted price, say 900 rupees. The difference of 100 rupees, whether that commission, that all depends upon if there is a principal agent relationship. If there is a principal agent relationship, then that is subject to TDS. If there is a principal relationship, then there is not subject to TDS. So in this case, if we read the case law, we came to know that if there is a principal relationship, therefore in this case there is no need to deduct any TDS. Okay, so this is a case law which has been coming again and again multiple times. So I don't think so again it will repeat it in the May 25 or September 25 or Jan 26. So they will not repeat the same case law again for the next few attempts at least. Now the next question is a simple case law, a simple theory question. You can do that at your end. I'm not interested in discussing theory over here. Okay, something which is very straightforward, which you have to read it from the book. You can do it yourself. Okay. Now the next question is based on again tax audit. I have told you earlier also that from May 2024 onwards, last question will be a tax audit question. Which question? Last question will be your tax audit question. Okay. Now question number 6. There is a domestic company engaged in developing and operating a solid waste management system, filed its return of income on 30th September, claiming deduction under 80IA. So assessee is claiming deduction under 80IA. Now for to claim deduction under 80IA, the assessee has to take a form 15 CCB issued by the chartered accountant. Okay. So the chartered accountant has to check whether all the conditions of 80IA has been fulfilled or not, and accordingly the chartered accountant will issue the certificate. Okay. Now later on the chartered accountant came to know the time limit of 10 years of 80IA is expired. Okay. So while signing the report, he was not aware that the time limit is expired. But later on, the chartered accountant came to know that the time limit of 10 years has expired. So what is the responsibility of the chartered accountant in such case? The moral responsibility of the chartered accountant would be to tell the assessee that file a revised return and the chartered accountant should withdraw its report. These are the two things he should do. He did these two things. He told the assessee to file a revised return, disallowing the deduction under 80IA, and he said that I am withdrawing my report under 10 CCB. Now the department is saying no, the chartered accountant is guilty, etc. No, the chartered accountant is not guilty. A CA will be guilty if he does not exercise due diligence or grossly negligence. In this case, the CA is not grossly negligent. Whenever he came to know, he took a relevant action. He withdrew the report. He changed the PNL. He told the assessee to file a revised return and pay the tax. So the chartered accountant in this case is not guilty. I hope it is clear to all of you. Okay. You have to just write down in few words. Don't stretch it unnecessarily to a great extent. Next question. We are planning to acquire 5 JCB machine, but we are under a dilemma whether to acquire or whether to lease, whichever is more beneficial, we will go for that. So whether the department will apply GAR on this? No, it's a tax planning. No, whether to acquire a machine or whether to take a machine on lease, it is my personal choice. There is nothing wrong in that. Whatever is more beneficial for me, I will do that. Therefore, it is a case of tax planning, and whatever is a case of tax planning on that the government cannot impose GAR. GAR is imposed on tax avoidances, not tax planning cases. Similarly, next case also, it's a beautiful case which is called as tax harvesting. There is an assessee by the name called as Mr. Dhaval, aged 45 years. He has made an investment in equity shares and he has made a short-term capital gains of 110 lakh rupees on 20th of March 2024. Now he's trying to play very smart over here. He was holding another 1000 equity shares which was purchased at 500, and on 31st March, the market value of the share went down to 200. So what he did, he sold all of them at losses. Now, whatever losses he has incurred, he has tried to set off against this capital gains of 10 lakh rupees, and then he repurchased them again on what? On 31st March on 1st April 2024. This is known as tax harvesting. So, if there is a stock which is on loss, you purchased at 500, but now the market value is 200. You sell that stock. And repurchase that stock. Okay. Because of that, what will happen? Whatever you have sold, you will be able to book a loss on that, and that loss can be set off against your other capital gains income. Okay. So this is nothing wrong in that. As of now, there is no provision under income tax law to stop such things. It's a case of tax planning. In future, there might be a provision according to me. That's what maximum people are doing these days. So the government might bring a provision to stop such kind of things in future. But as of now, there is nothing like that. Therefore, no GAR will apply on this. And finally, the last question out of the 9 papers which we have discussed in this particular beautiful compilation. ABC Limited is an Indian company. It makes an application to board for advance ruling in relation to tax liability of a non-resident. So can a resident make an application for non-resident in respect of transactions that we are going to enter with non-resident? The answer is yes. Now, the value of the transaction is 250 crores. So there are multiple questions which are asked over here. How many copies of application need to be filed? You need to file 4 copies, which is called as quadruplicate. 4 copies have to be filed. Okay. What would be the fees? So if the transaction value is between 100 crore to 300 crore, then the fees is 5 lakh rupees. So in this case, you have to pay a fee of 5 lakh rupees. Then what is the remedy available to applicant if the board rejects the application? So this we have done multiple times earlier also. The remedies available is you have to file an appeal to High Court within 60 days from the date of receipt of order. In case of genuine cases, you will get 30 days extension also. I hope it is clear to all of you. So this is what this paper is all about, and this is what my commitment towards my dearest students of full English who wants to learn direct tax in full English from me is all about. See, I could have done one thing for you all, that I could have recorded the things in Hindi and I could have told you that there is an option of auto dubbing. Listen to that in English, but that will not serve the purpose, tell me. I'm telling you honestly, auto dubbing will not serve the purpose. The way I will be explaining in my own way, auto dubbing will not be able to do that. So I am taking this extra effort. I'm not saying that I'm taking extra effort for you all. I can say the extra effort I am taking for Hindi students also. All of them are equal to me. Sometimes I can say that I'm taking extra effort for my Hindi student. Sometimes I can say extra effort I'm taking for my English student. I'm not saying that I'm doing any favor by making a separate video for you all. Absolutely no. It is my duty and it is my honor. I feel very happy that I'm able to serve you all. Especially language cannot become a barrier for my students. If language is becoming a barrier, my knowledge is of no use. For that purpose, if I have to record one thing twice, I will do it. If I have to record one thing thrice, 4 times, 5 times, I will do that also. But I don't know these many languages. I only know Hindi and I only know English, and I don't know any other language. Okay. So I have tried my best to compile this for you all. Believe me. At the end, if you are feeling hopeless, if you are feeling that nothing can be done in direct tax, believe me, just do the 9 RTP compilation, 9 past paper compilation, and the MTP compilation, which I am going to upload in the next few days. Believe me, if you do this properly, you will be easily able to score exemption. Your 80% paper will definitely come out of this only. The ICI does not have any scope beyond this. ICI does not have any scope beyond this. Max to max, they will put some amendments in these questions. And amendments we all have done very precisely on YouTube also, in our class also. So if you have liked our video, this has taken a lot of efforts for me to take this video. So if you have liked it, please share it with your friends who want to learn in full English, and also give your views and opinions below that how did you find this video. Till then, take care all of you. Bye. See you soon.